Hi students, I am Prakash, Chartered Accountant and acting as academic advisor in Masterminds from the past 20 years. Here is a short video introducing matchless Masterminds briefly for the convenience of the students who came to this channel for the first time. Masterminds was established in the year 2002 and has been acting as a reliable platform to offer coaching for CA and CMA courses. Masterminds is undeniably the pioneer and the leader in MEC, CEC, CA and CMA courses with nearly 20,000 admissions per annum. This is an incredible initiative by three edupreneurs, namely Mohan, Radha and Prakash, that is me. All three qualified CA at a very young age of 21 years and started this organization under the mentorship of my father, Mr. M. Siv Prasad Garu. So Mr. Mohan is my brother and Radha is my sister-in-law. And by the way, it's me, Prakash, Chartered Accountant. So here are the courses for which we offer the coaching. We offer coaching for MEC, CEC groups exclusively at intermediate level. And we also offer integrated coaching for MEC along with CA, CMA Foundation. And we also take exclusive admissions for CA, CMA Foundation or CA, CMA Inter. And we also offer coaching for CA, CMA final level as well. Recently, we have started a unique academic program at intermediate level, that is MEC Pro, aiming for the students who want to pursue BBA or MBA or CLAT courses in future rather than CA or CMA, and we have received a huge applause for the same. So 20 years of experience, and we have finished more than 155 batches of CA or CMA Inter in Guntur alone and similar number of batches in all our branches together. So till now completed 17 batches of CMA Inter and 18th batch is going on. Successfully completed 25 batches of CA final till now and 26th batch is running now, and we have also successfully completed 4 CA or CMA final batches in Hyderabad. So till now our students are able to achieve 990 All India ranks at various levels of CA, CMA courses, and our students are able to achieve first rank for 48 times in various courses for which we offer coaching. So in a single year, our students are able to achieve 3 All India first ranks in the year 2020, and till now our students are able to achieve state first rank at MEC intermediate level for 18 times, that too 8 times in a row. In a single attempt, our students are able to grab 98 All India ranks at CMA Inter and final results of January 2021 and our All India ranks in February 2022 CA results. And here are the 10 All India ranks in CA final results of 2021 alone. And till now, our students are able to secure 93 All India ranks at IPCCR CA Inter level in the last 9 years. And here is our physical presence: Guntur, Vijayawada, Hyderabad, Amirpet, Dilshuk Nagar, Vizag, Tirupati, Kurnool and Rajahmundry. And here are the locations where we have branches. And here are the contact numbers. Here is the list of our physical presence and here is the list of our online presence. And for your kind information, we don't have branches in any other locations other than stated here. So please do install our Android app Masterminds Online Classes from Google Play Store, and if you belong to iOS platform, then install an app called Class Plus from Apple Store and enter the organization code as MZGUN. In this app, you can find a large number of useful content like regular batch videos, crash batch videos, rapid revision batches, guidance classes, motivational videos, amendment videos, Masterminds test series, whatnot. Large amount of useful content is already available in the app. In our app, you can find a section called study material where large amount of free content is also available. Until now, more than 24,000 students have already downloaded our app and we are nearing to 25,000. Sir, is it possible to interact with the directors directly? Yes. If it is an administrative issue, you need to contact Mr. Mohan sir on this mail ID. If it is academic issue, you need to contact me on this mail ID. So thanks to all our students who are our true brand ambassadors and who helped us to reach this position. All the best. today I am very much happy to announce you that we are going to upload the marathon lectures on the subject of CA Inter Auditing recorded by our beloved faculty and our old student Mr. Mahmood sir, who is having wonderful corporate experience and also teaching experience. All the students who studied in Masterminds are very much aware about the quality of teaching of Mahmood sir, and today we are going to upload the rapid revision batch videos or marathon videos of the subject of CA Inter Auditing, which run for 17 hours. Yes, what you heard is right. In a matter of 17 hours, you can revise the entire subject of auditing, and in these 17 hours, our faculty is going to give detailed explanation to each and every concept. Since the available time is very less, just by watching these 17 hours of videos, you can revise the entire subject of auditing. And I am very much confident that you will love these videos, and I request all of you to give your valuable comment on the quality of these videos. All the best.
Hi everyone, welcome to you all. Right. So as you all know, we are going to do a series of sessions. We call it as a rapid revision batch. So in total, we are going to have some sessions around 17 to 18 hours. Somewhere around 17 to 18 hours we will be conducting these sessions. In these sessions, our main agenda will be to discuss to revise the entire concepts of the auditing ones. Our entire subject, we want to revise it within this 17 or 18 hours. Right? So it is actually a very short period of time. So we will follow some order. We will not go as per the index. We will follow some order. Why? Because there is a chapter, if you all are aware, there is a chapter company audit. You all know that company audit, everyone can just go through once and can remember all the provisions. So what we did was we planned to revise this company audit chapter at the last. We will keep it as a last priority. So like that, there will be a little bit in a change of the order of discussing. Some concepts has been taken to the end, some concepts has been brought forward on the basis of the priority, on the basis of the importance. Right? So totally in this 17 to 18 hours, we will be going to cover, we will be going to revise the entire auditing material. Okay. So this is the agenda for our sessions. For having these sessions, this is the main agenda. Right. So I think you all are aware, the title of our subject is Auditing and Assurance. The title of our subject is Auditing and Assurance. Right. So in this subject, we are going to discuss nothing but the provisions which are there in the standards on auditing. Okay. So in this entire subject, almost all 80% of the concept will be 80% of the questions or 80% of the theory questions or practical questions, whatever we are going to discuss, 80% has been taken from the standards only. Right. So the remaining 20% of the syllabus, that is some practical concepts which are taken practically, or some other laws and provisions like company audit. Company audit has been taken from the provisions of Companies Act. It is not from a standard, it is actually a practical concept. And if you observe, audit of items of financial statements, audit of different entities, right? This is also taken from standards. Bank audit. So these we are taken from the guidelines of the RBI and Banking Regulation Act. So out of our entire syllabus, 20% of the syllabus is only the content other than the standards. 80% of the syllabus, 80% of the syllabus, 80% of the concepts, 80% of the questions which we have discussed, those all are taken from the standards only. Only 20% of the concept like this company audit, audit of items of financial statements, audit of different entities, bank audit, all these are other than the standards. Right? So we are going to revise them. Okay? And one more thing, during this revision, I will try to cover what is the pattern of this MCQs, how the MCQs can be asked in the examination. We will try to cover that also. Okay? So we will have some focus on what is the pattern of asking on the questions. Whatever I was telling you, it was there in first chapter. So nature, objective and scope of the audit. See, if you observe, so it contains a definition of the audit. So audit is an independent examination of the information, whether profit oriented or not. So this is the definition which you already know, whether it is a profit oriented or not, and irrespective of its size and legal form. And what is the objective of doing the audit? The auditor will express an opinion on the financial statements. Next, what is the purpose of the audit? So it increases the confidence. Enhances means increases. It enhances the degree of confidence of users of the financial statements as they are verified for its validity and accuracy by an independent competent person. Some independent competent person will verify the financial statements, and this independence means what? Independence can be of two types, which you have already seen. Independence is of mind and independence of appearance. So an independent person will verify the financial statements whether they are valid or not, whether they are accurate or not. So that's why it increases the confidence of the users of the financial statements. Next, implications. What are the implications? The auditor's opinion does not guarantee regarding what? Future viability of the entity and also efficiency and effectiveness of management. The auditor will just verify the historical financial information and he will just give an opinion whether they are reliable or not. That's all. Next, what are the points that are to be considered? In this question there is some additional information. What is that? What are the points that are to be considered before expressing an opinion? You are appointed as an auditor of so and so company, and before you actually give your opinion on the financial statements, what are the points minimum you will verify? Right? So they are giving you some set of 8 points. What are they? First point, the information in the financial statements are in conformity with the books of accounts. So the source for the financial statements is actually books of accounts only. So whatever the financial statements that you are preparing, whether they are matching with the books of accounts or not, as an auditor, that is the first point that you have to consider. Next, the journal entries in the books of accounts are supported by sufficient and appropriate audit evidence. Are you required to verify this or not? So whatever the entry which is there in the books of accounts, each and every entry should be supported by sufficient and appropriate audit evidence. For everything there should be proof. Next, there are no omissions or duplications. There should not be any omissions. There should not be any omissions. There should be no omissions, no duplications or fictitious entry. Right? Nothing should be omitted. The entry should not be recorded multiple times, or there should not be fictitious entry. Fictitious means what? There should not be any fake entries. There should not be any fake entries. Next, the information conveyed by the financial statements is clear and unambiguous. The information should be clear. It should not create any confusion. Next, the amount classification and presentation disclosure, that should be as per the accounting standards, and also they should be prepared as per applicable financial reporting framework. And final point, accounting estimates should be reasonable. What do you mean by these accounting estimates? So in the preparation of financial statements, management will be making so many estimates or not. So what are the examples of the estimates? Depreciation. Right? So you will arrive at the depreciation of an asset by estimating the useful life of the asset. By estimating useful life of asset. See, useful life of asset is something which you cannot say it accuracy. For example, today I have bought a fan. So whether for what period it is going to work, I will estimate. No. For example, I have bought one air conditioner. I have installed it in my premises, in my office. So I am estimating the useful life as 3 years for that AC, air conditioner. Will it exactly work for 3 years and after that it will automatically get off? No, right? So it is just my estimate. For example, in the next year, after I have bought, within a 1 month, there was a short circuit and everything got burnt. My air conditioner was also burnt. So I have estimated something wrong from the estimate can happen. Yes or no? So accounting estimates are natural in the process of preparation. We use accounting estimates. The management uses lot of estimates, assumptions. Estimate in the sense assumption. The management will make use of so many assumptions in the preparation of financial statements in so many areas. Depreciation is one area where the management will estimate what is the useful life of the asset. Provision for doubtful debts. It is also a assumption or an estimate. Provision for warranties and guarantees, it is also an assumption, right? So like this, in the preparation of financial statements, there will be a lot of assumptions which will be used, right? These assumptions will not be accurate. As an auditor, you have to verify whether these accounting estimates are reasonable. Whether these accounting estimates are reasonable, acceptable. For example, the company has bought a air conditioner and they want to treat the useful life as 15 years. They want to treat the useful life of the machinery as 15 years. Is it a reasonable accounting estimate? Any air conditioner, to the maximum extent, we can estimate to use it for 5 years, but not longer than that, and generally 3 years only. Right? We cannot estimate an air conditioner to work for 15 years, but the management has bought some set of 100 air conditioners for its offices, and they want to use 15 years as a useful life. Now, is the accounting estimate which is made by the management reasonable? Is it acceptable? No. So as an auditor, you should verify whether the accounting estimates are reasonable or not. Reasonable means not accurate. Reasonable means acceptable, appropriate. That's all. Okay. So these will be the minimum points which as an auditor you are required to consider before expressing an opinion on the financial statements. These are the points which you minimum as an auditor you should verify them once. Right? So we have seen the meaning of the audit, what is the purpose of the audit, what are the implications of the auditor's opinion, and also what are the points that will be considered by an auditor before expressing an opinion on the financial statements. Okay. Now, next question is regarding objectives of the auditor as per SA 200, that we have already seen previously. To obtain reasonable assurance whether the financial statements are free from material misstatements, whether they are prepared as per applicable financial reporting framework, and whether they are, and the auditor is required to report as per relevant standards on auditing. Okay. Now, next, see, so whenever you want to carry out a business, you can carry out in business in so many number of ways. You can constitute your business in so many number of ways, right? So what you can do is, you can start as a sole proprietor, you can start as a partnership firm, you can start as a company, right? You can start as a society. You can also start it as a trust. You can start it as a HUF also. So many number of ways you can constitute your business. And if you want to form a sole proprietor, you can just go and obtain a trade license and can start doing your business. If you want to conduct a partnership firm, there are some 2 or 3 persons who want to pool their funds and they want to start a partnership business. They have to go to the register of firms and get registered under the Indian Partnership Act. Similarly, if you want to form a company, a group of persons will come together, they will pool their capital, they will be allocated shares, and they will go to the ROC, Register of Companies, and they will get a certificate of registration. That is a company. See, actually, this is only this we call it as a legal form. These different types of entity will not have existence. First thing, keep in mind that this company, society, trust, this status is nothing but given by a piece of paper. That's all. This is a status. That means if you want to show a company, will you show it as a building? This building is our company. Can you say that? Or this premises, this building, 2nd floor is our partnership firm. This you cannot say. It does not. Legal form is something which you cannot show it in a physical form. It is just a imaginary form. It is nothing but if you are a company means what? You 4 or 5 persons will come together, pool their capital, and they will get registered with the ROC and get a certificate of registration. That's all. You are a company. Just a piece of paper will show you that you are a company. right? Depending upon the constitution of the business, there will be a laws which are applicable to you. So if you are in partnership firm, you have to comply with the Indian Partnership Act. If you are a company, you have to comply with the Companies Act. Society, there will be Societies Act. If you are a cooperative society, there will be a Cooperative Societies Act. There will be a Trust Act, HUF. So like that, whatever your constitution of the business, there will be some law that will be applicable to you, right? So like this, business can be constituted in so many ways. So if the law under which you are constituted, if the law under which your business is constituted, if that law requires, if that law makes audit mandatory, there can be some laws under which you are constituted which makes the audit mandatory, whereas under some other laws the audit will not be mandatory. For example, if you assume under Companies Act, once you are constituted as a company, you should have a compulsory audit for your entity, whereas the same requirement is not there for sole proprietor, right? So depending upon the constitution, depending upon the legal form of the business, some laws and regulations will be applicable, and under those laws and regulations, some laws make audit a mandatory requirement, whereas some other laws may not make audit a mandatory requirement. So the audits are broadly classified into two categories. One is statutory audit. Other one is non-statutory audit. Non-statutory or voluntary audit. So statutory audit refers to that audit which is made mandatory under the provisions of law. If any audit is mandatory, compulsory under any law for the time being in force, so some law is applicable to you, and as per that law you are compulsorily required to undergo a function of audit. We call such an audit as statutory audit. Whereas the law does not require you to have the law does not require you to undergo any kind of audit, but you voluntarily want yourself to conduct an audit. For example, there is a sole proprietor, he just want to have audit voluntarily. There is no act which requires the audit of a sole proprietor business, but the owner himself wants to get the accounts audited for its own advantages. Is there any restriction? No. If you want to have an audit, you can always appoint an auditor, right? There is no statutory requirement, there is no mandatory requirement, but the business owner wants to have the audit. We call such an audit as non-statutory audit or voluntary audit, right? So examples are companies audit, tax audit under the Income Tax Act, GST audit under the GST Act. These are all examples of a statutory audit. Whereas non-statutory audit like sole proprietor audit, partnership audit, for these entities audit is not required, but still the business owners wants to conduct audit for their own advantages, right? So now come to independence. So in case of statutory audit, is there a requirement of independence of mind, or is there a requirement of independence of appearance, or both? In case of statutory audit, both independence of mind and appearance is also required. In case of statutory audit, both independence of mind and appearance is required. Whereas in the case of a non-statutory audit, independence of mind is only enough, independence of appearance is not required. For example, you are a sole proprietor, you are conducting an audit of sole proprietor, the business owner wants to get some audit, he can appoint his relative as an auditor. He need not go to an external person, right? So independence of appearance is not required in non-statutory or voluntary audit, whereas in the case of a statutory audit, both independence of mind and appearance is required. Both are required. Both independence of mind and appearance, both are required, whereas in the case of a non-statutory audit, independence of mind, that attitude of independence is more than enough, independence of appearance is not required. Now one more thing, in the case of statutory audit, what is the scope of the auditor, what are the rights of the auditor, what are the duties of the auditor? Who will decide that? Law will only decide that. Under whatever law the audit is mandatory, that law only will specify what will be the scope of the auditor, what are the rights of the auditor, what are the duties of the auditor, everything will be told under the law only. Whereas in the case of a non-statutory audit, the scope, rights and duties of the auditor will be mentioned by the appointing authority. So whoever is appointing you as an auditor, he will decide what is your scope, what are your rights, what are your duties. Everything will be decided by the appointing authority. In what case? In non-statutory audit case. Whereas in the case of statutory audit, what is the scope of the auditor, what are the rights of the auditor, what are the duties of the auditor, everything will be decided under the law under which such audit has been made mandatory. Whereas in the case of non-statutory audit, since there is no law which governs the audit, it will be decided by the appointing authority. That means whoever the person is appointing you, they will decide what should be your scope, what should be your rights, and what should be your duties. So on the basis of applicability of the audit, on the basis of statutory requirements, audits are classified into two categories: statutory audit and non-statutory audit. Okay, so this is statutory audit and non-statutory audit on the basis of the requirements of the law. Okay, now what will be the advantages of this audit? What will be the advantages? It safeguards the interest of the shareholders, yes or no? So it will protect the shareholders' interest, because the auditor will verify and say whether the financial statements is correct or not. So it protects the interest of the shareholders, and also it is helpful for getting the bank loans. For loans also you require audited financial statements. If you go to the banker, he will ask for audited financial statements before giving you the loan, right? It is helpful for settlement of the disputes. If there are any disputes relating to trade disputes or income tax related matters, what will be taken as a evidence, what will be taken as a proof? Audited financial statements will be taken as a proof, right? And it is helpful for identifying weaknesses in the internal controls. In case if there are any weaknesses in the internal controls, that we will be able to rectify by way of this audit, right? And also it is helpful for the employees also to get the bonuses, etc. Right? So all these are advantages. And also in the case of amalgamations, in the case of amalgamation, to determine purchase consideration also audited financial statements is required. And in the case of a partnership firm, for example, if one of the partner was expired, his accounts required to be settled or not. In order to settle that accounts also, sometimes audited financial statements will be helpful. In the case of retirement or death of a partner, or in the case of admission of a partner, what should be the capital contribution, what should be the settlement in the case of a death, everything will be helpful. All these issues can be sorted out with the help of audit of the financial statements. Okay, so these are all the advantages of the audited financial statements, right? So not only statutory audits, these are all advantages will be available if you go for a non-statutory audit also. Okay, so these are all the advantages of a non-statutory audit. Now let us see about what should be the qualities of an auditor. So the qualities of an auditor are very simple. So as an auditor, what are the qualities that you must possess? And these qualities are broadly classified into two categories: technical qualities and professional qualities. Technical qualities are those qualities which you acquire through a formal education, nothing but are subjects or curriculum of the CA. So accountancy, as an auditor you must have a technical knowledge of the accounting or not. You should know about standards on auditing, accounting principles, accounting procedures, that you must know. And also you should have a knowledge about, technical knowledge about auditing also. You should know about standards on auditing, you should know how to perform audit procedures, everything. You should have a knowledge about direct and indirect taxes, income tax, GST, service tax, duties, right? All this you must be aware of. And also you should be aware of general principles of laws of contracts and partnership, your foundation or CPT level law. You should be able to know when a contract will be formed, when we will say there is a valid contract, when we will say there is an offer, when we will say there is an acceptance, when a contract will be valid, when there is a valid agreement. This minimum basic concept which you should know, general principles of laws of contract and partnership. And also you should have a knowledge about specific statutes and provisions applicable. Should have specific knowledge of some special statutes also. For example, if you are conducting an audit of company, you should be aware of Companies Act rules and regulations or not. Obviously yes. And also if you are conducting an audit of any of a branch of a bank, you should be able to know about what was mentioned in the Banking Regulation Act, what are the rules and regulations there. If you know, then only you will be able to verify whether these provisions are complied or not. Right? So as an auditor you must possess these technical qualities. Technical qualities are nothing but professional qualities like accountancy, auditing, taxation, general laws of contracts and specific statutes. Apart from this, you are also required to have personal qualities. What are the personal qualities? Like you should have tact, you should be intelligent fellow, you should have a caution, you should be careful, you should have firmness, you should be able to support your decisions, you should have a good temper, you should not get always angry, you should have a proper judgment, decision skills, you should have a patience, you should have clear-headedness, you should not have confusion, you should have common sense, you should have reliability, other person should be able to rely you should have trust. So whatever the qualities which makes a good person, all these qualities should be there in a good auditor also, right? So the qualities of the auditors are broadly classified into two categories: technical qualities and professional qualities, right? So there was one London Lord Justice Lindley case law. In the case of London and General Bank case, there they have told that auditor should have these qualities. So if you observe here, there is a relevant question. Lord Justice Lindley, in the course of judgment in the famous London and General Bank case, has succinctly summed up the overall view of what an auditor should be regarded as a personal qualities. The Lord Justice Lindley, in the case of famous London and General Bank case law, London and General Bank case, in that the Lord Justice Lindley, this judge, have given what are the personal qualities? Nothing but these only: tact, caution, firmness, good temper, judgment, patience, clear-headedness, common sense, reliability, trust. All these are the provisions which are all these. This is the judgment. These personal qualities an auditor should possess, like that the Lord Justice Lindley has told in the London and General Bank case. Okay, so these are the qualities of the auditor. The next question is relating to what should be the ethical requirements of the auditor. What are the minimum moral or ethical requirements? So what are the auditor should be? The auditor should have integrity. What do you mean by integrity? He should be a honest person. He should be a sincere person. He should be a straightforward person. Right? He should be very honest. He should not say, if he has done something, then only he has to comment on that. He should be honest. He should not always tell lies. Right? He should be integrated person. He should be honest, sincere and straightforward. He should have objectivity also. Objectivity means what? Objectivity means not having any partiality. You should not have bias attitude. You should not favor someone. You should not be unbiased to someone. You should treat everyone equally. Right? So whatever work you do, everyone's work has to be reviewed without any bias. There should not be partial attitude. Next, what do you mean by independence? Independence means your wishes should not be your opinion should not be subordinate to the wishes of the management or any other person, and also your opinion should not be subordinate to your own wishes. For example, the original audit fees we have agreed was 5 lakhs. You are appointed as an auditor of some company. The client has originally offered you 5 lakhs of audit fees. Subsequently, when conducting the audit, you came to know about lot of mistakes. Now the client is coming and telling you, sir, don't give a modified opinion, please give unmodified opinion only. Even though if there are mistakes, I will pay 5 lakh rupees extra. What he is telling? He will pay 5 lakh rupees extra if the auditor gives an unmodified opinion, provided even though there are misstatements. Now, can the auditor give importance to his personal wishes? Instead of giving an unmodified opinion, if he wants to give unmodified opinion, why? Because he will get a 5 lakhs extra amount. So because of this personal wishes also, the auditor should not change his decision. So what do you mean by this term independence? The term independence means auditor's judgment should not be subordinate to the wishes and directions of the management or any other person. And also the auditor's decision should not be subordinate to his personal wishes also. And confidentiality, you should maintain confidentiality. Whatever as an auditor, you will have access to any information of the client. The client cannot say, why do you require this information? This is a privilege as an auditor you are going to enjoy. You will have access to a lot of information. Sometimes you will get to know about the trade secrets of the client also as a part of audit. Will you go and disclose that information to the competitor? You should not do that. It should be a minimum ethical requirement to maintain the confidentiality. You should not disclose whatever information that you have obtained from the client to the third party without the permission from the client. Even though there are some scenarios which you want to share, you should obtain the permission of the client. You should obtain the permission of the client, then only you can share the information about the client. This is a minimum ethical requirement that as an auditor you should possess, because as an auditor you are going to have loads of information, some secret information, trade secrets, secret formulas, right? So some patents you will come to know, salaries of a key managerial person you will come to know. So if you go and disclose this information to the competitor, then obviously your client would suffer a loss. So that's why you should maintain a confidentiality. You should not disclose the information. Whatever you have obtained by way of conducting the audit, you should not disclose that information to any other person without the permission of the client. And also you should have necessary skills, professional competence and due care. In order to conduct an audit, you should have skills, you should have specialized skill, you should have competence, you should be capable person. Right? How you will get this skill and capability? By way of your education. Now you are learning all these subjects for what? In future you want to act as an auditor by using the knowledge that you have studied as a part of your curriculum. And you will get this skill by way of training, your articleship. Why you are doing the articleship? Because by doing the articleship, you will be able to obtain that skill, how to do the work. And these skills will come by practical experience also. Right? So all these are minimum ethical requirements. An auditor should possess these minimum ethical requirements. What are they? What are they? Integrity, objectivity, independence, confidentiality, and professional competence and due care. These are the ethical requirements which every auditor must possess. Now, we will come back to threats to independence later. Now, let us see the concept of professional skepticism. What do you mean by this? Professional skepticism. So, professional skepticism involves three parts. See, generally the word skeptic means attitude of questioning mind. It means you should have a questioning mind. You should not accept whatever comes to you. You should not blindly accept whoever says. For example, if you go to the management, and ask, sir, are your financial statements correct? The management will obviously say, yes sir, very correct, 100% perfect sir. Will you blindly believe that? No, right? So every auditor should possess a quality, a characteristic called professional skepticism. And what do you mean by this professional skepticism? Professional skepticism means attitude of questioning mind. Attitude of questioning mind. Right? And you should also be alert to unusual circumstances. You should be alerted to unusual circumstances, and you should make a critical assessment of audit evidence. You should make a critical assessment of audit evidence. So, professional skepticism is one of the important quality which an auditor should possess, and it involves three parts. It should contain an attitude. Professional skepticism means an attitude of questioning mind. What do you mean by this attitude of questioning mind? Whatever you come across while conducting the audit, you should not believe anything blindly. You should be able to counter question it. Is there any chance of misstatement? Is there any chance of manipulation? For example, you went to the company, you asked for a books of accounts. The management has provided you a complete set of books of accounts along with the supportings, bills, everything. Then, at the time of verification, you should not verify them with a view that everything will be correct only. You should not start your verification process with an attitude that whatever management is doing, that is correct only. That attitude should not be there. You should have an attitude of questioning mind. You should verify with an attitude that what could go wrong here? What are the chances of manipulation here? That attitude of questioning mind should be there. Okay? And you should be alert to unusual circumstances. You should always remain alert. When you will remain alert? When usual circumstances happen, you will alert, or when unusual circumstances happen, you will be alert. Generally, any person will be alert when unusual circumstances happens. Yes or no? So, what are the situations that require you to remain alert? So, you have to remain alert to what are the possible frauds that will happen. What are in case of, if there is any situation of possible fraud. For example, you are traveling in a bus. You found that someone was keeping a hand in your pocket. You will be alert or not? Why? Because there is a possibility of someone stealing your wallet from your pocket. Okay, so similarly, during the course of conducting the audit, if any specific area you are sensing that there is a situation, there is a possibility of fraud here, you have to remain alert to that. For example, you are going through the company and you are walking around the company. When you go to the cashier's office, there the cashier was not there at his desk, and also the cash box was kept unlocked. And also the cash box was kept unlocked. There is the cashier was not sitting at his table, and also he did not lock the cash box also when he was away from his desk. Now there is a situation of possibility of fraud in that cash area or not. So you will keep this point in mind while you are verifying the cash. And while you are roaming around the company, you found that there was a place which is close to the gate where they are keeping a lot of some inventory. And also immediately beside the place where the inventory was kept, there is a door which goes out, through which you can go outside of the company, and there was no security guard standing at that gate only. Able to understand? So there was a place where inventory was stored, and that inventory was stored close to some gate. At that gate there was no security guard only. So that means what? There is a possibility of fraud here, there is a possibility of theft here. Some of the workers may take out the inventory and go from that gate outside. Right? So if you find any of these situations of possible fraud, you should be alert. You should be alert about conflicts between multiple audit evidences. Conflicts between multiple audit evidences. Right? So for example, you are verifying the debtors. When you verify the books of accounts, the amount is shown as 10 lakhs. But when you get a confirmation from the debtor, he is telling that he is required to pay 8 lakh rupees only. What is actually happening here? There was one of the debtor in the company books of accounts, right? Mr. A is the debtor. That debtor in the books of accounts, when you observe, it is showing that the amount is 10 lakhs that is required to be received from him. But when I get a confirmation from the debtor, when I ask a letter, when I send an email to the debtor confirming the balance, he is telling that no sir, I am not required to pay 10 lakhs, I will be required to pay only 8 lakhs sir. But the company is showing 10 lakhs of debtor's balance. So here there is a conflict between multiple audit evidences. You will be alert or not? You will be obviously alert. And also, if you are having doubts as to reliability of audit evidence, if you are having any doubt as to reliability of audit evidence, then also you should remain alert. For example, you found some checks, right? So generally the banks will not accept the checks. Or take another example. For example, you are verifying some transaction. You are seeing some supporting invoices. In the supporting invoices, there are lot of strike-offs. Or for example, take your MCQs paper only. Take some MCQs. You are attempting some exam which contains objective questions, right? Which contains only MCQs. For example, first you wrote a correct answer. First you wrote the option as B. Then you strike it off. Then before that, or you have strike it off, and then you have written the answer as correct option as B. Is it acceptable? Now you will get a doubt or not. This person might have copied. Why? Because first he wrote the answer as A, then he strike it off, then he wrote the B. So there can be certain circumstances. Similarly, in audit also, there can be certain circumstances where you will get a doubt as to reliability of the audit evidence. Whether that evidence is reliable or not, you will get a doubt sometimes. Regarding that doubt also, you should remain alert. So the auditor should remain alert under three circumstances. What are that? Situations of the possible fraud, conflicts between the multiple audit evidences, and doubts as to reliability of the audit evidence. Right? So by being alert, what can happen? By being alert to unusual circumstances, you can reduce risk of overlooking unusual circumstances. By overlooking unusual circumstances. For example, if you are not remained alert, so for example, you are traveling in the bus, so you found a sense of someone putting a hand in your pocket, but still you are not alert. What will happen? That person will run away with your purse. So similarly, if you are alert, what you can do? You can take immediate action. You can turn around and if you find the person, you will beat him, or you can stop him from stealing your purse. Yes or no? So similarly, in the conduct of audit also, by being alert to unusual circumstances, you can reduce the risk of overlooking unusual circumstances. You will not overlook it. So if you don't remain alert, if you are not alert to the situation that the cash desk was left unlocked, then you will not be able to find the mistakes in the cash. Right? By being alert, you can reduce the risk of overlooking the unusual circumstances. You will overlook that. You can reduce that overlooking by remaining alert. And also you can reduce the risk of overgeneralizing you will also reduce the risk overgeneralizing while taking the decisions, while making the conclusions. So for example, you have verified some transactions. If you have verified only purchases area, in the purchases area everything is good, you cannot say, sir, since purchases area is good, every area also will be good. Right? Why? Because in purchases internal controls are working very strong, whereas in the sales area the internal controls may not be that strong. If you don't have that professional skepticism, what you will think, since in purchases area everything is correct, in all other areas also everything will be correct, right? But you maintain this professional skepticism, you are alert to unusual circumstances, then you will not overgeneralize it. Similarly, you can reduce the risk of taking inappropriate decisions. If you remain professionally skeptical, you will reduce the risk of inappropriate decisions regarding the audit procedures. You will reduce the risk of taking the inappropriate decisions. If you remain professionally skeptical, if you have that attitude of questioning mind, if you are being alert to unusual circumstances, you can reduce the risk of overlooking unusual circumstances, you can reduce the risk of overgeneralizing while taking the conclusions, and you will also reduce the risk of taking inappropriate decisions regarding the nature, timing and extent of the audit procedures. Okay, now what do you mean by critical assessment of audit evidence? Critical assessment of audit evidence means that you are critically analyzing the audit evidence. Sir, how can you analyze the audit evidence? How can you critically, in-depth analysis of audit evidence? How can you critically analyze the audit evidence? Nothing but I will verify whether the evidence is obtained from reliable source or not. I will see whether the evidence has been obtained from reliable source or not. Is it reliable or not? Right? And also I will see whether the evidence is sufficient. Sufficiency of audit evidence means what? Quantity of the audit evidence. Whether whatever evidence that I have obtained, is it sufficient? Is the quantity of audit evidence sufficient? For example, there are 1 lakh purchase transactions. I have verified only 100 transactions. Is it sufficient or not? That decision that you can critically analyze. Or am I required to obtain more evidences? Right? So critical assessment of audit evidence means what? Analyzing, is evidence obtained from reliable source or not? Is evidence obtained is sufficient or not? Is evidence obtained is appropriate or not? The evidence which I have obtained is qualitative or not? Or is there any requirement of additional or alternative evidence? Is there any requirement of additional or alternative evidence? So this is nothing but critical assessment of audit evidence. Okay, so this is regarding the professional skepticism. So professional skepticism involves 3 things: attitude of questioning mind. So if you observe here, attitude of questioning mind, being alert to unusual circumstances. One second. Being alert to unusual circumstances and critical assessment of the audit evidence. Right? For what situations the auditor should remain alert? Right? So for what situations he should remain alert? Conflicts between multiple audit evidences, doubts as to reliability of audit evidence, and situations of the possible fraud. And by maintaining professional skepticism, what risk you can reduce? Overlooking, overgeneralizing, and also taking inappropriate decisions. All this risk you can reduce. And what do you mean by critical assessment of audit evidence? It involves analyzing whether evidence is obtained from a reliable source or not. Is the evidence obtained sufficient? Is the evidence obtained appropriate? And also is there any requirement of additional or alternative evidence? Okay, so recently asked a question in the examinations, and it is also there in RTPs and MTPs. Right? Nothing but skeptical means that you should have a questioning mind attitude. You should not accept blindly anything. You should have a questioning mind. Now, next question. So, one more important quality which an auditor should possess is the quality of the professional judgment. So, one more quality which an auditor should possess is professional judgment. What do you mean by this professional judgment? Professional judgment means that whatever the decisions that you are taking, that should be dependent upon your knowledge, that should be dependent upon your training, and that should be dependent upon your experience. Right? So you should not take decisions just in a fluke. You should not take decisions as ever you require. So you should not take decisions which comes to your mind. Your decision should be supported by your knowledge, your training, and your experience. So we say that judgments as a professional. We say that quality of decision making as a professional judgment. So what does that mean? Auditor should possess an important quality of professional judgment. What does that mean? Whatever the decisions that the auditor is taking, he should be able to take by using his knowledge, experience, and training. right? And while taking these decisions, auditor will also use assumptions. Like the management, while they make use of assumptions while preparing the financial statements. Similarly, auditor also, while taking the decisions during the course of the audit, he will also take a lot of assumptions. Okay, so that is professional judgment. So meaning, it refers to the taking decisions by the auditor during the course of his audit by using his knowledge, training and experience. The auditor's decision should be based upon knowledge, training and experience of the auditor. He should not take a decision whatever come to his mind, or he should not take a decision by tossing a coin. If heads comes, I will perform this procedure. If tails comes, I will perform this procedure, like that. He should not take a chance. Whatever the decision he is taking, he should be able to take by using his knowledge, experience and training. And judgment includes assumptions and estimates made by the management also, well, made by the auditor also, sorry. So auditor also, while taking the decisions during the course of the audit, he will use a lot of assumptions and judgments, assumptions and estimates. And the auditor should maintain this professional judgment quality throughout the audit, from the beginning of the audit till the ending of the audit, and also during the course of performing of the audit. At any stage, auditor is required to have this professional judgment. And the quality of professional judgment means the auditor's decisions should be based upon the knowledge, training and experience of the auditor. Okay, and this quality should be maintained at the time of planning, at the time of performing and at the time of conclusion of the audit also. And what are the various circumstances where auditor will take the where auditor will use the judgment? So here they are giving you some examples. Materiality and audit risk in deciding which item is material, right? And also what should be the risk of the auditor. In this area, auditor will use the professional judgment. And also nature, timing and extent of the audit procedures. What are the audit procedures that the auditor has to perform? What should be the timing of the audit procedures? How depth audit procedures should be performed? Regarding this also, auditor will use professional judgment. Next, evaluating whether sufficient appropriate audit evidence has been obtained or not. Similarly, in evaluating whether the auditor has obtained sufficient and appropriate audit evidence or not, for deciding that also, auditor is going to use professional judgment. And also, while drawing up the conclusions based on the audit evidence obtained. See, if you obtain audit evidence, that will not be enough. On the basis of audit evidence, you have to make the conclusions. Right, so at the time of deriving the conclusions from the audit evidence obtained also, auditor is going to use his professional judgment. That means whatever the conclusions that he is arriving at, he will arrive at the conclusions by using his knowledge, training and experience. He will not take the decisions whatever comes to his mind, or he will not use the luck like tossing of a coin, like that he will not take the decisions. This is the quality of professional judgment. Right, so all these concepts till now, till this question number 12, whatever we have discussed, that is completely taken from essay 200. Whatever the questions that we have discussed till question number 12, that have been taken completely from the essay 200 only. Okay, so I think in between I have left out the question which is relating to the threats of the auditors, threats to independence, that I will discuss along with the company audit. And I think two more questions are left out, like scope and principal aspects. I think those are points wise. So let us see that also once. Question number 3 and question number 4, scope and principal aspects. See, that actually doesn't make any sense in revising. Those are nothing but point wise only. So anyway, let us read that also once again. Sorry, I have not discussed still inherent limitations also. Right. So let us discuss the inherent limitations. We are left with the one more question, sorry. So inherent limitations now. Right. Okay. Now let us take some example. For example, there is a Reliance company. Right. The Reliance company's turnover is some 6,50,000 crore, 6,60,000 plus crores. Right. So this is the extent of turnover of a Reliance company, 6,50,000 crores of turnover. Okay, you can imagine how many number of transactions will be there. How many number of transactions will be there? Some crores of transactions will be there. Or take the example of Avenue Supermarts, D-Marts. You can come to know there will be how many D-Mart stores are there across India. Somewhere close to 200 D-Mart stores are there across the India. Right. So all these stores will work for 365 days a day, 365 days every year. And some every day some thousands of customers will go, and each customer will buy some tens of items. So you can imagine how many crores of sales transactions will be there for the DMart annually, some crores of transactions. And you are appointed as an auditor of this Reliance company or this Avenue Supermarts. Now let me ask you a simple question. You are appointed as an auditor. Will you be able to verify 100% of the transactions? Will you be able to verify 100% of the transaction? Obviously cannot. It is impossible. Lot of difficulty involved, right? For example, take a simple example. So if you go to the Reliance company, if you go to their oil refining business or petroleum products business, they are having refineries across the India. They are having refineries. Okay. For example, they are having some 20,000 fixed assets. They are having 20,000 fixed assets. They have maintained a fixed asset register, right? So they are containing serial number, category of the asset, okay, name of the asset, location of the asset, where the asset is located, what is its actual cost, what is it depreciation, what is the actual cost, right, additional expenses if any, additional expenses, right, total capitalized value, what is the depreciation for the current year, accumulated depreciation, and what is the written down value. So like this, they are maintaining a fixed asset register. In this, it contains a serial number up to some 20,000. That means what? The Reliance company is having a total of 20,000 fixed assets. Now tell me, will you be able to verify each and every fixed asset physically? Will you be able to calculate whether the method of depreciation is appropriate? Is the actual cost correct? Is the depreciation percentage correct? Is the WDV correct? Will you be able to verify all these 20,000 fixed assets? Obviously cannot. So what you will do? Okay sir, I will not be able to verify 100% of the transactions. Okay, understood. Why I will not be able to do? Why it is impossible to verify 100% of the transactions? Why it will be impossible to verify 100% of the transactions? So now what is the alternative left for me? What I will do is, I will go for sampling. I will not verify 100% of the transactions. What I will do is, I will go for sampling. For example, I have selected this asset. I have selected one more asset. So some 10,000 asset I have taken, 15,000 asset I have taken. So totally I have taken 100 assets. Totally I have taken a sample of out of this 20,000 assets. I have randomly selected some 100 assets, and for those 100 assets I have calculated. For those 100 assets, I have seen where is the asset situated, what is the method of depreciation used, and I have verified the actual cost. I have seen the invoices, purchase bills. I have seen the method of depreciation. I have calculated the depreciation manually. I have calculated the WDV manually on my own using the calculator or Excel sheet. Then I compared with the WDV value which is there in the fixed rate register. So I have done this entire verification procedure for this 100 assets. I found no misstatement in this 100 assets. I found no mistake in the 100 assets which I have verified. Everything is correctly maintained as per the fixed asset register. I did not find even a single mistake. What I will think now? So since whatever the assets that I have verified, I will be generally I will not verify more number of assets. If I am in that situation, if I am an auditor, if I have taken 100 assets in my sample and all the 100 assets are not containing even a single misstatement, generally I would not like to verify more number of assets. So there is more risk averse auditor. So there is some other auditor who does not want to even risk. So he is not satisfied with 100 assets. What he wants to do is he wants to verify 100 more. So in addition to these assets, once again he has selected 100 more assets. So totally he has verified 200 assets. Now he is convinced. Now in that 200 assets also he did not find a misstatement. Now this 200 assets also he did not find any misstatement. Now he is convinced. Now he is of the opinion that out of the sample of the assets he has verified, he is not able to find even a single misstatement. So that's why he will conclude that all the misstatements may not contain misstatements. All the assets may not contain misstatements. He has concluded that. Is there anything wrong in this? Obviously no. Why? Because the standards on auditing also permits you to verify the transactions on sample basis. to verify the transactions of sample basis. Even the standards on auditing, even the regulatory provisions, even the statutory laws, they permit the auditor to carry out the audit on a sample basis, because 100% verification is not possible. Now tell me, you are out of this 20,000 assets, you are telling that I have verified 100% of the 100 assets. Out of this total 20,000 assets, you are telling that you have verified the 100 assets. That means you are indirectly telling that you have not verified 19,900 assets. As an auditor, you are telling that out of this 20,000 assets, I have verified 100 assets. That means you are telling that you have not verified 19,900 assets. There can be a misstatement in this 19,900 assets which you have not verified. There can be 19,900 assets which you are not verified. They can contain a misstatement. I am not telling there will be a misstatement. There is a possibility of misstatement in this 19,900 assets. But have you done any mistake here? As an auditor, by not verifying this 19,900 assets, did you do any mistake? I say I have not done mistake. Why? Because the standards on auditing, the statutory provisions, the laws, everything permit me to verify the transactions on a sampling basis. Where have I done a mistake? I have done properly only. I have verified sample. I did not find any mistake in the transactions which I have verified. How can you blame me if there are mistakes in the other transactions? I have not done any violation of my work. I have followed my work properly. I have done my work sincerely. I have followed the sample. Even the standards on auditing permitting me to verify the work on sampling basis. So I have followed it. Right? So that's why we say auditor will be able to obtain reasonable assurance. Auditor will be able to obtain reasonable assurance. Reasonable assurance means auditor's opinion is not 100% correct. Auditor's opinion is not 100% correct. There can be a possibility of auditor's opinion going wrong. Yes or no? Yes, there is always a possibility. But in such scenarios, can we make the auditor responsible? No. Why? Because there are some limitations to the audit. We say auditor only obtains a reasonable assurance. If you remember in the discussing the objectives of auditor as per SA 200, there I told you that the auditor will obtain reasonable assurance. I will come back to the reasonable assurance later. Now the time has come to discuss what do you mean by reasonable assurance. So reasonable assurance means auditor opinion cannot be taken as a guarantee. Auditor opinion is not 100% correct. There is a possibility that auditor's opinion may go wrong. Okay. So that meaning of the technical meaning of the term reasonable assurance is it is a high level of assurance. It is a high level of assurance but not absolute assurance. It is a high level of assurance but not absolute assurance. Absolute assurance means what? 100% correct. So here what do you mean by reasonable assurance? Reasonable assurance is a high level. That means this 20,000 assets, out of this 20,000 assets, if you verify 2 assets, is it a acceptable level of assurance? Are you convinced? By verifying, there are 20,000 assets total, you have just verified 2 assets calculations. Have you obtained convincing audit evidence? No. Right? You cannot go for a lower level of assurance. There should be high level of assurance. That means, okay, out of this 20,000 assets, I have verified 100 assets. Okay, I am assured. I am satisfied. I am convinced. So this is a reasonable assurance, means a high level of assurance, but not absolute assurance. Absolute assurance means 100% correct. Okay, auditor can never be 100% correct. He can have a high level of assurance only. High level means convincing assurance, acceptable assurance that you should have, but not 100% assurance. Okay, why the auditor can only have reasonable assurance? Why he cannot have absolute assurance? Why? Because there are some limitations to the audit. Why? Because there are some limitations to the audit, and these limitations are of such a nature that they cannot be avoided. They are unavoidable. They are unavoidable. So one thing we have seen, time constraint. We will not be able to verify 100% of the transactions. If we want to verify 100% of the transaction for Reliance company, we may require with 100 members of audit team 10 years of time to verify 100% of transaction. But we cannot give auditor 5 years of time to conduct a audit. So there is a time constraint. This is one of the limitation. And can this limitation be avoided? Can we give an auditor 5 years of time? No, we cannot. right? Or can an auditor expected to have a team of 20,000 members? We also cannot expect that. Right. So these are all nothing but limitations to the process of audit, and these limitations are of such a nature that they are unavoidable in nature. So we give these limitations a name as inherent limitations of audit. We give these limitations a name, we call them as inherent limitations of audit. Inherent limitations are those limitations which cannot be avoided. They will be present whatever you do. They will be present. We cannot eliminate them completely. We call such a limitations as inherent limitations. Because of these inherent limitations, auditor can only obtain reasonable assurance. Auditor cannot obtain absolute assurance. Because of this, auditor can reduce the audit risk but can never be reduced to zero. Auditor will always have some risk. This risk can be reduced only. Audit risk can never be reduced to zero. Why, sir? Why audit risk cannot be reduced to zero? Why? Because there are some limitations to an audit, and these limitations are of such a nature that they cannot be avoided. So that's why audit risk can never be reduced to zero. Auditor can never give a guarantee. Reasonable assurance only can be obtained. Absolute assurance cannot be obtained. These are all the reasons for that. These are all the limitations because of that. Okay. Now, these inherent limitations are broadly classified into three types: nature of financial reporting, nature of audit procedures, and time and cost constraints. These inherent limitations are broadly under three categories: nature of financial reporting, nature of audit procedures, and time and cost constraints. What do you mean by this nature of financial reporting? So nature of financial reporting means the management, while preparing the financial statements, they make lot of assumptions, as we have already seen, accounting estimates. So one of the area is depreciation, as we have already discussed. So management is estimating the useful life of air conditioner as 5 years. But what if the next year next year only a fire accident happens? Can we say management has wrong? No, right? Why? Because we will do estimation regarding some item only when we are not accurate, or regarding one item where we cannot be accurate. Yes or no? We call useful life of an asset as an estimate or assumption. Why do we call that? Because we cannot be accurate. How can we say for it up to what time an air conditioner will function? Are you an astrologer? No, right? So we cannot say. Since we cannot say, what we do? We make an estimate. We make a what? Estimate. So whenever you are using the estimates, that means there is always a possibility of that estimate or assumption going wrong or not. Assumption means something which is not accurate. No. In future anything can happen which make your assumption invalid. Example, you have taken a useful life of air conditioner as 5 years. Immediately after the next year there was a short circuit, entire machinery was burnt. Now, can you say your assumption is wrong? Assumption is wrong, but can you blame for making a wrong assumption? No, I don't know, boss. Next year there will be a fire accident. How can I know this year only? Understood? So, the process of preparation of financial statements involves usage of the assumptions. When you are making assumptions, then you are telling that financial statements may not be 100% accurate. Yes or no? You are making an assumption. Assumption is having a possibility of going wrong. That means there is a possibility that financial statements can go wrong. There is no 100% correctness even in the preparation of the financial statements. Then how the opinion expressed on that financial statements can be 100% accurate? Okay. For example, the company has used 5 years of depreciation, 5 years of useful life. In the first year, it has provided a depreciation of 1 lakh. In the next year, second year, there was a fire accident. It has recognized the entire 4 lakhs as an expenditure in the next year only. Why? Because there is a fire accident. Now, can the shareholder come and blame the auditor? See, the machinery was destroyed in 2 years only. First year depreciation should have been 2,50,000. The management has provided only 1 lakh depreciation. So, you have given a wrong opinion. Even though there is a misstatement, you did not give a correct opinion. Can the shareholder come and blame an auditor? Boss, it is not a mistake of the auditor. It is a mistake in the assumption only. And assumptions are prone to Assumptions are prone to differ. They can change. You can have no control. So same example, the company has bought machinery for 5 lakhs. They have considered useful life of 5 years. In year 1, the depreciation provided was 1 lakh. Second year, there was a fire accident, entire machinery destroyed. The company has recognized an expense of 4 lakhs next year. Now, one of the shareholder is coming and questioning, since the value of the machinery is 5 years and the used asset was destroyed after 2 years, first year depreciation should have been 2.5 lakhs, second year depreciation would have been 2.5 lakhs. The management has provided 1 lakh depreciation only, but still you have not modified your opinion. You are responsible for wrong opinion. How can you blame an auditor for that? Right? So because of these reasons, auditor cannot obtain absolute assurance. Auditor's opinion cannot be taken as 100% correct. Why? Because the process of preparation of the financial statements involves usage of the assumptions and estimates, and these assumptions can go wrong. Okay? So that is the nature of financial reporting. Right? So nature of financial reporting. The financial statements preparation involves many assumptions and judgments which may vary considerably from entity to entity. Hence, financial statements may get materially misstated because of this accounting estimates. So that is why one of the reason for that is one of the inherent limitations. Now, next come to the audit procedures. Sometimes because of the audit procedures also, auditor may not be able to give 100% guarantee. Why? Because there can be some legal and practical constraints. So what are the legal constraints? For example, you want to verify the inventory which is lying in the godown, right? So GST department has came and seized that godown. Will you be able to go and break that seal and go and verify the stock inside lying there? No, you cannot do it. There is a legal constraint. Whatever sealed by that government, you cannot open it unless by the government only. Right? Then what you will say? Then what you will do? Whatever the management has told as an inventory lying in that godown, you will take that only. You will not be able to go and verify. Why? Because there is a legal constraint. You cannot break the seal imposed by the GST department. There is a practical constraint. There is a legal constraint. You cannot verify the evidence. Sometimes there can be practical constraints also. For example, your godown was situated in one of the place in Assam. Suddenly there were floods. You are not able to travel to Assam and physically verify the inventory. Now what you will do? Whatever the management has told, sir, the stock lying in the godown is 10 crores, sir. This is the report. You will accept that. Why? Because you are not able to go and verify that because of the practical constraint. Okay, so because of this legal and practical constraints, sometimes auditor may not be able to obtain the required evidence. Then because of this non-availability of evidence, in future your opinion may go wrong. Okay, next, normal audit procedures may not be effective to detect the frauds which are sophisticatedly carried out. So if any fraud is carried out, fraud will be carried out by an intelligent person only. The person who has committed the fraud will not commit it in such a way that it will be easily identified. Yes or no? The person who is committing a fraud will not commit such fraud in such a way that it will be easily identified. He will take so many precautions. He may create false evidences. He can destroy the evidences so that it cannot be detected. So how good your audit procedures you do, you will not be able to detect those frauds which are sophisticatedly carried out, which are very carefully carried out. You cannot blame the auditor for not detecting such kind of frauds because the management has created so much of fake evidences or destroyed the evidences. So these normal audit procedures which you carry out, they may not be able to detect the frauds which are sophisticatedly carried out. And the nature of audit procedures is determined by auditor's professional judgment. And similarly, what the auditor procedures the auditor wants to use, they will be dependent upon the auditor's professional judgment. The audit procedure used by one auditor may not be same with the audit procedure used by the other auditor. It all purely depends upon the auditor's professional judgment. Some procedures may be able to detect some kind of evidence, whereas other kind of audit procedures may not be able to detect same kind of evidence. Right? So this is also one of the inherent limitation. Right? So we have covered two inherent limitations: nature of the financial reporting and nature of the audit procedures. Now, time and cost constraint, time and cost benefit comparison. See, one more thing. For example, you went to the audit, you went to the client. right? So the client has given 20 days of time for completing. You have 20 days of time for completing the audit. There are fixed assets, some 2000 fixed assets are there. You did not verify even a single asset. You did not verify even a single asset. Now subsequently, without verifying single asset, you have given an opinion, right? Actually, out of these 2000 assets, 200 assets are not there in existence only. 200 assets are fake assets. But you did not verify assets only. Completely you have ignored the assets. Now subsequently your opinion came wrong. Now the court called you, sir, you have conducted an audit of so and so company. In that company, out of 2000 assets, 200 assets are fictitious, sir. Why you are not able to rectify? The auditor is saying that, sir, he did not give me the enough fees, sir. He has given me 5 lakhs of fees only. So whatever I have done, that is more than enough, sir, with respect to the audit fees that he has given. So since he has not given audit fees, I have done only half work. Will the court agree to this argument? Or the auditor is telling, sir, I am having 20 days of time only. Out of these 20 days, I have to cover a lot of items. So I skipped the fixed assets, sir. There are 20 days of time. So I have to cover a lot of items. So I just simply skipped it. Can you say like that? No. Time and cost benefit comparison cannot be taken as a sole excuse for avoiding the audit procedure. You cannot use time and cost as a sole reason for avoiding or skipping the audit procedure. Within the time, within the benefit, within the cost, you should be able to plan procedures. You should do minimum things. You should do minimum things, right? For example, you went to a doctor, right? Doctor was doing an operation. The patient told that he will be able to pay 5 lakh rupees only. Will the doctor put half the stitches and leave the other half? There was a 10 inches cut. The doctor asked for 10 lakhs of fees. The patient is telling, no, sir, I will not be able to pay 10 lakhs. I will pay 5 lakh rupees only. Out of that 10 inches cut, the auditor has made a stitches for 5 inches only, and remaining 5 inches, he left it open. Is it acceptable? Similarly, for auditor also it is not acceptable. If you accept low fees, if you are having no time, you should be able to cover minimum. So I told there are 2000 items, you are not able to cover 2000 items, do minimum of at least verify 20 out of this. Okay, if you are telling, no sir, I don't have time, so that's why I did not verify fixed assets only. That is not acceptable, right? So within the time and within the cost, you should be able to do minimum procedures, right? You cannot completely skip the procedures, you cannot completely omit a procedure, or you cannot completely skip certain areas for which no alternative is possible. Okay, so this is what they are telling you here. Time, cost, benefit comparison. The auditor cannot escape saying time and cost as a reason for not obtaining sufficient appropriate audit evidence, even when there is no alternative. He cannot only use saying time and cost as a reason to escape. However, due to certain external factors, the audit shall be completed within a limited period of time. So, but the auditor cannot be given so much of time, and he cannot be given so much of fees. Within the time, within the cost, he should be able to plan his audit in such a manner that minimum efforts are done from his end, right? So unless the auditor properly plans and performs the audit, the objective cannot be achieved, right? So there is an interesting statement here. Actually, the question nowadays, the questions are being asked very much practically. They are using the sentences which are used as it is in the board material, right? So while preparing this material, we tried to simplify, but we tried to simplify in some areas, not all the areas, some complicated areas. But the questions are being asked in a statements, very complicated statements. Now let us see what he is telling. If you observe the first relevant question, the matter of difficulty, time or cost involved is not in itself is a valid basis for the auditor to omit an audit procedure for which there is no alternative, or to be satisfied with audit evidence that is less than persuasive. Persuasive means convincing. So if you read this sentence, you will not be able to understand. So let us break this sentence. What is he trying to tell? So what he is telling, the matter of difficulty, time and cost is not in itself a valid basis, is not a valid basis to omit a procedure, for which there is no alternative, or satisfy with the evidence which is less persuasive. persuasive. So this is a statement which he has given in the examination and he is asking you to explain. Nothing but let us see, like we have broken this sentence into parts. Let us analyze this sentence. So what he is telling, the matter of difficulty, time and cost. That means auditor is having very difficulty, or auditor is not having sufficient time, auditor is not able to bear this cost. He cannot use this reason as a valid basis. It is not a valid basis to omit a procedure for which there is no alternative. That means the auditor is telling that he is not having time and he is not able to bear the cost. For that, he did not verify entire fixed assets area. He omitted the entire audit procedure for which there is no alternative. He has omitted entire fixed assets from the scope of the audit. So can the auditor say non-availability of time and cost as a basis to omit an audit procedure for which there is no alternative? No, he cannot omit. And similarly, what he is telling, or the matter of difficulty, time and cost is not a valid basis for satisfying with the evidence which is less than persuasive. Persuasive means convincing. Convincing. For example, there are, take the example only that we have discussed. There are 20,000 assets. Out of this, auditor is verifying only 2 assets. Now when the court has asked, sir, why you verified 2 assets only? The auditor is telling, no sir, there is no time, no cost. Out of this 20 assets, if you verify 2 assets, will you be able to get convinced with this verification of 2 assets? If I am an auditor, I cannot. If I am an auditor, I cannot. Out of this 20,000 assets, if I verify 200 assets, okay, I will be convinced. But you have verified only 2 evidences, 2 assets, and you are telling that I am not having time and cost. That's why I verified only 2 assets. You are satisfying with the evidence which is very less convincing. You are satisfying with the evidence which is very less convincing. Can you, for obtaining very less convincing evidence, can you say difficulty, time and cost as a constraint? No. This is what he is telling you, the statement. So this same sentence we have simplified. This same sentence was simplified like this. The auditor cannot escape saying time and cost as a reason for obtaining sufficient and appropriate audit evidence even when there is no alternative. We have simplified the same sentence in simple English. But he used the same sentence which was there in the board material for asking the questions. Okay, so you should be able to understand the logic. Sometimes this question may be asked as a MCQ. What he will say is, which of the following statements is correct? First, he will give the one of the option, this sentence as it is. In one option, he will remove this word not. In other option, he will remove the word no, there is alternative. In some other option, he will remove something. Instead of less, he will say more than pervasive. Right? So like this, the questions are being asked. So here, by-hearting is not the solution. Here, you should be able to understand the context. You should be able to understand the concept. So if you get this concept, then you will be able to find out the correct answer. If you are not able to get the context, you will completely lost in that question. Nothing. He will say which of the following statements is correct. He will give one statement as it is, and in other statements what he will do, he will take out this no word. He will or in other option he will take this not, and in some other option he will take out both. So like this nowadays the questions are being asked. So that's why conceptual understanding is very much important. By-hearting will not help you in the examinations. In today's scenario, in today's pattern of asking questions in the examination, if you by-heart it, you will not be able to qualify. Okay, so don't by-heart it, try to understand the concept. If you are able to understand the concept, you will be able to answer any kind of question. Okay, so third kind of inherent limitation is time and cost constraints. There are other limitations like senior management fraud. If a fraud has been committed by senior management, that is also one of the inherent limitation. Or entity's ability to going concern. If the entity is not able to continue as a going concern, there also you will not be able to judge whether that going concern assumption is appropriate or not. That is also one of the limitation. And if there are so many related party transactions, you will not be able to get a true picture if there are a lot of related party transactions. Sometimes related party transactions may be introduced in order to give a wrong picture, in order to show the wrong turnover, in order to show the wrong profits. So whenever there are related party transactions, then also you will not be in a situation to obtain the complete evidence. Okay, so these are all the limitations. So broadly 3 limitations: nature of financial reporting, nature of audit procedures, time and cost benefit comparison, and other set of limitations like frauds involving senior management, going concern assumption, and related party transactions. Because of these inherent limitations, the auditor will obtain only reasonable assurance. He will not be in a position to obtain absolute assurance. And because of these limitations, the audit risk can never be reduced to zero. It can only be reduced to an acceptably low level. And these limitations also are of such a nature that they cannot be avoided. So that's why the name is given as inherent limitations. So we have discussed about what are the inherent limitations of the audit. So there are broadly 3 categories of inherent limitations: nature of financial reporting, nature of audit procedures, time and cost constraints, and other limitations. So these are the inherent limitations because of which auditor can only obtain reasonable assurance. He cannot obtain absolute assurance. And also because of these limitations, audit risk can never be reduced to zero. Right? These limitations are of such a nature that they are unavoidable. So that's why we call them as what? Inherent limitations. So in essay 200, in questions related to essay 200, we are only left with 2 more questions, question number 3 and question number 4. So those are actually these are nothing concept is involved there. It is just a points wise question. So let me revise that also once. So third question: write a short note on scope of the audit. What should be included in the scope? So as an auditor, you have to cover all the aspects which are related to the financial statements. You should not ignore any area, any aspect which is related to the financial statements. That should form part of your scope of audit. Next, you have to check the reliability of the source data. How can you check the reliability of the source data? It can be verified by evaluation of the accounting system and internal control system. So you can know whether the underlying data is reliable or not by verifying the accounting system and internal controls. You have to review the accounting softwares which they are using and what are the internal controls, and also you have to perform test checks. So you will come to know whether accounting systems are there or not, internal controls are there or not. Then you have to test check them also. A few of the sample you have to select and you have to verify those internal controls and accounting systems also. Next, you have to verify presentation and disclosures. That means whether whatever the information that is presented in the financial statements, whether it is as per the relevant statute or not, that you have to verify. How you can do that? You have to compare the financial statements with the accounting records. You have to compare financial statements with the underlying accounting records, and you have to consider whether the assumptions made by the management are reliable or not, or reasonable or not. Accounting estimates, the point which we have seen. And also you have to verify whether the accounting policies are selected correctly, and also the accounting policies that have been selected, whether they are applied consistently or not. Right? So selection and consistency of the accounting policies. Next, you should also see whatever the classification, presentation, disclosure which is there, that is appropriate or not, that is as per the applicable financial reporting framework or not. That also you have to see. What if there is a limitation on scope? That means management is not permitting you to carry out the work. Then what you are supposed to do? You can mention the same in the auditor's report. If there is some limitation which is imposed upon your scope, that is the management is not allowing the auditor to carry out his work properly, then what auditor can do? He can disclose the same in the auditor's report. Okay, so how it will be disclosed, we will come back to that later. Next, so once you are appointed as an auditor, are you required to perform technical duties also? For example, the company has appointed you as an auditor and they are asking you to give your opinion about the pending litigation in the court. Are you the person who possesses required expertise to comment on the litigations? No, you are not that person. You don't have the technical skills, right? So the person who is an expert in that is a lawyer, not a chartered accountant. So as an auditor, you are not required to perform the technical duties which are beyond the scope and competence. Okay, so this includes the scope of the auditor. It should cover all aspects. You have to check the reliability of the source data by comparing the accounting systems and internal controls, and also by doing the test checks. And also you have to verify whether the presentation disclosures are correct or not. This can be done by comparing the financial statements with the underlying records. You have to consider whether the accounting estimates are reasonable or not. You have to see whether the accounting policies are selected properly and applied consistently, and also classification, presentation and disclosure is appropriate or not. And if there is any limitation on scope, then the same can be communicated to the auditor's report, and whatever the technical duties are there that the auditor is not expected to perform, which are beyond his scope and also beyond his competence. Next, there are some principal aspects. This is also point wise, most of them which we already know, right? So I will go point by point. So that's all now. So first point, what should be the minimum principal aspects? What should be the basic aspects which you have to consider while doing the audit? First point, the auditor has to ascertain whether the accounting system and internal control system is matching with the size of the entity. So comparing with the size of the entity, whether the company is having adequate accounting system, adequate internal control system is there or not, that auditor has to verify. Next, examine the systems to identify the weakness. Not only he should evaluate this accounting and internal control system, he should do test check once and try to identify if there is any weakness. Okay. Next, he has to check the arithmetical accuracy. So nowadays it is redundant. Why? Because arithmetical accuracy we need not look into nowadays. Why? Because all the companies, all the entities, all the organizations are using the softwares only. So you need not be concerned about the arithmetical accuracy. But they have included, you have to verify the arithmetical accuracy of the transactions, and also you have to verify validity of the transactions. How can you verify whether a transaction is valid or not, whether a transaction is genuine or not? How you are going to verify? By comparing the entry with the supporting documents. Like for example, the company has recorded purchase entry in this purchase ledger. How can you verify that? How can you know whether the transaction is valid, whether the transaction is genuine? How can you get to know? By comparing with, by verifying by scrutinizing the underlying records. You will scrutinize whether there is an invoice for this or not, whether there is a purchase order for this or not, whether there is a transport bill for this or not. You have to verify the validity of the transactions also. Next, you should see whether the capital and revenue expenditure has been properly classified or not. As we have seen, for example, if any transport cost has been incurred for bringing the machinery to our premises, that cost should be capitalized, right? Can the company treat it as a revenue expenditure? Obviously cannot. So you have to see whether the capital and revenue expenditure is properly classified or not. Next, whether incomes and expenses are accounted in the proper financial year cutoff procedures. Right, you should also ensure that whatever the entries are there which requires to be recorded in a single year, that has been recorded in that year only or not. For example, what are the entries that have happened in the 18-19 financial year? It should be recorded in the 18-19 financial year only. No entry should be taken to the next year, and next year's entry should not be brought to the financial year 18-19. Right. So whether all those entries are properly recorded in the correct financial years or not, as an auditor you are required to verify. And you have to see whether the incomes and expenses are showing a true and fair view in the profit and loss. In the profit and loss account, whatever the incomes and expenses are shown, whether they are true and fair or not. Similarly, in the balance sheet, whatever the assets and liabilities are shown, whether they are true and fair or not. And also the auditor should verify whether the financial statements are in conformity with the books of accounts or not. So this is the basic point, right? So financial statements should always match with the books of accounts. Why? Because the source for preparation of the financial statements is nothing but books of accounts only. So whatever the financial statements that the management is preparing, that they should be matching with the books of accounts. Right. Next, what are other principal aspects now? Statutory compliances. As an auditor, you are required to see whether the entity is complying with the various laws and regulations or not. For example, if you are an entity, you are required to comply with the Income Tax Act. You are required to comply with the GST Act. If you are a company, you are required to comply with the Companies Act. If you are having so and so number of employees, you have to comply with the PF Act, Gratuity Act, ESI Act. So there are, and if you are having factory and there is certain number of workers, then you have to ensure the compliance with the Factories Act. Right. So all these laws and regulations are complied with or not. As a statutory auditor, you are required to verify it once. Next, finally, so you have done all these procedures, all the principal aspects you have covered. What is the ultimate thing? So everything on verification of each and every matter, what is your ultimate opinion that you have to express in the form of a report or not? And that report should be in the written format. And what should be the format, how the report should be prepared, it is mentioned under SA 700. So as per the requirements of SA 700, after carrying out all the above principal aspects, you have to prepare your audit report in accordance with the SA 700. In accordance with the SA 700. So these are the principal aspects and scope of the audit. Right. So with this we have completed SA 200 related questions. Now we will move on with the SA 210, SA 220. Right. So SA 210 discusses about engagement letters and SA 220 is a quality control standard. So there is one question. For example, you want to do some engagement, audit engagement, okay, engagement. So there is a new client, and for the new client, just give me a moment. For a new client, you are previously you are not aware of this client. Now the client has approached you and he is asking you to conduct an audit. Okay, so now you are doing an engagement for him. For a new client, you are doing a new engagement. Okay, so here you will accept. Here you will accept the engagement. Now there is already an existing client. There is already a existing client. That means we know this client. For the last year also, for some previous years also, we have conducted some audit for him. Some kind of engagement we have done. So existing client, existing engagement. Existing client, existing engagement. That means, so there is for the previous year, there is a company X Limited. For this company, Mr. A, for the financial year 18-19, he has conducted a statutory audit, company audit. So for the same client, for the same engagement, for 19-20 year also, he is only appointed. So we say existing client, existing engagement. Then auditor shall take a decision whether to continue or not. Then the auditor shall take a decision whether to continue or not. So in case of a new client, it is a new engagement, then the auditor shall take a decision whether to accept the engagement or not. Now when it comes to the existing client and it is an existing engagement, already previous year you have carried out some work, the same work for the current year also the client is asking you to continue. Now you will take a decision whether to continue the audit work or not. Now, so existing client, new engagement. For example, last year you have conducted for client X Limited statutory audit. This year he is coming to you and asking for doing the tax audit. Able to understand? Existing client only, X Limited. For the financial year 18-19, Mr. A conducted a statutory audit. For the same client for the year 19-20, the client is requesting you to do tax audit. So same client, new engagement. Here also you have to take a decision whether I can accept the engagement or not. Whether I can accept the engagement or not. So whenever you are doing some work, you have to take a decision whether to accept the engagement or to continue the engagement. Acceptance means for a new engagement, for a new work, for a new client, you are asked to do some kind of audit. Now you have to take a decision whether you can accept or not. For an existing client, existing engagement, you will take a decision whether I can continue with the audit work or not. Right? For an existing client and for a new engagement, you should make a decision whether I can accept it or not. Okay. So before accepting or continuing the engagement, before accepting or continuing the engagement, what are the points that an auditor should consider? What are the points that an auditor should consider? SA 220 tells you about 4 points which are required to be considered before accepting or continuing a client relationship. Before you take a decision whether to accept a client relationship or not, and before you take a decision whether to continue the client relationship or not, you have to consider some points. See, basically what we look at is money, fees, yes or no. So as an auditor, when we will accept the audit or continue the audit, when we want fees, when we are getting the required fees, yes or no. But you should not write that in the examination, right? We have to be professional, no. So we should not behave like that. So practically something happens, so practically what will happen, it will depend upon fees only, but you should not write the same thing in the answer, right? Your answer should be professional. So they will tell you some points as per SA 220. Before accepting or continuing client relationship, an auditor is required to consider 4 items. What are they? He has to consider integrity of the management, integrity of management and those charged with governance. So for whatever client you want to conduct an audit, whether the management of that management and those charged with governance of that client are honest people or not. If they are honest, you will accept. If they are not honest, that means they are always known for committing the frauds. They are always known for doing the mischievous things. Probably if I am an auditor, I will stay away from such client. Yes or no? So first thing what you have to consider is integrity of the management or those charged with governance. Next you have to consider whether as a you have enough resources or not. Whether you have enough resources to complete an audit or not. For example, I am a recently qualified chartered accountant. I am having an office with only 1 article assistant, no other staff, only 2 people in the office. So myself and my article assistant. So suddenly Reliance company came to my office and asked me to conduct an audit. Will I be able, even though they are willing to give an audit to me, will I be in a situation to complete the audit with the resources which I am having? Obviously cannot. So before accepting the engagement itself, you have to assess whether you are having enough engagement team competence to complete the audit, whether you have enough of resources with respect to time, human resources, whatever. Before accepting the audit only, you first make an assessment whether you are capable of completing the audit. You have to assess your own capability also, capability of finishing the audit. And also we have seen there are some ethical requirements, yes or no? So as an auditor, before you accept an engagement with the client, you have to see whether you are independent, whether you are having integrity or not, whether you can act objectively or not. So you should also see whether the ethical requirements are met or not. Are also required to see whether you are able to comply with the ethical requirements before accepting the engagement itself. So these three will be considered in the case of a new engagements, that is accepting, when taking decision regarding accepting. When it comes to continuance, one more additional point will be there. What is that? Significant matters which have arisen during the course of previous audit. Significant matters of previous years. For example, last year also you have only conducted the audit. Current year also the client is telling you to continue as an auditor. So before continuing, I will consider what are the significant matters that have arisen during the previous year audit. For example, last year I have found some mistakes and I asked the client to rectify, but he is taking no action. So generally in such cases, what I will do, I will step in as an auditor. Right? So in case of continuation, in addition to these 3 points, in addition to checking the integrity, in addition to assess the capability of completing the audit, in addition to checking the compliance with the ethical requirements, I will also see what are the significant matters which have arisen during the course of conduct of the previous year's audits. So SA 220 says that before accepting or continuing the client relationship, you have to consider 4 things. What are they? Integrity of the management and those charged with governance, resources, capability of you for completing the audit, ethical requirements, whether you are able to comply with the ethical requirements, and also significant matters which have arisen during the course of the previous audit. And also significant matters which have arisen during the course of the previous audits. Okay. So this is what they have given. Question number 13, mention any 4 points which assist the auditor in accepting and continuing a relationship with the client as per SA 220. In SA 220, these 4 points are given which an auditor has to consider before accepting or continuing any client relationship. Okay, next, one second. Yeah. Now let us discuss some provisions which are related to SA 210. Right. So in SA 210, they will tell you primarily about agreeing to the terms of the engagement. Right. For example, audit is also nothing but a business service. Yes or no? Audit is also nothing but a service. So as an auditor, I am providing my audit services to some client. Why I am going to provide audit services to the client? Why? Because I want revenue. By conducting the audit, I am going to receive the fees and I am going to provide services to the client. So it is nothing but a business contract between the auditor and the client. So generally in any kind of business agreements, business contracts, there will be a written agreement or not. For example, you want to construct a house, you are appointed one constructor for the purpose of construction of the building. So first thing what you will do is you will take out a stamp paper and you will write what is expected from the constructor, how many buildings he has to construct, what is the quality of the cement which he has to use, what company bricks which he has to use. Right? So what are his responsibilities, and also you will write at what duration you are going to pay the amount to the constructor. So for example, entire cost of construction of the building is some 30 lakhs. So it is 3 floors building. So I am telling that after completion of the first floor, I will pay him 10 lakhs. After completion of second floor, I will pay him another 10 lakhs. And after completion of the third floor, I will pay the balance amount. So whatever these terms and conditions between you and the constructor and the builder, what you will do, you will take out a stamp paper and write out everything. And both the parties will sign along with the witness. Right? So what is the purpose of this? So what is the purpose of this written agreement between you and the builder of the house? You want to avoid conflicts in the future. You want to avoid conflicts in the future. For example, the builder has constructed 3 floors, but you are telling I will pay only 28 lakhs. Builder is telling, no sir, you have agreed for 30 lakhs. No, I said only 28 lakhs. I did not say 30 lakhs. Right? Or constructor has used, you have asked him to use Ultratech cement. He used some other cement. When you go and ask the builder, hey, why did you use this cement? I have asked you to use other kind of cement. No. Constructor is telling, no, you did not tell anything about the usage of the cement. So like this in future, so many conflicts may arise. So in order to avoid that conflicts, what we will do? We will have a written agreement. Similarly, an audit is also kind of a provision of the business services to the client. Here also an agreement is required or not? Written document is required or not? That written document in audit terminology, we call it as letter of engagement. That written agreement between the auditor and the client, which contains the terms and conditions related to the audit, is known as a letter of engagement. And how this letter of engagement should be prepared, what should be the contents, that all are given under SA 210. Okay, so letter of engagement is a written letter which we sent by auditor to the client. Which is sent by auditor to the client. Please keep this point in mind. Auditor will send the letter of engagement to the client, not client will send the letter of engagement to the auditor. Okay, so the letter of engagement will always be sent by the auditor to the client, but not client to the auditor. Please keep this in mind. Auditor will send engagement letter to the client. They can test you in the true or false statements, or they can test you in the case of MCQs also. Okay, it has to be sent by auditor to the client. And what should be the contents of the engagement letter? So let us see. Right, so these are the contents of the engagement letter. Title, there should be title, there should be a heading, letter of engagement, there should be addressee, and there should be objective and scope of audit, a paragraph which contains what is the objective and what is the scope of the auditor, and the paragraph which contains the details of responsibilities of the auditor, and a paragraph which contains responsibilities of the management. You have to refer to a applicable financial reporting framework, whichever is applicable, and finally it should contain a signature of the auditor. It should also contain the signature of the client. When client signs, what does it mean? The client has agreed to the contents of the engagement letter, right? Date and place, and finally they should contain date and place also. So let us see one sample engagement letter, how an engagement letter will look like. So this is nothing but I have taken from the standard only, if you are able to see, right? See here what they are telling. So first there should be title. Right, there will be title engagement letter, then addressee to the board of directors of ABC Company Limited. Right, addressee is board of directors. Next there is a paragraph relating to objective and scope of audit. So in that what he is telling, you have requested that we audit the financial statements of ABC Company Limited, right, which comprise balance sheet, statement of profit and loss, cash flow statement, significant accounting policies, etc., etc. Our audit will be conducted with the objective of expressing the opinion. Our objective will be to express an opinion. So that is contained in the objective and scope of audit paragraph. Next, the responsibilities of the auditor. See what he is telling. Let us have one look. So what is mentioned in this paragraph, we will conduct our audit in accordance with the standards on auditing. He is telling that he will comply with the standards on auditing while conducting the audit, and these standards require us to comply with the ethical requirements, as that standard require the auditor to apply ethical requirements, and he will obtain reasonable assurance only, right? And he performs audit procedures, what else? Yeah, and one more thing, because of inherent limitations, there is an unavoidable risk that some material misstatements may not be detected, even though the audit is properly planned and performed in accordance with the standards on auditing. Right here, what he is telling, the management is the auditor can only obtain reasonable assurance. Why? Because there are inherent limitations. Because of these inherent limitations, there can be some misstatements which may not get detected. Okay, so that he is telling. Next, he is telling about risk assessment, etc. Next, responsibilities of the management paragraph. What is there in the responsibilities? What are the responsibilities of the management? First thing, they have to prepare the financial statements. Yes or no? They have to prepare the financial statements as per applicable financial reporting framework. Right? Next, they are responsible for designing and maintaining the internal controls. The management is also responsible for designing internal controls also, and also to provide the auditor with access to all the information, including books, accounts, vouchers and other documents. That means whatever the information which is required by the auditor. For example, if the auditor wants to examine the books of accounts, who is having the responsibility to provide that books of accounts? Management will be having the responsibility to provide that books of accounts. Additional information after verifying the books of accounts, if the auditor gets any doubt, who has to clarify that? Management is having the responsibility to clarify that. And also, if the auditor wants to inquire any person within the entity, within the organization, the auditor wants to question someone, right? The management should provide the auditor without any restriction access to the people within the entity, so that auditor can ask whatever information. Here, whatever information involves information which is useful for the audit, not personal informations. Okay, don't go and ask the personal information to the staff. Where is your address? What is your phone number? You should not ask these things. So you can have unrestricted access to the persons within the entity to collect information, to obtain inquiry for whatever information which is required for the audit. That's all. For that you can have unrestricted access. So all these rights, all these are rights of the auditor. These are the responsibilities of the management, right? And finally, there will be a signature of the auditor, right? So here for XYZ Enco Chartered Accountants firm registration number. So on behalf of the firm, a chartered accountant will sign. Next, it should also be signed by the company. So here board of directors, one of the board of directors will sign. Right. Next, date, place, etc. That's all. Okay. So this is how the engagement letter will look like. So practically speaking, this engagement letter is, practically speaking, do you think the management will be able to understand all these contents? The management will be able to understand all these contents. See, for example, if you go through this entire thing, even a practicing chartered accountant will not be able to understand clearly what it is, right? How can we expect a client to understand all these terms? So practically what happens, you know, we will send an engagement letter. So just we will copy this from the, we will copy this and paste it in a Word document, change the names of the company, change the names of the auditors and just give it to them. Or we will copy the engagement letter of the last year, copy paste, we will sign will be signed by the auditor, and we will send a copy to the management. So the management, from the management, a person will ask, sir, what is this? What I have to do? Sir, at the last page there will be a signature column, there you please sign and give it back. That's all. Okay, so practically speaking, this is just a formality. Most of the people will not understand what is the purpose also, and especially client will not understand what is mentioned in what is mentioned only. So those are related to the contents of the engagement letter. Okay, now, so these are the contents of the engagement letter. Next, there is a question relating to preconditions for an audit. So there is actually preconditions means nothing but management responsibilities only. What do you mean by preconditions? So there are some preconditions which are mentioned under SA 210. That means there should be some conditions which should be present before an auditor can start his audit. Okay, those are called as a preconditions. Other name for it is premise to audit. We call preconditions also as premise to audit, and we also call these preconditions as management responsibilities also. We also call it as management responsibilities also. So whatever may be the question, preconditions to audit or premise to audit or management responsibilities, the answer is same. What are that? Just now we have seen what are the management responsibilities in the engagement letter. What are they? The management is responsible for preparation of the financial statements, if you observe here, right? So preparation of the financial statements as per the applicable financial reporting framework, that is the responsibility of the management. And designing and implementing of the internal controls, the management is also responsible for designing and implementation of the necessary internal controls. And also the management should provide the auditor with access to the books of accounts, access to all the information like books of accounts, etc. and additional information. If the auditor requires any additional information for the purpose of the conduct of the audit, that additional information should also be provided by the management. And also unrestricted access to the persons within the entity from whom auditor can obtain the information. So these are the preconditions, nothing but responsibilities of the management. Next. So audits on the basis of appointment of auditor divided into two types: initial audit engagement and recurring audit. So initial audit engagement means for the first time for that client you are doing the audit. This is the first time you are working for that client. Recurring audit means what? Previous year's auditor is only appointed as a current year auditor also. Recurring audit means what? Previous year auditor is only appointed as auditor for the current year also. Whereas initial audit engagement means this is the first year for which you are conducting the audit of that client. Previously you don't know about that client, this is the first time you are working for the client. Whereas what do you mean by recurring audit? Last year auditor only continued as a current year auditor. We call such an audit as recurring audit. So in case of initial audit engagement, it is obvious that auditor is compulsorily required to send the engagement letter. Yes or no? In the case of initial audit engagement, since you are not having any previous connection with the auditor, you are compulsorily required to send the engagement letter in the case of initial audit engagement. Whereas in the case of recurring audit, is it required to send engagement letter each and every year? So what do you mean by recurring audit? Last year auditor is only appointed as a current year auditor also. For the last year you have only conducted the audit. Current year also you are only continuing as an auditor. Are you required to send the engagement letter each and every year? The standard says generally it is up to the auditor's judgment. The auditor will decide if it is a recurring engagement whether to send an engagement letter each and every year or not. That will be decided by the auditor on the basis of professional judgment. Okay, the standard tells you that in certain circumstances, even though it is a recurring audit, it is advisable to send the engagement letter. Even though last year auditor is only continuing as a current year auditor, still in some cases you are required to send the engagement letter, or else generally not required. Generally not required. Generally each and every year in case of recurring audit, engagement letter is not required. It is up to the decision of the auditor. But in some circumstances it is advisable to send the engagement letter every year even if it is a recurring audit. What are those circumstances? Let us see. So any indication that entity misunderstands the objective and scope of the audit. So you have already sent the engagement letter last year, but they have misunderstood it. So now send the engagement letter once again clarifying those misunderstandings. Next. Or a change in the legal or regulatory framework. For example, there is any change in the Companies Act which is impacting the financial statements. Send the engagement letter once again incorporating that amendments. Next, a change in the applicable financial reporting framework. Is there any, for example, there is some changes in the accounting standards, a new standard has been established, or there is some additional requirements under existing standards. So in such cases also incorporating those amendments, send an engagement letter once again. Or is there any change in the auditor's reporting requirements? Is there any changes in the standards on auditing? Then also send a new engagement letter. Or a recent change in the top management. For example, board of directors are replaced with a new board of directors. Then also send an engagement letter once again. And also a significant change in nature or size of the entity's business. If there is any change in the nature or size of the entity's business, then also send an engagement letter in case of recurring audits. Okay, so if there are no such circumstances, generally it is not required to send the engagement letter each and every year. But if there are certain circumstances, if there are these circumstances, misunderstanding, changes in the reporting framework, changes in the standards on auditing, then it is highly advisable to send the engagement letter even though if it is a recurring audit. Okay, next question. Right. So engagement letter, so you are appointed as an auditor of some company, you send an engagement letter, the client has agreed to the terms of the engagement also, right? So you have actually started the audit. Now the client is coming to you and asking for changes in the terms of engagement. Changes in terms. So originally you have sent an engagement letter containing all the terms and conditions. The client has accepted also. Now client is requesting you to change the terms of the engagement. He is asking you to change the terms. Now what you should do? So as an auditor, what you will do? First you will verify what is the reason for asking of the changes in the terms. For example, the client is coming and telling, sir, we cannot provide access to all the employees. Our employees don't want to talk with you, or so there are some employees who will intentionally provide the wrong information, sir. So that's why we don't want to provide unrestricted access to the employees within the entity. So like that, the client is coming to you and asking for the changes in the terms of the engagement. First thing what you will do is there a reasonable justification? So whatever changes they are asking, is there a reasonable justification for that? If there is a reasonable justification, what you will do? You will accept to the terms. You will accept to the changes in the terms. The client is coming and asking you to change in the terms of the engagement which were originally agreed. So what you will do, first thing, you will see whether there is a reasonable justification for that changes. If yes, you will accept. And once you have accepted, what you will do, the original engagement letter will be cancelled, and according to this change in the terms, you will draft a new engagement letter and get it signed by the client once again. Yes or no? Why? Because you have agreed to the changes in the terms of the engagement. So that's why old engagement letter becomes redundant. Now what you will do? So these changes which you have agreed, these changes you will incorporate in a new engagement letter, and you will send this engagement letter once again to the client, and the engagement letter will be accepted by the client, incorporating the changes. right? So new engagement letter will be drafted. So client has asked you to change the terms, but there is no reasonable justification. For example, you have got so many doubts in the purchases. When you go and ask the client, sir, I am having so many doubts, please provide me clarification. The client is telling, sir, please take purchases out of your scope. Please take purchases out of your scope. Please don't verify purchases. Right? Now, is there any reasonable justification for that? No reasonable justification. So, when there is no reasonable justification for changes in the terms, what you will do? I will not agree to the changes. Don't agree to the changes. If there is no reasonable justification, don't agree to the changes in the terms of the engagement. So you have not agreed. Why? Because management has not given you proper reasons, no justification, and the management is not cooperating with you. Since you have not agreed to the changes in the terms of engagement, management is not cooperating with you. If you ask whatever information, they are telling we don't have that, or that has been damaged, we will not be able to show. So they agreed for they requested for the changes in the terms. As an auditor, you did not accept, and management is not cooperating. Now what you can do? The standard says withdraw from the engagement, resign from the engagement. That's all. Withdraw from engagement when you have not agreed to the changes in the terms and the management is not cooperating or not allowing you to do the work as per originally agreed terms. Then what you have to do? You have to resign from the engagement. Okay. So this is what they will tell you here. What are the reasons for request? Because of what reasons the client may request for the changes? There can be change in the circumstances, or there can be misunderstanding of the terms originally understood, and also with a view to restrict the, sometimes with a view to restrict the scope, with a view to restrict the terms and conditions also, the client may request you to change the terms of the engagement. So what you should do? If there is a reasonable justification, he can accept. Right? So once you accept, the old engagement letter becomes redundant, and in that place new engagement letter has to be drafted and signed by the client and auditor. Non-acceptance of changes in the terms of the engagement. So if there is no reasonable justification, then he should not agree to the changes in the terms. And if if the auditor is unable to agree to the changes in the terms of the engagement and is not permitted by management to continue the audit, then what he has to do? Withdraw from the engagement. That's all. Okay. So these are the contents given under SA 210. One last concept is there, one small point is there. So for example, before accepting the audit only, client is imposing the restrictions on your work. So for example, you are sitting in your office, a client approached you and he is telling, sir, please conduct an audit for our company. You said, okay, sir. But he is telling, okay, sir, you are listening. He is telling that, sir, you have to do the audit, but you should not verify sales. You should not verify fixed assets. You should not verify inventories. So before the start of audit only, the client is putting the restrictions. Before you accept the audit itself, the client is imposing the restrictions. You came to know that before accepting the audit only, the client is putting a lot of limitations. Then what you can do? Don't accept the audit only. Don't accept the audit. Before acceptance only, you know that client is putting a lot of restrictions. Because of that, you will, even though if you accept, you will not be able to get evidence required. If you are not able to obtain sufficient and appropriate audit evidence, you will not be able to express opinion. So before acceptance of the audit only, you know that you will not be able to express an opinion. Then why to accept that engagement only? Do not accept itself. If before the acceptance of the engagement only, management is imposing the restrictions, then don't accept the engagement at all. Why? Because even though if you accept, what you are going to do? You will say that you will not be able to express the opinion. Why? Because there is a limitation. You will give a disclaimer of opinion. You know, before acceptance of the engagement only, you are going to give a disclaimer. That means what? Disclaimer of opinion means what? Not able to give an opinion. So before accepting the engagement only, you came to know that you will be not be able to give an opinion. Then why to accept the engagement? Don't accept at all. Okay. The same thing they are telling you here. Prior to the acceptance of the audit engagement, if there is a limitation imposed by the management on the rights and duties of the auditor shall not accept the engagement. If before acceptance only there are lot of limitations imposed by the management, don't accept at all. Because with the impose of limitations, the auditor cannot obtain sufficient and appropriate audit evidence and hence cannot obtain reasonable assurance and results in expression of disclaimer of opinion. Okay. So with this we have completed nature, objective and scope of the audit. Next we will start audit reporting revision. Okay. So now let us quickly revise company audit chapter also. Okay, right. So first of all, in company audit, we will start our discussion with section 141. Section 141, subsection 1, it tells about qualifications of the auditor. Subsection 2, it tells about signing of the auditor's report. Subsection 3, it tells about disqualifications, and subsection 4, it tells about subsequent disqualification. So first of all, 141 subsection 1, who is qualified to act as an auditor of the company? An individual who is a practicing chartered accountant. Individual who is a practicing chartered accountant, not just a chartered accountant, he should be a practicing chartered accountant. That means an individual who is a chartered accountant and also holding a certificate of practice. That person is eligible to act as an auditor of a company. If a firm is to be appointed as an auditor, here firm includes LLP also. Yes, firm or LLP can also be appointed as an auditor, provided what? Majority of the partners should be practicing in India. A firm or LLP can also be appointed as auditors of a company, provided what is the condition? Majority of the partners should be practicing in India. For example, there are 4 partners. Out of them, 2 partners are practicing chartered accountants, 2 partners are cost and management accountants. Can they be appointed as an auditor? Answer is no. Majority means what? More than 50%. Out of 4 partners, if 2 are chartered accountants, there is no majority practicing chartered accountants. Okay, majority means what? More than 50%. Okay, so qualification. Firm, if an individual practicing chartered accountant. Firm, majority of partners should be practicing chartered accountants. Who can sign the auditor's report? 141 subsection 2. If an individual is appointed, he only will sign the auditor's report. If a firm is appointed, who will sign? Only those partners who are practicing chartered accountants. They can only sign the auditor's report. Next, disqualifications. So let us cover fastly disqualifications. Right? So we will see here these are the persons who are not eligible to act as an auditors of the company. That means even though you are a practicing chartered accountant, if you attract any of the disqualification, you will not be eligible to act as an auditor of the company. What are the disqualifications? Let us cover point by point. First one, a body corporate other than an LLP cannot be appointed as an auditor of the company. So body corporate means what? Generally company, right? Including a foreign company. So a company or a foreign company cannot be appointed as an auditor of other company, right? But LLP is also a body corporate. Still LLP can be appointed as an auditor. Whereas other than LLP, if any body corporate is there, that cannot be appointed as an auditor of a company. Next, what is the second disqualification? Officer or employee of the company. A person who is an officer in a company or he is an employee in the company, the same person cannot be appointed as an auditor. Next, a person who is a partner or who is in employment of an officer or employee of the company. There is some person, he is actually a partner of officer or employee of the company, or he is an employee of officer or employee of the company. Such other person also cannot be appointed as an auditor. Okay, right. Next one, clause D. So clause D, it contains 3 subclauses. First one, what? Whether a person or his relative or his partner is holding any security or interest in the company, in the holding company, in the subsidiary company, in the associate company or subsidiary of such holding company. What do you mean by this? Group company. Able to understand? So if a person or his partner or his relative is holding any security in the company for which you are conducting the audit, if in its holding company or in subsidiary company, in its associate company or or even fellow subsidiary or co-subsidiary. So if you are holding any security in this group companies, either yourself or your relative or your partner, you cannot act as an auditor in this company. But there is an exception to this rule. What is the exception? The relative can hold the securities for a face value up to 1 lakh rupees. Only relative. The relative can hold shares in any of this group company for a face value. Here important term is face value, not market value, not purchase price. If the face value is less than 1 lakh, there is no disqualification. That too, for what purpose? Only for the relative. Only relative can hold the securities in the company or group company, not a partner, not the person. If they are holding even a single share, they will be disqualified. But a relative can hold shares for a face value not exceeding 1 lakh rupees. Next, second subclause. The person, his relative or his partner is indebted to the company or group companies. Same, right? If the person or his relative or his partner is indebted to the company or group companies for an amount exceeding 5 lakh rupees. If a person or his relative or his partner is indebted, is required to pay to the company some amount, and if the amount is more than 5 lakhs, then they will be disqualified. Okay, here auditor can receive the fees on progressive basis. Auditor can receive the fees on progressive basis, that is proportionately he can receive the audit fees even though the entire work was not completed. He cannot receive the fees on advance basis. If he receives the fees on advance basis, he will be said to be indebted. So there is a difference between progressive basis and advance basis. Advance is indebtedness, progressive basis is not indebtedness. One more point. It is immaterial. It is immaterial whether the credit period is given in the ordinary course of business or not. It is immaterial. Even though the credit was allowed to you like any other customer, still you will be disqualified. Once you are indebted, once you, your relative or your partner is indebted for an amount exceeding 5 lakh rupees, disqualification will get attracted. It is immaterial whether the credit period has been given in the ordinary course of business. Those are all not required to be considered. Okay, next. So third subclause, a person or his relative or his partner has provided any security or guarantee to the company or group companies for an amount exceeding 1 lakh rupees. Right? So if a person or his relative, person means here practicing chartered accountant, or his relative, partner means here business partner. So if they have given any security on behalf of some other person, they have provided any security or guarantee to the company or group companies for an amount exceeding how much? 1 lakh, then they will be disqualified. Okay, so this is clause D, very much important clause, most of the times asked in the examination. Okay, so a person, his relative is holding any security, that is first subclause, or is indebted to the company, second subclause, has given any guarantee. So some important points we have seen. The relative can hold the shares for a face value not exceeding 1 lakh. The auditor can receive the fees on progressive basis, and it is immaterial whether the credit period has been given in the ordinary course of business or not. Next, what is fifth subclause? If a person or a firm is having any business connection with the company or its group companies, here group companies in the case of clause E, it includes a subsidiary of the associate company also. Important. Right. So in the case of clause D, 141 subsection 3 clause D, here group companies means company, holding company, subsidiary company, associate company and subsidiary of the holding company. Subsidiary of holding company. Whereas for the purpose of clause E, that is 141 subsection 3 clause E, here the group company means company, holding company, subsidiary company, associate company, subsidiary of holding company and also subsidiary of associate company. So this small difference is there, please keep this in mind. Right. So what is clause E? A person or a firm, that is a practicing chartered accountant or his a firm, is having any business relationship with the company. If they are having any business relationship with the company or its group companies, what does here group company? One extra point, subsidiary of associate company also. So if they are having any other business relation other than this statutory audit, if they are having any other relationship with the client, they are disqualified. But there are some exceptions. That means some kind of business relationships are accepted. What are they? Professional services which are permitted by ICAI and Companies Act. So Companies Act and Chartered Accountants Act are permitting some professional services can be rendered in addition to the audit, like tax audit, GST audit, like that services you can render, no problem, no disqualification. Other one, transactions which are in the ordinary course of business of the company at the arm's length price. So if you are having a transaction in the ordinary course of business and at arm's length price, like sale of products, for example, you are having, you are appointed as an auditor of Airtel company. Then if you go by the blind law, if you go blindly by clause E, what does that mean? You should not have Airtel connection. Is it reasonable? No. So if you are a customer in the ordinary course of business, like any other customer, for example, you are appointed as an auditor of HUL. Does that mean you are not allowed to buy the soap of any HUL? Unreasonable, right? So you can have some transactions as a customer which are in the ordinary course of business and at the arm's length price. There should not be special discount given for you because you are an auditor. So like any other customer, you are also charged. That is in the ordinary course of business. You can have such a business transactions, right? So like airlines, hospitals, hotels, you can have an ordinary course of business, normal transactions. But one point you have to keep in mind here. So the company, the auditor is actually a customer in the ordinary course of business, right? So such kind of relationship he can have, no disqualification. But the auditor as a customer, he bought the goods from the company and that too on a credit basis, and the amount of indebtedness is more than 5 lakhs. Even though he is not disqualified under 141 subsection 3 clause E, he will get disqualified under 141 subsection 3 clause D. Clause D. Okay. So why? Because there what we have told, it is immaterial whether the credit period is given in ordinary course of business or not. In clause E, what we say, you can have a business connection. in the ordinary course of business. But if you are indebted in the ordinary course of business for an amount exceeding 5 lakhs, you will be disqualified. Okay, that is clause E and clause D, combined study of clause E and clause D. Next, a person whose relative is a director or is in employment of the company as a director or key manager person. For example, you are a practicing chartered accountant, your relative is working as a director in some company, or is some key manager person in another company. Can you be appointed as an auditor of that company? The answer is no. Next, a person who is in full-time employment elsewhere. So you are a practicing chartered accountant, you are a full-time employee elsewhere, you also cannot be appointed as an auditor of any other company. Next, a person or a partner of a firm holding appointment more than 20 company audits as on the date of proposed appointment. That means a person cannot hold more than 20 company audits at any time. The auditor at any time he can have only how many company audits in his name? Only 20 company audits in his name. If a firm of chartered accountants contains 2 partners, will the limit will be 20 or 40? The limit will be 40. If the audit firm is having 3 partners, how many company audits they can have? 60. If the company is having 4 partners, how many company audits they can have? 80. Okay, the limit of this 20 is calculated per partner. Okay, and while calculating these 20 companies, some companies will not be included. That means some companies will not come under the ceiling limit. So there are certain companies without any limit, we can conduct any number of audits. What are they? So let us see them also. Right. So the companies that are excluded from the ceiling limit, certain companies will not be included in ceiling limit. What are they? 1-person company, dormant company, small companies, and private limited companies having a paid up capital of less than 100 crores. So these companies will not be included in the ceiling limit. That means what? For these companies we can conduct any number of audits without any restriction. Okay, right. So this is regarding the ceiling limit. Next point of disqualification. Right. So we have covered F point, G point, H point also. Next, I. A person who has been convicted by a court of an offence involving a fraud and a period of 10 years has not elapsed from the date of such conviction. For example, if the auditor is convicted by a court involving a fraud, the auditor has committed some fraud colluding with the management and he was proven guilty by the court of law. The court has passed an order that so and so auditor has committed a fraud. From the date of that order till 10 years have been expired, you cannot act as an auditor of any company. You cannot act as an auditor of any company, not only in the company in which you have committed fraud, in any company you cannot be appointed as an auditor till 10 years have been elapsed from the date of order of the court. Next, J point. Any person whose subsidiary or associate firm or any other form of entity is engaged as on the date of appointment in providing services as specified under section 144. That means your firm or your associate firm or any of your partner is providing any services under section 144 to either the company or its subsidiary company or its holding company. So section 144 they have specified some 8 services. If you are providing statutory audit services to one company, you should not provide any of these 8 services, either these 8 services or statutory audit, any one of them. Able to understand? You should not provide, as a practicing chartered accountant, you should not provide. Any other associate or subsidiary firm, they also should not provide. And you should not provide to the company for which you are conducting audit, its holding company also you should not provide these services. To its subsidiary company also you should not provide this kind of 8 services which are specified under section 144. Now let us see what are the services which are specified under section 144. Okay. So what are the services? So accounting and bookkeeping services, internal audit services, design and implementation and maintenance of information systems, financial information systems, actuarial services, investment advisory services, investment banking services, outsourced financial services, or management services, any other kind of service if notified subsequently. Okay, next. So that is relating to the disqualifications. Next, what is 141 subsection 4? 141 subsection 4 says that at the time of appointment, if you find any disqualification, you should not be appointed at all. But at the time of appointment, there is no such a disqualification. But after you have been appointed as auditor of some company, any of the disqualification got attracted to you. At the time of appointment, no disqualification. But after your appointment, you have purchased shares in the company. That means what? Subsequent disqualification. At the time of appointment, there is no disqualification. But subsequently, auditor attracted any of the disqualification under 141 subsection 3. Now what has to be done? The Companies Act says vacate from the office immediately. Vacate from the office immediately. If the auditor attracts any of the disqualification subsequent to his appointment, what auditor is supposed to do? He has to vacate the office immediately. But there is one exception. That means what? In one scenario, in one subsequent disqualification, auditor need not vacate the office immediately. What is that? If your relative, after your appointment, he has purchased a shares for a face value more than 1 lakh, you have to take a rectification. You have to take an appropriate action within 60 days. If you are not able to take any appropriate action within 60 days, then after the expiry of that 60 days, you are required to vacate. So if after the appointment as an auditor, if any of the disqualification gets attracted, the auditor shall vacate the office immediately. But if there is one exception, that means what, auditor need not vacate the office immediately. In what case? So if your relative has acquired shares for a face value more than 1 lakh, then you need not vacate immediately. 60 days period will be given to you. Within that 60 days, you have to take appropriate action. That means what, you should convince your relative to reduce his shareholding. Within 60 days also you are not able to take an action, then you shall immediately vacate. Okay, this exception is available. This 60 days time limit is applicable only when your relative is holding the shares. For example, after your appointment as an auditor, you yourself buying a shares, then you have to vacate immediately. Okay, now next. Right. So how the auditor will be appointed? So let us see. So there are some companies which are required to constitute audit committee. There are some companies which are not required to constitute audit committee. So here we have given limits to what companies the audit committee is required to be constituted. I am not going through the limits, guys. You can please go through the limits. Okay. So I will not cover the limits once again. So you please go through the limits. So there are certain class of companies where audit committee is required to be constituted. There are some companies where audit committee is not required to be constituted. Let us see how the auditor will be selected. What is the procedure for selection of the auditor? Right. So selection of the auditor, how auditor will be selected? I will cover most of the questions in the form of chats only. Okay. So how the auditor should be selected? If the company is required to constitute an audit committee, first they will select the auditor on some appropriate basis and they will recommend the name of the auditor. To board of directors. If there is an audit committee, they will recommend the name of the auditor to the board of directors. They will select auditor on some appropriate basis and they will recommend the name to board of directors. Now two things can happen. Board of directors agree with the recommendations of the audit committee. Board of directors do not agree with the recommendations of the audit committee. If they agree, well and good, no problem. If they agree with the recommendations of the audit committee, if the board of directors agrees with the recommendations of audit committee, no problem at all. What they will do, they will recommend the same name to the members. And members will appoint the auditors in an AGM. Okay, as simple as that. Now, the problem actually arises when the board of directors do not agree with the recommendations of the audit committee. Audit committee has recommended some auditor, but the board of directors don't agree with that recommendation. Now, what has to be done, sir? Now, first the matter has to be referred back to the audit committee. The board of directors shall tell to the audit committee, sir, we are not okay with your recommendation. Please change your name. Now, two things can happen. Board of directors may change their recommendation. So I think they shall recommend the matter to the audit committee. Now, audit committee may do two things. What are the two things? The audit committee may change their recommendation. The audit committee, what they can do? They may change the recommendation. If they change the recommendation, no problem. Well and good. They will change the recommendation. They will communicate to the board of directors. If the board of directors agree, they will recommend the same name. Sometimes what audit committee will do is they will not change the recommendation. Audit committee will say, sir, we don't agree with your, board of directors are telling, sir, we don't agree with your recommendation. Audit committee is telling, no sir, that person is only the appropriate person. We will not change our recommendation. You have to recommend the same name to the members also. We are not going to change our recommendation. Audit committee is not agreeing to change the recommendations. Now what has to be done, sir? Now the act says that if the board of directors referred back the matter to the audit committee for change of recommendation, but they did not agree to change. Now what can happen? Now the act is telling that board of directors can recommend their own name irrespective of the recommendations made by the audit committee. Board of directors can recommend their own name. Board of directors can give the recommendation to the members irrespective of audit committee refusing to change the recommendation. They don't want them, so recommend other name. You decide other auditor, you recommend the name. Board of directors can only give the recommendation. Board of directors only can give the recommendation. And they can recommend the name to the members, but they have to state that we are disagreeing with the recommendations of the audit committees because of so and so reasons. They have to mention that fact. Okay. So, if the board of directors do not agree with the recommendations of the audit committee, first they shall refer back. If the audit committee do not want to change the recommendation, then what can be done? Board of directors can recommend the name of the auditor on their own to the members, and they have to tell the fact to the members that audit committee has recommended some other name and we have rejected the recommendation of audit committee because of so and so reasons. All this should be properly communicated to the members. Okay. So, this is the manner of selection. If the audit committee is not required to be constituted, no headache only. If the audit committee is not required to be constituted, then there is no issue at all. The board of directors only can select the auditor, they can only recommend the name. If the audit committee is constituted, then you have to follow this procedure. Okay. So this is the manner of selection. Right. So audit committee should consist of what members? Audit committee shall consist of minimum 3 directors, and majority of them should be able to read and understand the financial statements, and majority should be independent directors also. Next. What are the provisions relating to appointment of an auditor? Let us see. Provisions related to appointment of an auditor. So let us cover that quickly. Appointment of auditor. Now, so here we are going to discuss under 2 cases: government company, non-government company. Further, under government company, first auditor, subsequent auditor. Under non-government company also, first auditor, subsequent auditor. So I will explain entirely in the form of chat. Please follow. Right. First auditor of a government company has to be appointed by CAG within 60 days of incorporation or registration. Within 60 days. If they fail to appoint, see guys, I am not going to go in detail. It just contains of the time limits. I will quickly give it in the form of a chat. Okay. So in the case of first auditor of a government company, CAG has to appoint the auditor within 60 days. Then if they fail to appoint, board of directors within next 30 days. Within next 30 days at a board meeting. If they also fail to appoint, then members within next 60 days. Within next 60 days at an EGM, extraordinary general meeting. So this is the procedure for appointment of a first auditor of a government company. CAG within 60 days. If they fail to appoint, board of directors within next 30 days. If they also fail to appoint, members within next 30 days. Now, first auditor of a non-government company, he should be appointed by board of directors within 30 days of incorporation. Within 30 days of incorporation. If they fail to appoint, members within 90 days. Within how many days? Within next 90 days at an EGM. Okay. So this is the procedure for appointment of a first auditor of both government company and non-government company. Next. In case of subsequent auditor of a government company, so the appointment procedure should be, he should be appointed by CAG only within 180 days from the commencement of a financial year. Within how many days? Within 180 days from commencement of financial year. Right. So in case of a subsequent auditor of a non-government company, he shall be appointed at annual general meeting. He shall be appointed at annual general meeting. Okay. And he will hold the office till the conclusion of that AGM in which he is appointed. Till the conclusion of 6th AGM, his tenure will continue. In the case of subsequent auditor of a non-government company, the subsequent auditor of a non-government company will be appointed at an AGM, and his tenure will be from the AGM in which he is appointed till the conclusion of 6th AGM. So he will be there for 6 AGMs, but he will conduct the audit of 5 financial years only. Okay. So please keep this in mind. Next, one more thing. What is the tenure of these auditors? So the tenure of the first auditor of both government company and non-government company till the conclusion of first AGM. Till conclusion of first AGM. Here also. Till the conclusion of first AGM. Now in this case, in case of subsequent auditor of a government company, his tenure will be till the conclusion of next AGM. Till the conclusion of next AGM. Whereas what will be the tenure of the subsequent auditor of a non-government company from the AGM in which he is appointed till the conclusion of 6th AGM. He will be there for 6 AGMs, he will conduct an audit of 5 financial years. Please keep this in mind. Now, next part. So this is relating to the procedure for appointment. So everything I have given in the form of a chart. I will not go through that once again. Next. Next, the concept of casual vacancy. What do you mean by vacancy? Vacancy means auditor's office is vacant. What do you mean by casual vacancy? Vacancy in the office of the auditor by reason other than the expiry of the term. See, there can be so many reasons for the expiry of the vacancy in the auditor's office. One of the reason is expiry of the term. For example, first auditor of a non-government company till the conclusion of first AGM is over, his tenure is over. Then office will be vacant. Yes or no? There can be other reasons also for vacancy in the auditor's office, like death of the auditor, right? Inability of the auditor, resignation of the auditor, right? So what do you mean by casual vacancy now? Vacancy in the office of the auditor by reason other than the expiry of the term. Other than expiry of the term of the auditor, if by any reason auditor is vacating the office, If there is because of any other reason other than the expiry of the term, if there is a vacancy in the office of the auditor, then we say there is a casual vacancy. How that vacancy should be filled? How that vacancy should be filled? So that also discussed under Companies Act. Let us cover that also. That also I will tell you in the form of a chart. Okay. So casual vacancy. Casual vacancy. Guys, please have these charts. They will be very much essential for one day before the examination for preparation. So casual vacancy. So casual vacancy in the case of a government company. In the case of a government company, casual vacancy has to be filled by CAG. Casual vacancy has to be filled by CAG within 30 days. If they fail to appoint, if they fail, board of directors within next 30 days. Within next 30 days. Next. In case of a non-government company, in case of a non-government company who has to fill a casual vacancy, here they have divided it into two categories. Casual vacancy by reason other than resignation. By reason other than resignation. Casual vacancy caused in the office of non-government company by reason of resignation. By reason of resignation. If by reason other than resignation, then it has to be filled by board of directors within 30 days of vacancy. Board of directors within 30 days if other than resignation. In case of resignation, board of directors will fill within 30 days. In addition to that, it is required to be approved. It is required to be approved by members. It is required to be approved by members within 3 months. Required to be approved by members within how many months? Within 3 months. Okay. So board of directors only will appoint by reason of resignation or other than resignation. But in the case of resignation, in addition to appointment of auditors by the board of directors, it shall also be required to be approved by members at a general meeting within 3 months from the date of board meeting. Okay. So this is the manner of filling of the casual vacancy. Right. So you can observe here. So government company, very simple. CAG, if they fail to appoint board of directors. In case of non-government company, two cases, by reason of resignation, by reason other than resignation. What are the duties of the auditor in respect of the resignation? So there are generally duties of the auditor. What are the duties? First, he has to submit one form. So I will cover the form elsewhere. Okay. So let's just leave it as of now. I will cover it. I will cover the forms all once. In this chapter, we are going to come across 4 forms: ADT 1, ADT 2, ADT 3, and ADT 4. I am going to cover all at one place. Okay. Next. Provisions relating to rotation of auditor. What do you mean by this rotation? Right. So rotation means, so I will tell you the concept. Okay. So rotation is not applicable to each and every company. There is some applicability criteria for the rotation. Please go through this applicability criteria. I am not going to revise. What do you mean by rotation? If an individual practicing chartered accountant has been appointed as an auditor, he can be appointed for only one term of 5 consecutive years. If a firm of chartered accountants, irrespective of number of partners, have been appointed as auditor of the company, they can be appointed for not more than 2 terms of 5 consecutive years. That means 10 consecutive years a firm can be appointed. If an individual has to be appointed for one term of 5 consecutive years. Able to understand? If an individual is appointed as an auditor for one term of 5 consecutive years, he can be appointed. If a firm of chartered accountants have been appointed for 2 terms of 5 consecutive years, they can be appointed. After that, they cannot be appointed. That means what? They cannot be appointed for lifetime. No. After that expiry of one term of 5 consecutive years or 2 terms of 5 consecutive years, they have to undergo a cooling period of 5 years. After the expiry of, if a firm is appointed for 2 terms of 5 consecutive years, if they want to be reappointed again in the same company, they have to wait for a cooling period of 5 years. If an individual has been appointed as the auditor of a company, 5 years are over. If he wants to get reappointed in the same company, he has to undergo a cooling period of 5 years. Able to understand? So that is the concept of rotation. What is the manner of rotation? An individual cannot be appointed for more than one term of 5 consecutive years. A firm of auditors cannot be appointed for more than 2 terms of 5 consecutive years. Okay. And during this 5 years cooling period, there are some restrictions. So for example, there is a firm ABC and Co. They have been appointed as auditor. They have completed 10 years. After that, they want to appoint XYA and Co. Other firm of chartered accountants. In both of these firms, A is a common partner. So not only this firm, during this cooling period of 5 years, this firm also cannot be appointed. Able to understand? So if the incoming auditor and the outgoing auditor is having a common partner, then that incoming auditor also cannot be appointed under the cooling period of 5 years. And also firms operating under the same brand name or firms operating under the same network. If different audit firms are operating under the same network or under same brand name, during that cooling period, that firms which are operating under the same network also cannot be appointed for that cooling period. And also, if a person who is in charge of the firm and certifies the financial statements, he resigned from the firm and joined another firm, then also that other firm cannot be appointed for a cooling period of 5 years. These are the special points which are required to be kept in mind. So if there is a common partner and also if there is an incoming auditor, so all these points you can go through. I have summarized it, you can go through it once. Next, provisions for removal of auditor. How can you remove an auditor? Okay, let us see this. Right. So removal of auditor. How can an auditor be removed before the expiry of the term? How he can be removed? First, board of directors shall pass a board resolution, ordinary resolution only. Board of directors shall pass a ordinary resolution for removal of the auditor. Then they have to make an application to the central government. Then they have to make what? Application to the central government in form ADT2. In form ADT2. Within how many days? Within 30 days from the date of board resolution. Within 30 days of board resolution, the management of the company shall make an application to the central government. In what form? In form ADT2. Now, once the central government approval has been given, within 60 days of approval of central government, within 60 days of approval of central government, the general meeting should be held by the members, and in that general meeting special resolution has to be passed. So all these steps are required to be followed if you want to remove an auditor before the expiry of the term. If you want to remove an auditor before expiry of the term, all these conditions must be satisfied. If any one of the condition is missing, then you cannot remove the auditor. Okay. So they are telling you, first a board resolution shall be passed. Here ordinary resolution is enough. Board resolution, ordinary resolution. Then after getting board resolution, you have to make an application to the central government. In what form? In form ADT2. Next, the central government, if the central government gives approval, then within 60 days of getting the approval, the management of the company shall convene a general meeting. In that meeting, special resolution of the members shall be passed. Okay. And one more thing, before removing the auditor, an opportunity of being heard must be given to the auditor. Next. Right. So tribunal also can remove the auditor under certain circumstances. So in some cases, tribunal also can remove the auditor. Under what circumstances? Someone has to make the application, right? Who can make the application for removal of auditor to the tribunal? So the application can be made by tribunal on its own. The tribunal on its own can initiate the proceedings, or the application can be made by central government, or it can be made by any other person concerned. It could be member, creditor, or whoever. Anyone concerned by the company, they can make an application. Right. Application should be made to whom? Application should be obviously made to tribunal. Next, what is the procedure? So if the tribunal is satisfied that the auditor was involved in the fraud, auditor acted in a fraudulent manner or colluded with the management in the fraud, then it will pass the order for removing the auditor. If the tribunal is satisfied that the auditor has involved in the fraud, then it will pass an order. And one more condition, if the central government has made an application, then the tribunal must pass the order within 15 days. If the application has been made by the central government, the order must be passed by the tribunal within 15 days, and in that case, that vacancy can be filled by the central government only. When central government has made an application, if the central government has made an application to the tribunal for removing the auditor, then order should be passed by the tribunal within 15 days of this application, and in that case, central government can fill the vacancy. In all other cases, it will be case of a casual vacancy, and it will be filled as per the procedure which we have discussed earlier. Okay, so this is the procedure for removal of the auditor. And if you remember, in case of 141 subsection 3, that is disqualifications, there we have seen that if a court has passed an order stating that auditor has involved in a fraudulent manner from 10 years until 10 years have been elapsed, he cannot be appointed as an auditor of the company. While discussing disqualifications, we came across one point that if the court has passed an order that the auditor was involved in the fraud, he cannot be appointed as an auditor until 10 years have been elapsed. If the tribunal has passed the order, then the time limit is not 10 years, the time limit is 5 years. So two cases, if the order that the auditor is involved in the fraud is passed by the court, then until 10 years have been elapsed, he cannot act as an auditor. If the order that the auditor is involved in the fraud is passed by a tribunal, then he cannot be appointed as an auditor for a period of 5 years. Okay, so please keep this in mind. So next, so here, prohibition on further appointments. An auditor, whether individual or firm, against whom final order has been passed by the tribunal under this section, shall not be eligible to be appointed as an auditor of any company for a period of 5 years from the date of passing the order. If the order is passed by the court, then the prohibition shall be for the period of 10 years. Next, what are the powers of an auditor? Right. So let us see overview. What do you mean by what are the powers which are given to the auditor under the Companies Act? First one, right to access books of accounts. The auditor is going to verify books of accounts only, no? So the auditor should have an access to books of accounts. Here books of accounts doesn't mean only accounting records. The auditor can access even other records also, like minutes of the meeting, MIS reports, that records also he can access. And this right is available for the auditor is having such a right to access books at working days and business hours, not on Sundays and non-working hours. Okay, right. Next. So that is the first right. Second one, the auditor is also having right to obtain additional information also. In addition to the books of accounts, if the auditor needs any additional information, then the auditor is having right to obtain such additional information also. Next. So the auditor is also having right to receive notices of any general meeting, either extraordinary general meeting or annual general meeting for whatever year he has been appointed as an auditor. For that year, if any general meeting is happening, the auditor is having right to receive the notice of such general meeting, and he is also having right to attend that general meeting. The auditor is also having right to attend the general meeting. Whether the financial statements are discussed in that meeting or not, irrelevant. Auditor is having right to attend any general meeting, either EGM or AGM, but not board meetings. Okay, so he is having only right to attend meetings for general meetings only. Next, right to lien. So auditor is also having right to lien, but it is practically impossible for the auditor to exercise right of lien. Why? Because as per section 128, auditor is the company is required to maintain its books of accounts at the head office. Yes or no? It is registered office. So if the auditor wants to exercise right of lien, what he has to do? He has to take the books of accounts from the client's premises to the auditor's office, which is in violation of section 148. Yes or no? Sorry, 128. It is all violation of section 128 if you exercise right of lien on books of accounts. Even though the act has given you a right, it is practically impossible. Why? Because as per section 128, the books of accounts are required to be kept at the registered office, and also it will be unprofessional. If you as an auditor you say please pay the money and take your books, it sounds unprofessional, right? So that's why, because of this impracticability, because of these reasons, the auditor's right to exercise lien is highly impracticable. Okay, so these are the rights of the auditor. Next, what are the duties of the auditor? First one, the auditor is required to prepare a report. Yes or no? The auditor is required to make a report. On what and all he will prepare a report? On the financial statements he will prepare a report. On the accounts he is going to prepare a report. In that report, what he will state? Whether the profit and loss is giving a true and fair view or not, whether the balance sheet is giving a true and fair view or not, whether the cash flow statement is giving a true and fair view or not, he has to state in that report. That is the first duty. Second one, he is having a duty to sign the audit report. Yes or no? So if you give an audit report, that will not be enough. You have to sign the auditor's report also. Who can sign the auditor report? That we have seen under 141 subsection 2. Next, he is also having duty to comply with the auditing standards. Auditor, while conducting the audit, he has to comply with the auditing standards. This is mentioned under 143 subsection 9. Auditing standards are specified under 143 subsection 10. Okay, and also auditor is having a duty to attend the general meetings. It is not only the right of the auditor, it is also duty of the auditor to attend the general meeting. Whether AGM or AGM, the auditor is also having a duty to attend the general meetings. So it is both right and duty of the auditor to attend the general meetings. So these are the duties of the auditor. Next, reporting of the fraud. So if as an auditor, if you have identified any fraud, what and all you are required to communicate? What are your reporting responsibilities? So let us see. Right. Okay. So let us see the fraud reporting, which is mentioned under 143 subsection 12. So for the purpose of deciding what are the responsibilities of the auditor with regard to fraud, we will be classifying frauds into two categories. We will be classifying frauds into two categories. Fraud in which the amount involved is 1 crore or more. Another one, fraud in which the amount involved is less than a crore. The fraud in which the amount involved is less than crore. So there will be reporting responsibilities different under both the categories. Let us see. First, if the amount in the fraud involved is 1 crore or more, then what are the auditor's responsibilities? First, auditor shall communicate to the audit committee or board of directors within 2 days of his knowledge. Within 2 days of his knowledge, auditor is required to communicate to the audit committee or board of directors, and he should give them 45 days of time for giving the reply. He should give 45 days of time to seek their reply. Okay. Now, within 45 days, if they give a reply, within 45 days, if you receive the reply of the management, then within 15 days of receipt of reply, from the management, he has to communicate the matter to the central government in form ADT 4. In form ADT 4. Okay. So within 45 days, if the management does not give a reply, then also you are required to communicate to the central government. Here time limit was silent, but implied condition is 60 days from the date of communication to audit committee or board of directors. Okay. So the act is actually silent. So just remember these points. So let us cover them. So first, the manner of reporting. If the amount involved is more than 1 crore, what he has to do? The auditor shall report the matter to the board of directors or audit committee, as the case may be, within how many days? Within 2 days. And seek their reply within how many days? Within 45 days. Next. On receipt of reply from the management. So if the management has given reply or observation within 15 days, within 45 days, then what auditor has to do? He has to communicate the matter to the central government within 15 days of receipt of the reply. From the date on which he got the reply from the management, from that date, he has to communicate to the central government within 15 days. If the auditor fails to get any reply or observations within the stipulated time of 45 days, he shall forward his report to the central government along with a note containing the details of his report that was earlier forwarded to the board or the audit committee, for which he has not received any reply or observation. Okay. So if the auditor did not receive any reply, then also he is required to communicate to the central government and also state that I have not received any reply from the management. Next. The report shall be how he has to send the report. The report should be on the letterhead of the auditor. It should contain postal address of the auditor. It should contain what is the email of the auditor. It should contain the telephone number. It should also be signed by the auditor, and also stamp also should be affixed. Right? The seal also should be affixed. And the report shall be in the format ADT 4. Report shall be in what format? In form ADT 4. Next. What is the amount? What are the reporting responsibilities? If the amount involved in the fraud is less than 1 crore, what and all he has to report in that case? Then also within 2 days of his knowledge, he has to communicate the matter to audit committee or board of directors. What and all he has to communicate? He has to communicate what is the nature of the fraud along with the description. What is the nature of the fraud and what is the description, how the fraud has happened. Then he has to give also what is the approximate amount involved in the fraud and also who are the parties involved. These and all he has to communicate to the management or audit committee within 2 days if the amount of fraud is less than 1 crore. Right. Then after that, what board has to do? The board of directors has to disclose the same information in the board's report. The following details of each of the fraud reported to the audit committee or board of directors shall be disclosed in the auditor's report. What and all they have to disclose? Same. The above 3 points. In addition to that, what are the remedial actions taken by the management? So the auditor has found out a fraud and communicated with the management. Now, what are the remedial actions that are taken by the management? That also management has to give a disclosure in the board's report. So these are the responsibilities. These are the reporting responsibilities of the auditor in respect of the fraud. Now, so I think we have covered joint audit separately. There was a question relating to internal audit, I think. So branch audit also we have covered. So branch audit, the accounts of the branch, who can audit? The accounts of the branch can be audited by company auditor himself, or another chartered accountant also can audit the branch accounts. If the branch is situated outside India, then either the company auditor can conduct an audit, another chartered accountant can conduct an audit, or any other person who is qualified to act as an auditor as per the local laws. For example, there is an Indian company, one of the branches situated in the US, the company wants to have the accounts of the branch audited. That branch can be audited either by the company auditor himself or by another chartered accountant practicing in India, or that branch can also be audited by local chartered accountant. Locally in USA also there will be some profession which is equivalent to CA or not. In US it is CPA, in UK it is ACCA. So as per the local laws of that country where the branch is situated, whoever is eligible to act as an auditor, that same person can conduct the audit of the branch also, right? So who can be appointed as branch auditor? The auditor appointed for the company, that is principal auditor, or any other chartered accountant holding certificate of practice, or where the branch office is situated in a country outside India. The accounts of the branch office shall be audited either by the company auditor or by an accountant. Here accountant means any other chartered accountant holding certificate of practice, or by any other person duly qualified to act as an auditor of the accounts of the branch office in accordance with the laws of the country where the branch is situated. Who can appoint the branch auditors? Generally, branch auditors also will be appointed by the members, but however, the members can delegate the authority to the board of directors. They can give the right to the board of directors to conduct they can give the right to the board of directors to appoint the branch auditor. Right, next. What are the reporting requirements? The reporting requirements of the branch auditor are very much similar to principal auditor. He is also required to report under 140 subsection 1, 140 subsection 11, CARO, everything will be applicable to the branch auditor also. And the branch auditor will submit a report to the company auditor, principal auditor. Next. There is a question relating to internal audit. I think we have discussed internal audit under SA 610, but as per the Companies Act. So for some companies, appointment of an internal auditor is mandatory. So here they have given the applicability criteria. Please go through it once. Okay. Next, who can act as an internal auditor as per Companies Act? The internal auditor can be chartered accountant, whether a practice or not. Whether a practicing chartered accountant or not, any chartered accountant can act as an auditor. Even a cost accountant, whether in practice or not, he can also be appointed as an internal auditor. Or any other professional which is recognized by the board. Not only chartered accountant and cost accountant, any other profession which the board may decide, yes, it is okay. Such other professionals also can be appointed. And internal auditor may or may not be an employee. Sometimes your employee alone, your employee himself can act as an internal auditor. Such a flexibility is there in the case of internal audit. Who will decide the objective and scope of internal audit? Objective and scope of internal auditor will be decided by the board of directors. Okay, there will not be any specified law which decides your scope. Next, independence. So they will tell you some independence requirements relating to internal auditor. See, so generally when we compare internal auditor and statutory auditor, who will be more independent? Obviously statutory auditor, right? So next, internal auditor can be an employee, can also be an outside consultant, right? Who will be more independent, employee or outside consultant? Obviously outside consultant will be more independent than the employee. So like that, some independence related matters they will tell you, you can go through that. Okay, right. Next, so I have told you that, so with this we have completed this chapter also, audit, company audit also, almost all everything we have covered, right? So I have told you that I am going to tell you about the 4 kinds of ADT forms in this chapter, which you have to remember, because they are having a, nowadays they are asking you in case of MCQs, regarding this ADT forms, they are asking you in the MCQs, so we will cover that. 4 ADT forms will be there, we will be covering that, right? So one summary I will give. Okay. So in under companies audit, there are 4 ADT forms: ADT 1, ADT 2, ADT 3 and ADT 4. Purpose. What is the purpose of ADT 1? Okay, please have this table ready so that it will be helpful for MCQs. ADT 1, what is the purpose? What is the purpose of ADT 1? Appointment of auditor. ADT 1 is appointment of auditor. What is the purpose of ADT 2? Removal of the auditor. Purpose of ADT 2 is removal of the auditor. What is ADT 3? Resignation of the auditor. Resignation of auditor. ADT 4, reporting of the fraud. Okay, next. There is some more extension to this. Now, who has to file it? It has to be filed by. It has to be filed by. Okay. ADT 1, it has to be filed by company. ADT 2, it is also required to be filed by company. ADT 3, it has to be filed by auditor regarding resignation. ADT 4 is also required to be filed by auditor. Okay, it has to be filled with whom you have to file. It has to be filled with. ADT 1, it has to be filled with ROC. Removal of auditors, it has to be filled with ROC. Sorry, it has to be filled with central government. Right. Now, coming to resignation, it has to be filled by auditor with ROC and also with the company and also with the CAG if government company, if auditor of a government company is resigning, if government company, right? ADT 4, this also required to be reported to central government. Okay, so this is filled by and filled with. Next, time limit. Let us see the time limit also. Within what time it has to be filled? Time limit, ADT 1 within 15 days from the audit committee. Okay, so these are the time limits within which you have to file. So you may have a confusion this. So how come this 60 days come? Let me explain that. So for example, if the fraud is more than 1 crore, what you will do? First you will give, first you will inform to the board of directors or audit committee within 2 days, right? After that you are going to give 45 days of time limit for the reply. After receiving the reply, you can take 15 days of time. So in total 45 plus 15, from the date of communicating the matter to the audit committee or board of directors, you are having 60 days of time. 45 days for the reply, 15 days for your sending the report. So within 60 days from the date of communicating the matter with the management or audit committee, you can send the ADT 4. So these are the 4 ADT forms which will be important from the MCQ point of view. Okay. So ADT 1, ADT 2, ADT 3 and ADT 4. Okay. Right. So with this we have completed entirely about the company audit chapter also. So I think I thought of telling you about independence, threats to independence. So in first chapter I have told you there are some threats to independence. So here only I will cover. There are generally 5 kinds of threats to the independence. There are 5 threats to independence which are identified by IFAC. What are they? Self-interest threats, self-review threats, familiarity threats. One second. So regarding threats, I did not tell you there. I thought that I'm going to tell you here. Right. Okay. So these are 5 kinds of threats to independence of the auditor. What are the 5 kinds of threats to independence? First one, self-interest threats. It occurs when the company, when the auditor is having a shares in the company. The auditor is having some financial interest in the company. So then he may not act independently. Such a kind of threat will be called as self-interest threat. Self-review threats. These threats means what? When the auditor's work is reviewed by himself. That will be called as self-review threats. For example, you are appointed as employee for some part of the year. Subsequently, you have quit the job and set up a practice. You are appointed as auditor of the same company. Then you are reviewing your own work. So there will be a threat to independence. Next, advocacy. That means you are supporting client's opinion on some reasonable basis. See, you are supporting the client's opinion without any reasonable basis in case of third-party disputes. For example, there is some pending litigation with the tax authority. They have appointed you for representing. You are supporting the client's opinion without any reasonable basis. Now, if the same person is appointed as auditor of the company, then he may not act independently. Such a kind of threat will be called as advocacy threats. That is auditor promoting the client's opinion without any reasonable basis. Next, familiarity threat. What do you mean by familiarity threat? Auditor is having some close association or relationship with the client, either directly or indirectly. If the auditor is having some relationship with the client, like your relative is a chief financial officer, your relative is a director. So such kind of threat will be called as familiarity. Intimidation. Intimidation means what? Here the client is preventing you from acting independently. He is threatening you. He is telling that he will kill you if you give a negative opinion. Right? So such a kind of there are broadly 5 categories of threats. So self-interest threats, self-review threats, advocacy threats, familiarity threats, and intimidation threats. With this, guys, with this RRB, so we will stop our RRB discussion here. So with the completion of this, we have almost covered 80% of the syllabus in RRB. So we have left out a few parts like audit in automated environment, bank audit, audit of financial statements, and audit of different types of entities. Guys, please understand, these concepts are not suitable for revision. So if we are revising these chapters, that means that we are discussing the chapters once again. Why? Because there is no much of a concept involved in these chapters, in these 4 chapters that we left out. They are all point wise. They will all contain. They will not involve any concept, guys. They will all be containing point-wise questions, and more than that, they are all related to common sense. Those chapters are more of common sense. Okay, so that's why we did not cover those 4 chapters as a part of our RRB discussion. So remaining all the chapters we have completed. This is very much, I hope you all got a better understanding, or you got a better overview of the chapters. It will be very helpful for your preparation, for your revision, right? So I hope you are all benefited from these classes. Thanks once again, right? Thanks for taking part in this, right? I hope you got what you want from this rapid revision batches. And one more thing, all the best for your examinations. Please take your preparation seriously. I hope you are. I wish you a success for all of you, those who are going through all these videos, and for all the and for all the students who are participating in the examinations. I heartfully wish you for your success. Okay, thank you everyone. Take care. Okay, now we have completed revising first chapter, nature, objective and scope of the audit. As we have told, we will keep the company audit at last. So now we will start revising audit reporting chapter. So in this chapter we are going to deal about 4 standards, right? So SS 700, SS 701, SS 705 and SS 706. These are 6 standards we are going to revise, along with CARO reporting requirements, CARO 2016, and there are some points under 143 subsection 1 and 143 subsection 3. This is what we are going to revise in this chapter. First of all, SA 700. SA 700 deals about forming an opinion and reporting on the financial statements. So in SA 700, they have told you the format. They have told you what should be the contents in the auditor's report. Let us see what are the contents in SA 700. So they have told you that there should be title. There should be first of all a title, and also there should be some addressee. So like that there should be opinion paragraph, basis for opinion paragraph. So in total they have given some 14 contents. So let us see them one by one. So SA 700 tells you what are the contents. So let us see the contents one by one. First content, what is that? So first they are telling you that there should be a title to the auditor's report. So obviously there should be a title. In case of a statutory audit, the title of the audit report should be Independent Auditor's Report. So if you are conducting an internal audit, the title of the report should be Internal Auditor's Report. If you are conducting a tax audit, the title should be Tax Auditor's Report. Whereas people are used to the word Independent Auditor for statutory audit. So the title that has to be used for conducting the statutory audit, the auditor's report should contain a title Independent Auditor's Report. So if you observe here, I am showing you the practically the audit report of one company, which is Infosys Limited. So let us see both at the same time. So first there should be title. If you observe here, there is a clear title. It says Independent Auditor's Report. The title is there clearly. Next, there should be addressee. There should be what? Addressee. The report should be addressed to someone. See, audit report is nothing but a letter by which auditor is communicating his opinion to the shareholders, right? So every letter should have some addressee. Similarly, audit report being a letter given by the auditor to the members, it should also contain an addressee. So in the case of statutory audit, the auditor will address to the members of the company. If you observe here, so the auditor has used that addressee as to the members of the Infosys Limited or to the shareholders of the Infosys Limited. Next, directly after giving the title or after giving the address, immediately to the point we should go to the opinion. The auditor, the ultimate objective of the auditor is to express an opinion. So directly, while in the opening paragraph only, the auditor should discuss about the opinion that he wants to give. Okay, so if you observe, opinion is the first paragraph in the auditor's report. If you observe, title and address are not paragraphs. So we cannot call this title and address as a paragraphs. Okay, so the first paragraph in the auditor's report is opinion. Okay, now let us see what are opinions. How many types of opinions are there? So auditors' opinions are broadly classified into two categories. What are they? Unmodified opinion and modified opinion. Unmodified opinion and modified opinion. So what do you mean by unmodified opinion? So unmodified opinion means the auditor has obtained sufficient and appropriate audit evidence and concludes that financial statements are free from material misstatements. Financial statements are free from material misstatements and they are prepared as per applicable financial reporting framework. When the auditor obtains, see, you are telling that unmodified opinion means whatever the financial statements which are prepared by the management, they are giving a true and fair view only. They doesn't require any kind of modification. Whatever the financial statements that the management of the entity have prepared, those are giving a true and fair view only. They do not contain misstatements. They are prepared as per applicable financial reporting framework. If the auditor concludes that, how the auditor can conclude whether the financial statements are free from material misstatements, whether they are prepared as per applicable financial reporting framework or not, how the auditor is going to conclude? Auditor will conclude only when he obtains sufficient and appropriate audit evidence. So when the auditor obtains sufficient and appropriate audit evidence and concludes that on the basis of that sufficient and appropriate evidence, if the auditor concludes that financial statements are free from material misstatements. That means financial statements do not contain misstatements, and also they are prepared as per applicable financial reporting framework. They follow Schedule 3, they follow accounting standards. If it is the bank, they follow Banking Regulation Act. If it is the insurance company, they follow Insurance Regulatory Development Act. If it is the electricity company, they follow the provisions of the Electricity Act. So if the auditor, on the basis of sufficient and appropriate audit evidence, he concludes these two things, that is the financial statements are free from misstatements and they are prepared as per applicable financial reporting framework, then he will give an unmodified opinion. By giving unmodified opinion, auditor wants to communicate that whatever the financial statements that are prepared by the management of the entity are giving true and fair view, do not require any modification. They are true and they are giving a true and fair view. So this unmodified opinion is also called as unqualified opinion. Qualification means remark. Unqualified means no remark. So this unmodified opinion is also called as unqualified opinion or clean or clear opinion. Clean opinion auditor is giving, clean sheet he is giving. He is telling there are no misstatements in the financial statements. Right? So this is broadly unmodified opinion. So now what do you mean by modified opinion, sir? So modified opinion will be discussed under SS 705. Modified, the different kinds of, so there are, the auditor wants to give a modified opinion. That means what? Whatever the financial statements that are prepared by the management of the entity, they require some modification. They are not giving a complete true and fair view, they require some modification. So then the auditor will give modified opinion. Right? So modified means it requires the financial statements which are prepared by the management requires some modification. So now auditor will express a modified opinion in two scenarios. Auditor will express modified opinion in two scenarios. When the auditor obtains sufficient and appropriate audit evidence. When the auditor obtains sufficient and appropriate audit evidence, and on the basis of that evidence, auditor concludes that financial statements are not free from material misstatements. Or not free from material misstatements. That means what? So the auditor has been appointed as auditor of a company. He is conducting the audit. He found a lot of evidence, and on that basis of that evidence he is concluding that financial statements are not free from material misstatements, or financial statements contains some material misstatements. Then auditor is going to give a modified opinion. And modified opinion is also given in a scenario when auditor is not able to obtain sufficient appropriate audit evidence, and he is not able to conclude whether the financial statements are free from material misstatements. So in two cases, auditor will give a modified opinion when sufficient and appropriate audit evidence is available. On the basis of that evidence, auditor is concluding that financial statements are not free from material misstatements, or the auditor is not able to obtain sufficient and appropriate audit evidence and he is not able to decide whether the financial statements are free from misstatements or not. He is not able to comment. He is not able to obtain evidence. In both these scenarios, auditor is going to give a modified opinion. Okay, so actually speaking, there are different types of modified opinion. SS 705 says the modified opinion can be categorized into two ways. Categorized into three ways, sorry. Right? What are they? Qualified opinion, adverse opinion, and disclaimer of opinion. Qualified opinion, adverse opinion, and disclaimer of opinion. What do you mean by this? So all these three are different kinds of modification only. All these three opinions will come under the broad category of modified opinion. Let us see when a qualified opinion will be appropriate, when an adverse opinion will be appropriate, when a disclaimer of opinion will be appropriate. So we will discuss this with the help of some examples. For example, assume this is a balance sheet of a company. It is having a fixed assets of 100 crores. Under current assets, it is having inventory of some 20 crores, receivables of some 30 crores, cash and cash equivalents of some 50 crores, totally 200 crores of assets. And at the liability side, it is having a share capital of some 30, reserves and surpluses of some 70, and current liabilities and non-current liabilities put together some 100, total 200. Assume this is a balance sheet of some company. So you are appointed as auditor of this company. So you are verifying all items. So fixed assets correct only, receivables correct only, everything no misstatement, cash no misstatement, share capital no misstatement, reserves and surplus no misstatement, or non-current liabilities also no misstatement. But in inventory, out of this inventory, some 5 crores of inventory was materially misstated. Some 5 crores of inventory, for example, or some 2 crores of inventory, right? For example, there was a inventory, right? So with NRV of 8 lakhs, cost as 10 lakhs. So they have to follow as per AS2 NRV or cost, whichever is lower. So they have to value at 8 lakhs. But what they have done is they have valued it at cost, that is 10 lakhs. They have shown it as a 10 crores. They have shown it as a valuation of the inventory, which is accordingly wrong. So I have calculated the NRV. They gave me the calculation of the NRV. I compared with the cost. So they have to show it at 8 crores. But what they have done is they have shown the inventory as 10 crores. I am having evidence also. I am having the calculation of the NRV with me also. But the management is not agreeing. They are showing it as 10 crores only. So there is a misstatement in inventory for a worth of 2 crores. Now tell me, will it be appropriate on the basis of this misstatement? Entire financial statements are wrong. Can I say like that? Can I say on the basis of this 2 crores of misstatement, can I say entire financial statements are giving a wrong picture? I cannot say, right? So what I will say, what can I say? I can say that the financial statements are giving a true and fair view only, except or subject to inventory. Subject to inventory which contains misstatement. Can I say like this or not? Except this inventory, all other items in the financial statements are giving a true and fair view only. Like this I can comment. Right? So here you are not telling completely negative. You are not telling completely positive also. You are telling the financial statements give a true and fair view, but there are certain exceptions. Right? So, and also see one more scenario. So qualified opinion, one more scenario. For example, right. So here the management is telling you that the cost of the inventory is 10 crores. Or take other example. There is an inventory worth of 5 crores. The cost of inventory was 5 crores. Now, when I ask the management, sir, what is the NRV for this? Management is telling, no, sir, we will not be able to calculate NRV. We will not be able to realize we will not be able to determine what is the realizable value, sir. Unless we sell this inventory, we will not be able to calculate the net realizable value. So, you don't know whether NRV is more than 5 crores or NRV is less than 5 crores, that you are not able to determine. Because you don't have evidence. Management is telling they are not in a situation to calculate the NRV. They are not in a situation to estimate the net realizable value of the inventory. So I don't know what is the NRV. If it is NRV is more than 5 crores, then no problem. Cost or NRV, whichever is lower, 5 crores valuation would have been correct. But what if the NRV is less than 5 crores? Then it cannot be valued at 5 crores. I have to reduce it. I have to value it at a lesser amount if NRV is less than cost. I am not able to decide whether this 5 crores of amount of inventory, valuation of inventory, whether it is correct or not. I am not able to conclude. Why? Because I don't have evidence. I don't know the NRV. Here I am not able to decide whether this inventory valuation is correct or not. Why? Because I don't have evidence regarding this matter. I am not able to conclude. Right? Here also what I will say, all other items are giving a true and fair view only except inventory, in which I am not able to determine whether it is correct or not. This is also a qualified opinion. Right? So qualified opinion will be given in 2 scenarios. So let me try to define it. So let me define this qualified opinion. So qualified opinion can be given in 2 scenarios. Qualified opinion can be given in 2 scenarios. What are they? The auditor has obtained sufficient and appropriate audit evidence, and on that basis he concludes that financial statements contain a misstatement. Financial statement contains misstatement. It is material only. It is material misstatement only, but not pervasive. It is material but not pervasive. That means what? Here the auditor found evidence that 2 crores there is a mistake in the financial statements. First example, inventory was cost was 2 lakhs, NRV was 8 crores, NRV was Sorry, NRV was 2 crores, cost was 10 crores. So whichever is lower. But the management has valued at cost of 2 crores. Here cost of 10 crores. So overvaluation of 2 crores. Here the auditor is having sufficient evidence that the financial statements contain a misstatement. It is material also, but it is not pervasive. What do you mean by this? Not pervasive. What do you mean by this? Not pervasive. Pervasive means, in simple terminology, it is not so big that it is affecting the entire picture shown by the financial statements. So now I am telling that there is a 2 crores misstatement out of 200 crores of total assets. It is a material only, but I cannot say this 2 crores mistake, because of this 2 crores entire picture shown by the financial statements is completely wrong. I cannot say. That is nothing but pervasive. Pervasive means so material that it affects the entire picture shown by the financial statements. So in my first example, there is evidence the management has overvalued the inventory by 2 crores and it is material misstatement, but it is not so material that entire picture shown by the financial statements is violated. So the auditor has obtained sufficient and appropriate audit evidence and concludes that financial statements contain a misstatement which is material but not pervasive. Then the auditor will give a qualified opinion. Now one more scenario. Auditor not able to obtain sufficient and appropriate audit evidence. Auditor not able to obtain sufficient and appropriate audit evidence. He is not able to obtain. Right? Auditor is not able to get what is the inventory NRV. Auditor is not in a position to get the valuation of the inventory. Auditor is not able to obtain sufficient and appropriate audit evidence, and the possible effect of undetected misstatements. The possible effect of undetected misstatements could be material but not pervasive. Could be material but not pervasive. Right? So what is that here they are telling? So auditor is not able to obtain sufficient appropriate audit evidence. If you observe here auditor is not able to obtain evidence, auditor is not able to get the NRV valuation correctly. So what he can do? Even though that inventory goes wrong, even though that entire 5 crores may go wrong, we are not able to detect, no. Right? So one second, let me go to that example. So here if you observe, the inventory is worth 5 crores. Regarding this 5 crores, the auditor is not able to obtain evidence whether this 5 crores is correct or not. Auditor is not able to detect a misstatement. So here there is an undetected misstatement. Even if this goes wrong, the possible effect, even if this misstatement, even if this undetected amount of 5 crores go wrong, the possible effect could be material only but not pervasive. It is material but not so big that it influences the entire position shown by the financial statements. It is not so big. So it is material but it is not pervasive, not so material that the entire picture shown by the financial statements is wrong. Right? So regarding such item, auditor is not able to obtain audit evidence, then also auditor is going to give a qualified opinion. Auditor is going to give a qualified opinion. So auditor has to give qualified opinion under 2 scenarios. When the auditor is able to obtain sufficient and appropriate audit evidence and concludes that financial statement contain a misstatement which is material but not pervasive. Whereas in second case, where sufficient and appropriate audit evidence is not available and the possible effect of that undetected misstatements can be material but not pervasive. Even though that 5 crores goes wrong, possible effect is only material but it is not so pervasive. So auditor will give qualified opinion under 2 scenarios. Now what about adverse opinion? So auditor will give adverse opinion in 1 scenario only. Adverse opinion means completely negative. You are telling entire picture shown by the financial statements is wrong. Don't believe in the financial statements. They are giving you a wrong picture. Like that if you want to tell. Right? So in such cases what you can do is adverse opinion. But in order to tell something as wrong completely, you require evidence or you don't require evidence. When you will say something is completely wrong, when I have evidence only, no. I will say something is completely wrong, don't believe in something, when I will say obviously when I have an evidence. So adverse opinion will be given under scenarios when the auditor is having sufficient and appropriate audit evidence available, and on the basis of that evidence auditor concludes that financial statements contain misstatement which is material and also pervasive. which is material and also pervasive. Right? So what do you mean by this? So let us go to our example. Here if you observe, so the auditor is not able, the auditor found some evidence, there is a misstatement of 10 crores in this, there is an inventory, there is a mistake of some 5 crores in this, in receivables there is a 3 crores misstatement, in cash there is a 2 crores misstatement, in share capital some misstatement, reserves and surplus some misstatement, non-current liability some misstatement, in every item there is a misstatement. So here you cannot say they are giving a true and fair, you accept this, accept this, accept this, you cannot say like that. What you will say completely, entire financial statements are giving a wrong picture. Right? So that way of opinion is known as adverse opinion. Adverse means something completely negative. Okay? So adverse opinion can be given in one scenario when the auditor is having a sufficient and appropriate audit evidence, and on the basis of that evidence auditor concludes that financial statements contain a misstatement which is material and also pervasive. Able to understand? Next, disclaimer of opinion. Auditor will give disclaimer means what? Preventing yourself from doing something. Disclaimer means what? You are not doing something, you are preventing yourself from doing something. Disclaimer of opinion means what? The auditor is preventing himself from giving an opinion. When auditor wants to give it, when auditor is giving a disclaimer of opinion, that means he wants to convey that he is not able to express an opinion on the financial statements. When the auditor gives a disclaimer of opinion, what does he wants to convey? He wants to convey that he is not able to express an opinion on the financial statements. So for example, take the same example here, the auditor is not able to obtain evidence in the fixed assets. Some items he is not able to obtain. In current assets also he is not able to obtain some evidence. In share capital he is not able to obtain evidence. Reserves and surpluses not able to obtain evidence. In so many items he is not able to obtain evidence. Then how can he express an opinion? How can he form an opinion at all if he is not able to obtain evidence regarding so many items? How can an auditor will be able to express an opinion when he has got no evidence regarding so many items? If he is not having evidence, how can he express an opinion? So in this case, what auditor will do? He will say that I am not able to express opinion on the financial statements. Why? Because I am not able to obtain sufficient and appropriate audit evidence. So I am disclaiming myself from giving an opinion. I will not be able to comment on this. I will not able to give the opinion on this set of financial statements because he is not able to obtain audit evidence. So now, what could be the definition of disclaimer of opinion? Disclaimer of opinion will be given in one scenario when sufficient and appropriate evidence not available. When sufficient and appropriate evidence not available, and the possible effect of undetected misstatements is material and also pervasive. Okay, so qualified opinion in two scenarios, adverse opinion in one scenario, disclaimer of opinion in one scenario. Okay, in order to give an adverse opinion, you should have sufficient and appropriate audit evidence is must. In case of disclaimer of opinion, if you want to give a disclaimer of opinion, you should not have sufficient and appropriate audit evidence. Can adverse and disclaimer of opinion both happen at the same time? No, they cannot happen both at the same time. Why? Because for giving an adverse opinion, sufficient and appropriate audit evidence is must, whereas for giving a disclaimer of opinion, you should not be having sufficient and appropriate audit evidence. Both cannot happen at the same time. Okay, so these are the types, these are the different kinds of modified opinion as per SA 705. So broadly, opinions are classified into two categories: qualified, unmodified opinion and modified opinion. Under modified opinion, and once again there are three more categories: qualified, adverse, disclaimer. All these three will form part of your modified opinion only. All these three will form part of your modified opinion only. So the same thing is given in the material in SA 705. Right, see here. So circumstances when a modification to the opinion is required, we have discussed in two cases: when auditor has obtained evidence and concludes that they are not free from material, financial statements are not free from material misstatements, And also, when the auditor unable to obtain sufficient and appropriate audit evidence and is not able to conclude whether the financial statements as a whole are free from material misstatements. That means the financial statements which are prepared by the management requires a modification. And what are different types of audit opinion? Qualified opinion. Right, the auditor will issue qualified opinion in two circumstances: when auditor is able to obtain sufficient and appropriate audit evidence and concludes that financial statements contain a misstatement which is material but not pervasive. Right. Second point, if the auditor is unable to obtain sufficient and appropriate audit evidence and concludes that the possible effect of undetected misstatements on financial statements, if any, could be material but not pervasive. If the auditor is unable to conclude, he is not able to obtain sufficient and appropriate audit evidence and is not able to decide whether the possible effect of the mistake and is concludes that the possible effect of misstatements could only be material but not pervasive. Next, adverse opinion. The auditor shall express an adverse opinion if he concludes based on sufficient and appropriate audit evidence. So, in order to give an adverse opinion, sufficient and appropriate audit evidence is must. And misstatement should be both material and also pervasive. The misstatement should not only be material, it should be material and also pervasive. Next, disclaimer of opinion. When the auditor will issue disclaimer of opinion, he is unable to obtain sufficient and appropriate audit evidence. If you observe here, the auditor is not able to obtain sufficient and appropriate audit evidence and concludes that the possible effect of undetected misstatements is both material and also pervasive. Now, what do you mean by pervasive? The term pervasive has been defined as, right. So, if a misstatement is not restricted to single item, it is not confined to single item, there are misstatements in so many items, then we say that misstatement as a pervasive misstatement. Or even though if it is confined, it represents a significant portion of the financial statements. For example, so here the misstatement is confined to only fixed assets only, but the amount of misstatement is complete 100 crores. Even though the misstatement is confined to single item, it represents a substantial portion of the financial statements. So, fixed assets contain only misstatement, but the amount of misstatement is 75 crores. Even though it is confined to a single item, it is representing a substantial portion of the financial statements. Then also we call it as a pervasive. And in relation to disclosure, it is fundamental to users' understanding. There are some disclosures in the financial statements which will be fundamental to the users' understanding of the financial statements. If in such disclosures the management has committed a mistake, then also we say that as a pervasive misstatement. Okay. So, the meaning of the term pervasive is if the misstatement is not confined to single item. So, see here, if it is not confined to specific elements, even so if they are confined, they represent a substantial portion of the financial statements. If it is not restricted to single item, or even though it is restricted, it is representing a substantial portion of the financial statements, and in relation to disclosures, they are fundamental to the user's understanding. So, if in disclosures which are fundamental to the user's understanding of financial statements, in respect of such disclosures, if the management has made any mistake in the financial statements, then also we call such a misstatement as a pervasive misstatement. Okay, so everything we try to summarize in the table, so you can go through this table, right. So, one more thing, if the misstatement is not material, then it cannot be pervasive also. If there is a misstatement but it is not material, you are not required to modify your opinion. Only if the misstatement is material, then only you are required to modify your opinion. And also if the misstatement is not material, then it will not be pervasive also. Okay, so everything we try to summarize in this table, you can go through this. Okay, so next, come back to the contents once again. Right, so we have seen title, we have seen addressee, and also we have seen opinion paragraph. We have also seen different kinds of opinion, and while discussing that, we have seen what are the different kinds of opinion. SA 705 also we have discussed. And if you observe here, so here they are telling you something. Opinion paragraph or auditor's opinion. That means in the opinion paragraph, you have to compulsorily include some items. What are they? You have to describe the financial statements of the entity under audit. That means you have to identify the entity whose financial statements you are conducting audit. That means you have to specify the name of the company in the opinion paragraph. Right? Entity. Next, title of the components of financial statements. That means balance sheet, cash flow statement, profit and loss. You have to mention the title of the financial statements also, and you should Period. You should also give reference to the period covered by the financial statements. For example, if you will prepare balance sheet as at 31st March. You will prepare balance sheet you will prepare profit and loss cash flow statement, notes to accounts for the year ended. Right? So like that you should mention the period also, and also you should give a reference to the notes to accounts also. In opinion paragraph, all these 4 items must be present. In this 4 paragraph, all these items must be present. In every opinion paragraph of a company, these items must be compulsorily included in the opinion paragraph. What are the name of the entity, title of the components, period covered by each of the item of the financial statement, and also reference to the notes. Let us see one practical example whether all of these are combined in it or not. So if you observe here, I am showing you the Infosys annual report. So please observe carefully whether all these are included in the opinion paragraph or not. So what is that they are telling you? We have audited the accompanying standalone financial statements of Infosys Limited. So they have identified the name for which they are conducting the audit, which comprise balance sheet. They are giving the title of the components of the financial statements: balance sheet, statement of profit and loss, statement of changes in equity, statement of cash flows, and summary of significant accounting policies. That means a reference to the notes. Right? Reference to the notes is also given. Significant accounting policies means nothing but notes to accounts only. And one more thing, period covered. So if you observe here what they are telling, balance sheet as at 31st March 2020, right? And also profit and loss statement account for the year ended. So they contain period covered also. If you observe 4 items which are mentioned in the standard to be compulsorily included in the opinion paragraph, that we are able to find it in the Infosys annual report. They have given the name of the entity, they have given the title of the financial statements, period covered by the financial statements. If you observe here March 31, 2020, so period covered by the financial statements is also there, and also reference to the notes to accounts is also there. And one more thing, when you are giving unmodified opinion, the title of the paragraph will be opinion only, but if you are modifying your opinion, the title of the paragraph also should change. That means here the auditor is giving unmodified opinion. If you observe here, in our opinion and to the best of our information, the aforesaid standalone financial statements required by the Companies Act, where is that? Right, true and fair view. Here they are telling you, if you observe here, true and fair view. Right. So what is that they are telling you here? The financial statements are giving a true and fair view. That means what? They are giving a unmodified opinion. So if you are giving unmodified opinion, the title of the paragraph need not be changed. It could remain opinion only. But if you want to give a qualified opinion, adverse opinion, or disclaimer of opinion, what you have to do? You have to change the title of this paragraph also. If you are giving qualified opinion, the title of the paragraph should be qualified opinion. If you are giving an adverse opinion, the title of the paragraph should be adverse opinion. If you are giving a disclaimer of opinion, the title of the paragraph should be disclaimer of opinion. Okay. So this is relating to the opinion paragraph. Now let us come to the next content. What is the next content? Basis for opinion. Now, okay, you have told the opinion, you have given the opinion, right? Why your opinion should be believed? You have conducted an audit, agreed, you have verified the financial statements, everything you have done. So you are giving an opinion as a shareholder or as a user of the financial statement. Why I should believe in your opinion? Why a user of the financial statement should believe in your opinion? You have to tell your basis. No. On what basis you are giving an opinion, you have to tell. Then only the user will rely. So you have to tell that, boss, I am an independent person. I am not associated with the entity. I have conducted an independent verification. I have to follow standards on auditing, and also I will not give opinion just like that. My opinion will be supported by sufficient and appropriate audit evidence. Right? I have taken all the precautions. I follow standards on auditing. I am independent. I comply with ethical requirements. Right? So all these things you have to explain. Then only the user will be able to understand then only the user will be able to rely on your opinion. If you don't explain them that you are undergoing all this, then the user also will not be believing your opinion. So that's why in order to make the user believe in your opinion, you have to tell the basis for your opinion. What is the basis on which you are giving the opinion? Why as a shareholder, why as a user of a financial statement, you can rely on my opinion? Why you can rely? You have to provide the basis for opinion, right? So one more thing, if you observe here in basis for opinion paragraph, 4 items must be presented. What are they? The auditor has to state that the audit has been conducted in accordance with the standards on auditing. He have to tell that we conduct the audit as per the standards on auditing. He has to tell. Next, he should tell that there will be one more paragraph which contains auditor's responsibilities. Please refer to that paragraph. That also auditor should mention. The auditor should include a statement indicating in brief auditor's responsibilities and reference to such paragraph. In the basis for opinion paragraph, you should also tell that we are having some responsibilities and these responsibilities are included in a separate paragraph in this report under the heading responsibilities of the auditor. So if you observe here, one of the content of the auditor's report is auditor's responsibilities for the audit of the financial statements. This is also one of the content of the auditor's report. So in this paragraph, auditor will tell what are the responsibilities of the auditor, right? So in the basis for opinion paragraph, you have to tell that we are having some responsibilities and these responsibilities are mentioned in the paragraph below under a heading auditor's responsibilities for the audit of financial statements. That also you should mention. And what else should be there in the basis for opinion? The auditor should state that he is complying with the ethical requirements. Right, ethical requirements we have seen: integrity, objectivity, independence. So auditor should also state that I am just not like that. I follow ethical requirements also. I follow code of ethics also. That's why you can believe in my opinion. He has to state that. And also he has to state that he will obtain sufficient and appropriate audit evidence. His opinion is based on sufficient and appropriate audit evidence. That also auditor should state. So in basis for opinion paragraph, there should be compulsorily 4 items which auditor should state. What are they? He has to state that they comply with the standards on auditing. There are auditor's responsibilities which are mentioned in the auditor responsibility paragraph. Auditor is complying with the ethical requirements. He has obtained sufficient and appropriate audit evidence. These 4 matters must be mentioned under basis for opinion paragraph. So let us see it once whether they are available in the Infosys audit report or not. So if you observe here, we conducted our audit in the, actually Deloitte is the auditors for Infosys company. So let us see what is the auditors telling in the basis for opinion paragraph. We conducted our audit of the standalone financial statements in accordance with the standards on auditing. First point, mentioned or not. So they have to tell that they follow standards on auditing. They are telling you the same. They are telling that they follow standards on auditing. Next, our responsibilities are further described in the auditor's responsibilities. So what these telling, they are having some more responsibilities. Those are mentioned in the paragraph. Those are described in the auditor's responsibility for the audit of the standalone financial statements. So second point is also done. Next, we are independent of the company in accordance with the code of ethics by ICAI together with the ethical requirements. They are also telling that they comply with the ethical requirements and they are acting independently. And what is the last point? They have to tell that they have obtained sufficient and appropriate audit evidence. See what they are telling. We believe that audit evidence obtained by is sufficient and appropriate. He is also telling that in our opinion we have obtained sufficient and appropriate audit evidence. So whatever we have seen, there should be 4 points that should be included in the basis for opinion paragraph. These 4 points are there in the basis for opinion paragraph exactly. Okay. So in case of normal opinion, unmodified opinion, it is enough if you present this information. You need not explain why you are giving unmodified opinion. See, when you are telling something good, you don't need reason. If you are telling something as good or something as perfect, you don't need reason. But whenever you are telling something in a negative sense, you are telling don't believe this financial statements contains wrong, don't believe in this opinion, don't believe in this financial statements. If you want to say something in a negative manner, you have to give the reasons. Here, auditor is giving unmodified opinion, so no issue. So you need not tell the reason why you are giving a unmodified opinion. But if you give a qualified opinion, in addition to these 4 matters, you are also required to tell the reason why you are giving a qualified opinion. You are also required to tell the reason why you are giving an adverse opinion. You are also required to tell the reason why you are giving a disclaimer of opinion. Able to understand? So if you give an unmodified opinion, just it will be more than enough if you add these 4 points. That's all. That is standards on auditing, auditor responsibilities, ethical requirements, sufficient and appropriate audit evidence. If you are giving an unmodified opinion, these 4 points are more than enough. If you are modifying your opinion, you are giving either qualified, you are giving either adverse, you are giving either disclaimer of opinion. In addition to these 4 points, you should also explain what is the reason for modification. Why you are giving a qualified opinion, why you are giving an adverse opinion, why you are giving a disclaimer of opinion. These matters also should be form part of your basis for opinion paragraph. Okay, so this is regarding the opinion paragraph and basis for opinion paragraph. And also, as I have told you that whenever you are modifying your opinion, the title of this opinion paragraph should change. Similarly, whenever you are modifying your opinion, the basis for opinion paragraph title also should change. Here auditor is giving opinion, unmodified opinion, so that's why no issue. Basis for opinion paragraph. So if the auditor gives a qualified adverse or disclaimer of opinion, then the title of this paragraph should be basis for qualified opinion, basis for adverse opinion, basis for disclaimer of opinion. Right? So whenever you are giving a qualified adverse or disclaimer of opinion, the title of the opinion and basis for opinion paragraph should change accordingly. If you give an unmodified opinion, no changes required, you can use the titles as it is. Now, so let us come back to the next few contents of the auditor's report. See, 5, 6, 7 and 8. These contents will not be there in each and every audit report. Whether they will be available in each and every auditor's report or not, it depends on the circumstances. Fifth content, that is material uncertainty relating to going concern, key audit matters, emphasis of matter and other matter paragraph. All these 4 contents need not be present in each and every auditor's report. ఇవి ప్రతి ఆడిట్ రిపోర్ట్ లో ఉండవండి. వెదర్ దే విల్ బి అవైలబుల్ ఇన్ ద ఆడిటర్స్ రిపోర్ట్ ఆర్ నాట్, దట్ డిపెండ్స్ అపాన్ దట్ సర్కమ్స్టాన్సెస్. సో లెట్ us keep this discussion, let us keep these provisions on hold. We'll come back to them later. Fifth point, that is material uncertainty relating to going concern. We will read about this, we will revise about this while discussing the standards on auditing. While discussing SA 570, I will take you through what is this paragraph. Next paragraphs, key audit matter, emphasis of matter and other matter. Sorry, only these 4 paragraphs, not 9th one. So these 4 paragraphs. So 5th paragraph, regarding that I will revise that in the while discussing the standards on auditing. So key audit matters and emphasis of matter and other matter paragraph. 6th, 7th and 8th content, immediately after going through the remaining contents, I will take you through that. Okay, first let me take the other things, then I will come back to this 6, 7 and 8. 5th point I will discuss while discussing SA 570. Now I will not revise. So 6, 7 and 8, after completing the remaining concepts, I will come back. Okay, also 11th point, we will see it later. Also we will see 11th point later. Okay, right. Now, so what else is left? What else is left? So ninth point what? It contains the responsibilities of the management. Nothing but in this paragraph the auditor will try to explain the management responsibilities. He will remind the management of the responsibilities. So he will tell that, so management is responsible for preparation of financial statements, they are responsible for designing internal controls, they are responsible for providing auditor access to information. If you remember preconditions to audit in SA 210, the same thing he will give in the responsibilities of the management paragraph. So if you observe here, so key audit matters, we will come back later. Management responsibilities, yeah, here. See here. So management responsibilities paragraph. In this what he is telling, the company's board of directors is responsible for preparation of the financial statements, standalone financial statements that give a true and fair view. They have to prepare the financial statements. Next, the responsibility includes maintenance of advocate accounting records and others. It also requires internal controls for safeguarding the assets. So here if you observe, so they are also responsible for designing of the internal controls, accounting systems, internal financial controls and everything. And also they should provide the auditor with access to information, those things that we will explain in the management responsibilities. Now, next paragraph is relating to auditor's responsibilities. Here he will tell auditor responsibilities. He will tell that the auditor can only obtain reasonable assurance. He cannot obtain absolute assurance. Right. Next, what he will tell? What else? Right. So he says that they will assess the risk. We will come back later. Right here, if you observe, he is telling that they are required to exercise professional judgment. They have to maintain professional skepticism. He will mention that. Next, and so many things he will tell. Right. So he is required to obtain sufficient and appropriate audit evidence. He has to decide the materiality. Right. So all these things he will tell. He has to comply with the standards on auditing. His opinion cannot be taken as a guarantee. All these things he will explain. The responsibilities of the auditor. Okay, so that is the paragraph relating to responsibilities. Report on other legal and regulatory requirements. Actually, this paragraph contains information which is, there are some points which are required to be reported under the Companies Act. Under Companies Act, under 143 subsection 1, there are 6 points which an auditor is required to comment. Under 143 subsection 3, there are 10 points which auditor is required to comment. Under 143 subsection 11, nothing but CARO 2016. Under this, the auditor is required to report 16 more points. So totally 32 points. On 32 points, auditor is required to comment in the auditor's report. These are given under the Companies Act 2013. under Companies Act 2013, there are some reporting requirements. So under 143 subsection 1, 143 subsection 3, 143 subsection 11, totally on 32 points auditor is required to comment. He will include this in the auditor's report. These reporting requirements will be presented under the paragraph report on other legal and regulatory requirements. So whatever the reporting requirements are there of the auditor as per the Companies Act, those will be reported under the heading report of other legal and regulatory requirements. Right? So those 32 points will be reported, the comment of the auditor on those 32 points will be given under a separate paragraph with the title report on other legal and regulatory requirements. And after that, finally there will be a signature of the auditor. Right. So if you observe here, finally at the bottom, there is a signature of the auditor for Deloitte, Haskins and LLP. Right. So I have told you Deloitte are the auditors for the Infosys company. So they have given the name of the firm, and on behalf of the firm, one partner will sign. Not all the partners in the audit firm will sign. Any one partner on behalf of the firm can sign, and that partner should be a practicing chartered accountant in India. I hope you all know this is an important provision in the Companies Act. We will revise that at the end. Okay. So for Deloitte, Haskins and Company LLP, that is the name of the firm, and on behalf of that firm there is one partner, Sanjeev, he is signing. He is mentioned he is mentioned his membership number also, and also place where he is signing. He is signing at Mumbai. And also what is the date of signature? April 20, 2020. Audit report will not contain management signature. Please keep that in mind. In the morning class, we have seen that in the letter of engagement, auditor will sign, then it will give it a copy to the management also will sign. In auditor's report, management will not sign. Keep that in mind. Okay. Audit report is a opinion of the auditor. Their management signature is not required. Management signature is required in the letter of engagement. It is agreeing to the terms and conditions. Whereas through audit report, the auditor is not agreeing to any terms and conditions, is giving an opinion. Okay, so that's why management signature is not required in the auditor's report, whereas management signature is required in the letter of engagement. Okay, so these are all the contents: title, addressee, opinion, paragraph, basis for opinion. Right. So these 4 paragraphs will come back later. Right. Material uncertainty we will discuss in the SA 570, SA 701, SA 706. Immediately now we are going to revise after this, and it will contain a content of responsibilities of the management. A separate paragraph will be there. Responsibilities of the auditor, one separate paragraph will be there. There will be a paragraph relating to reporting requirements under the Companies Act, and the title of that paragraph will be report on other legal and regulatory requirements. There will be signature of the auditor. There will be place of signature and also date of the auditor's report. Okay, these are all the contents of the auditor's report. We have seen in the previous sessions up to the SA 700, we have seen different contents of the auditor's report, and also we have seen practically in what paragraph what content will be there, what are the matters that are to be included, everything that we have seen now. So I have told you that there are some 4 paragraphs which we will cover separately in the auditor's report. What are they? So material uncertainty relating to going concern, this we will discuss. This we will not discuss now. We will discuss it in SA 570. So remaining 3 let us discuss now. All right. First one, let us discuss about SA 701 key audit matter. SA 701 key audit matter. So what do you mean by this key audit matter? So generally, if you observe, see, we have seen the contents of the auditor's report. So whatever audit report you take, whatever company you take the audit report will look almost similar. It will contain the same contents, everything will be same paragraph, same order, everything will be similar. Only the name of the company and name of the auditors will change. So the industry thought that these audit reports are not providing any communicative value. All the audit reports of every company is looking similar. So there should be some communicative value in the auditor's report. So with that intention, the institute brought forward SA 701 key audit matter. So this standard is applicable on the financials for the audit of the financial statements on or prepared on or after 1/4/2018. After 1/4/2018, whatever the financial statements are prepared. So for that financial statements, if you are appointed as an auditor for auditing that financial statements, you are appointed for you. So reporting under SA 701 will be applicable. So that means from the year audit of the 18-19 financial years, key audit matters will be applicable. First of all, what do you mean by a key audit matter? Key audit matter means the matter which is of most significant. The matter which is of most significant, which the auditor has faced during the conduct of the audit of the current period. During the conduct of the current period, if the auditor has found any matter as very significant, so those matter has to be considered as a key audit matter, and that has to be disclosed in the financial statements. Sorry, that has to be disclosed in the auditor's report under the paragraph key audit matter. So first of all, what do you mean by key audit matter? The matters which are of most significant, which are most important, which the auditor feels those matters as very much important during the conduct of the audit of the current period. So for the year 1819, for the company A Limited, Mr. X has been appointed as a statutory auditor. So during conducting the audit of this A Limited for the year financial year 1819, if any matter was most significant, regarding any matter he thought that matter is most significant, then he has to disclose that matter as a part of key audit matter in his auditor's report. Okay, so these are the most significant matters which the auditor chooses from the audit of the current periods. Now, what is the purpose of communication? The purpose of communication of key audit matters is to enhance the communicative value. Of the auditor's report, to increase the communicative value, to provide some extra information to the users of the financial statements. The industry thought that the audit reports are becoming redundant, they are looking similar. So that's why, with that intention to increase the communicative value, they brought this SA 701 standard. What do you mean by key audit matter? These are most significant matters which the auditor has identified during the conduct of the audit. What is the purpose of this key audit matter? They enhance the communicative value of the auditor's report, and they provide transparency in reporting. First thing, sir, what do you mean by this significant matter, sir? Significant matters or key audit matters are those matters which are most significant, that we seen. So when we call a matter as a significant matter, it depends upon auditor's professional judgment. What amounts to significant matter? It depends upon what? Auditor's professional judgment. But the standard provides you some guidance. For example, if the auditor has faced a lot of difficulty in obtaining evidence regarding some area, the auditor can disclose that matter as a key audit matter. For example, you take an example of Infosys. So in IT companies, revenues are major areas where auditor faces a lot of difficulty in obtaining the evidence required. So in the revenue area, the auditor has found a lot of difficulty in obtaining the evidence. See, the purpose of disclosing the key audit matter means he is not giving any negative remark. If the auditor mentions any matter as a key audit matter in the auditor's report, he is not giving any negative remark, just he is telling why that matter is significant, how he has dealt with that matter, that's all. So if during the conduct of the audit of current period, if the auditor has faced any difficulty, if he has found any areas very risky, so how he has dealt with that area, that auditor has to discuss. That auditor has to disclose in the auditor's report. Okay, now if you observe here, this is the Infosys annual report. So let us see what are the key audit matters that the auditor is disclosing. So if you observe here, right, so fixed price contracts using percentage of completion method, that is in revenue recognition, there are some long-term contracts. For that contracts, they have to determine the percentage of completion. So if you remember in AS9, they will tell you to follow percentage of completion method. So that determining of percentage of completion is a very difficulty. How much percentage of work is completed? That is not as simple as we say. That requires a lot of judgments to be made. So regarding this determination of percentage of completion, the auditor has found a difficulty in obtaining the evidence. So that's why he has disclosed this matter as a part of key audit matter. So if you observe here, fixed price contracts using percentage of completion method, that is a key audit matter. He will explain why he has selected this matter as a key audit matter. Right, so he will say that so it has to be either recognized on a straight line basis or percentage of completion. Right, so he will explain what is the difficulty. He will say that the total efforts are calculated. So how that was calculated, why he has selected a key audit matter, everything he will explain in these 3 paragraphs. Then he will discuss how he has dealt with it, how the auditor has dealt with that, how this risky area auditor has dealt with. So what he is telling, how he has dealt with that. He selected a sample of fixed price contracts and determined percentage of completion. Right, he's compared the efforts, he has tested the estimates for consistency. So like that, what the auditor of this Infosys company has did, so he found that in case of revenue, determining percentage of completion for fixed contracts is difficult. The auditor found a difficulty in obtaining evidence regarding this area. So that's why he identified this area as a key audit matter and he has disclosed the information. Please keep one thing in mind, when the auditor is disclosing a key audit matter, it doesn't mean that auditor is giving a negative remark. He is just explaining something. In order to provide extra information to the shareholder, he is explaining some important matters, that's all. No separate opinion on these matters, no negative remark. If there is any key audit matter, it doesn't mean that auditor is telling something in a negative manner. Don't be in such a wrong notion. Okay, right. So what is the purpose we have said? To enhance the communicative value. So for example, for management, while preparing the financial statements, they have forgot to give some disclosure in the financial statements. Management, while preparing the financial statements, they forgot to give some disclosures. Now the management is telling the auditor, sir, you are preparing audit report, no, in that you have to include key audit matter, no, so we have forgot one disclosure that is to be made in the financial statements as per some accounting standard. You please give that disclosure in the key audit matters. Can the management say like that? No. Right, so key audit matter is not a substitute for disclosure in the financial statements, which is required as per applicable financial reporting framework. Not a substitute for disclosures in the financial statements. So for example, if the management has forgot disclosing some matters in the financial statements, can they approach the auditor and tell, sir, we forgot that in the financial statements, you are giving audit report, no, in that key audit matters paragraph will be there, no, there provide the disclosure. Can the management say, no, it is not a substitute for disclosures in the financial statements. It is also not a substitute for modified opinion. It is also not a substitute for modified opinion. What do you mean by this? So that means the auditor found some evidence. He found that there are some material misstatements in the financial statements. Can the auditor say like this, I will explain this matter in a key audit matter paragraph and I give an unmodified opinion? Can the auditor say no? If there is some misstatement in the financial statements and because of that, if the opinion is required to be modified, then opinion has to be modified. See, this key audit matter is not a alternative for a modified opinion. It is not a substitute for modified opinion. In key audit matter, what you are supposed to do? You have to just give the important information about some significant matters. That's all. You cannot say there is some misstatement. I will explain that in the key audit matters and give an unmodified opinion. You cannot say like that. Okay, so it is not a substitute for modified opinion, and also auditor is not giving any separate opinion on this key audit matters. The auditor is not giving any separate opinion, just he is explaining the matters, that's all. He is not going to give any separate opinion, he is just explaining the matters, that's all. Okay, so if you observe here, see here what he is telling. Key audit matters are those that in our professional judgment which are most significant in our audit of the standalone financial statements of the current period. These matters are addressed in the context of our audit of standalone financial statements as a whole and in forming our opinion thereon. And we do not provide a separate opinion. The auditor is not providing any separate opinion on the below matters, just he is explaining those matters, that's all. No separate opinion on these matters. Okay. So if you look at the standard, so first they are telling you definition of key audit matter, the matters in which professional auditor's judgment are of most significant, and these matters should be selected from those matters which are discussed with those charged with governance. So these key audit matters, the matters which you are considering as significant. So the matters which you want to report as a key audit matter, that has to be discussed, that has to be communicated first with those charged with governance. From those matters which are communicated with those charged with governance, from those matters you have to select a key audit matters. Okay, here what they are telling, first communicate out of the matters during the course of audit. There will be so many things which are required to be communicated with those charged with governance. Out of those communication, out of those matters which are communicated with those charged with governance, you have to select a few matters as a key audit matters. Here they are not asking you to take the permission of those charged with governance, just communicate them, that's all. And it is not a substitute for disclosure in the financial statements that the applicable financial reporting framework requires management to take. If the management is required to make any disclosure in the financial statements, that cannot be presented under key audit matter. Next, it is not a substitute for auditor expressing a modified opinion. Also, auditor cannot say there is some misstatement, I will explain that in the key audit matter and give an unmodified opinion. He cannot say. If because of some misstatement the modification is required, compulsorily he has to modify the opinion and give the reasoning basis for opinion paragraph. Key audit matter is not a substitute for modified opinion. Next, it is also not a separate opinion on the individual matters, and auditor is also not giving any separate opinion on the matters. Okay, right. So this is the purpose of communicating the key audit matter. Okay, so it enhances communicative value. It is not a substitute for disclosure. It is not a substitute for modified opinion. It is also not a separate opinion. Okay, let us see what other matters he has disclosed. Allowance for credit losses. So see, the auditor has selected one more key audit matter. What is that he is telling? In Infosys annual report only, any number of key audit matters you can disclose. There is no restriction on that. It is up to the auditor's professional judgment. The auditors of Infosys have selected two matters as key audit matters. First one is regarding determination of percentage of completion in case of fixed contracts, and the second key audit matter is allowance for credit losses. Let us see what is this. The company determines the allowance for credit losses based on historical loss experience, adjusted to reflect current and estimated future conditions, blah blah blah. Right. See, they use it to make some provisions for losses, so that losses are based upon the historical loss experiences. Right. So this the auditor has selected as a key audit matter. So what he is telling? We identified allowance for credit losses as a key audit matter because the company exercises significant judgment in calculating the expected credit losses. So there are so many judgments involved in determining the expected losses. So that's why auditor selected that area as a key audit matter. Next, he is telling what are his responses, how he has dealt with that area. He is telling what our audit procedures included the following. What are they? We tested the effectiveness of controls. Auditor has tested controls effectiveness in case of this estimated losses, right? And also he has verified completeness and accuracy. He has also did the computations, and also he has verified a sample of transactions, and he has done some analysis and calculations, and he has also tested the mathematical accuracy and computation of allowances. Okay, so this is the manner of presentation of key audit matters. Some matters during the conduct of the current year audit, if you found something as very significant, you have to disclose that under the key audit matters. Now, how the auditor will be able to decide from what areas he can select the key audit matters? Regarding this also, standard is giving some guidance. Areas from where key audit matters can be selected. Areas where there are higher risk of material misstatement. If in any area the risk of material misstatement is higher, the risk of happening misstatements is much higher, from those areas you can select the key audit matters. Or areas where significant judgments are involved. So many assumptions are involved. For example, as I have told, revenue is a high risky area in the case of IT business. And significant assumptions or judgments, wherever significant assumptions and judgments are there, from those areas also you can select the key audit matter. If you observe here, credit losses, why the auditor has selected credit losses? Because the company is exercising so many judgments in this case. So many assumptions are involved. From these assumption areas also you can select the key audit matter. Or if any significant events has happened during the year, like significant acquisition, significant events or transactions. So if any acquisition has been made during the year, right? So like that, from any significant events or transactions also you can select the key audit matters. These are the factors which the auditor has to consider while selecting the key audit matter. Nothing but if the auditor wants to select the key audit matters, from these areas he can select. What are those areas? Areas where the risk of material misstatement is very much higher, areas where there are more assumptions are involved, more judgments are involved, and also if any significant events or transactions happened during the year, from those transactions also you can select the key audit matters. So this is what D point. Factors for determining the key audit matters. What are they? The auditor shall take into account the following factors while determining the key audit matters. So while deciding what should be a key audit matter, the auditor shall consider the following areas. What are they? Areas of higher risk of material misstatements, areas of higher assessed risk of material misstatement, or where there is a significant risk, and also areas where significant judgments are involved, areas where more number of assumptions are involved, management is making a lot of assumptions in that area, from that areas also you can select the key audit matters. And also if there are any significant events or transactions that occurred during the year, from that areas also you can select a key audit matter. Okay, now next, prohibition. Standard puts some prohibition. Standard is telling you don't disclose the key audit matter in certain areas. Don't include a paragraph of key audit matter in certain circumstances. What are those circumstances? The standard says that if the auditor is giving a disclaimer of opinion, then the auditor shall not disclose key audit matter. If the auditor is giving a disclaimer of opinion, then the auditor shall not disclose key audit matter. What do you mean by this disclaimer of opinion? If the auditor gives a disclaimer of opinion, what does that mean? It means that auditor is communicating he is not able to express an opinion. Why? Because he is not able to obtain evidence. Why he is not able to obtain evidence? Because he is not able to perform the audit procedures. So if you remember the definition of key audit matter, key audit matters are most significant matters while conducting the audit of the current period. When you are conducting the audit of the current period, then in such cases, if you get any significant matters, those are required to be disclosed as a key audit matter. But if you are expressing a disclaimer of opinion, you are telling that you are not able to carry out audit only properly, then only you will get disclaimer of opinion. No. So what do you mean by disclaimer of opinion? Auditor is not able to express an opinion on financial statements. If he want to tell that, he will give a disclaimer of opinion. So if the auditor is giving a disclaimer of opinion, it means that he is not able to carry out the audit properly. He is not able to carry out the audit. He is not able to carry out the audit procedures. That's why he is not able to obtain evidence. That's why he is not able to express the opinion. That is what auditor wants to communicate when he gives a disclaimer of opinion. So if you are giving a disclaimer of opinion, you are indirectly telling that you are not able to perform the audit. If you are not able to conduct the audit properly, how you can identify the key audit matters? Able to understand? So the SS 701 says that if the auditor is giving a disclaimer of opinion, in case if the auditor is giving a disclaimer of opinion, the auditor shall not disclose key audit matters in the auditor's report. Why? Because if you are giving a disclaimer of opinion, it means that you are not able to carry out the audit completely. If you are not able to carry out the audit, how can you determine the key audit matters? So that's why when you are giving a disclaimer of opinion, the auditor shall not disclose a key audit matter. And also in other circumstances, that means even when you are not giving a disclaimer of opinion also, in some circumstances you should not be able to, you should not give a key audit matter. What are those circumstances? Right? If there are possible adverse consequences, if you are feeling that because of some communication there will be more negative consequences than the positive consequences, you are feeling that if I disclose some matter as a key audit matter, instead of increasing the communicative value, it will create a confusion. So then what you will do? Then the standard is telling that don't disclose that matter as a key audit matter. Or sometimes there can be legal or regulatory prohibition. Sometimes law or regulation will prohibit you from disclosing certain matters. For example, some laws and regulations prohibits the auditor disclosing transactions relating to money laundering. Those matters cannot be disclosed as a key audit matters. Or if it is confidential, and even if it is a confidential information, such confidential information also cannot be disclosed as a key audit matter. Okay, so when they ask you about the prohibitions regarding the disclaimer of, when they ask you regarding the prohibition on disclosing of the key audit matters, you have to write all these 4 points. First point is when he is giving a disclaimer of opinion, then there should not be any key audit matters, then there is no then there is no reporting on key audit matters. And also, even if no disclaimer, even if not disclaimer of opinion, then also in some circumstances the auditor shall not disclose key audit matters. What are they? Because of that disclosure, there are possible adverse consequences, more negative consequences of disclosures than positive consequences. You are auditor feeling that if I disclose some matter as a key audit matter, because of that there will be a lot of confusion, there will be a lot of misunderstandings. If like that there are more adverse consequences, you should not disclose that matter. And also when there is a law or regulation prohibits some matters from disclosure, right? So when there is a law or regulatory prohibition, then also you cannot disclose such matter as a key audit matter. And also when the information is highly confidential, you can also not disclose that matter as a key audit matter. Okay, so prohibition on key audit matters. SA 705 prohibits the auditor from communicating key audit matters when the auditor disclaims an opinion. So when the auditor is disclaiming his opinion, then he cannot disclose the key audit matters. Next, E point, circumstances where a key audit matter shall not be communicated. Even if disclaimer of opinion is not expressed, still in some circumstances they should not be communicated, key audit matters. What are they? Law or regulation prohibits. Law is prohibiting you from disclosing certain matter, then you should not disclose. Next, the auditor determines that the matter should not be communicated in the auditor's report because of possible adverse consequences. The auditor is feeling that if I communicate certain matter as a key audit matter, there will be more negative consequences. Instead of advantages, there will be more disadvantages. Then also you should not disclose that matter. And if the matter is highly confidential, or very sensitive information, then also you should not disclose that matter as a key audit matter. So this is completely relating to the standard. So we have seen the definition. SA 701 tells you about key audit matters, that tells you about definition, what is the purpose of the key audit matter and when it is prohibited and what are the areas from which the key audit matters can be selected. Very simple standard, very easy standard. So we have completed SA 701. Now let us move to the next standard, SA 705. SA 705 tells you about two more paragraphs. It tells you about emphasis of matter paragraph. So SA 706, it tells you about two more paragraphs which are emphasis of matter paragraph and other matter paragraph. So let us try to understand what do you mean by this emphasis of matter paragraph, when it will be used, what do you mean by other matter paragraph, when it will be used. So emphasis of matter paragraph. So for example, I will tell you with the help of an example. So the management has prepared financial statements. Okay, in the financial statements they have prepared balance sheet also, they have prepared profit and loss also. Okay, they have prepared statement of profit and loss also. So if you remember the vertical format of a P&L, so there will be some item here, extraordinary items. So there will be net profit before extraordinary items, then there will be extraordinary items, after that net profit after extraordinary items, it will be there. So in preparing the profit and loss statement, there is a extraordinary item. So what is that extraordinary item? They are showing some expense of 50 crores. So the net profit before extraordinary items was 1000 crores. They are showing in the statement of profit and loss some extraordinary item which is 50 crores. So that total showing net profit after the extraordinary items was 950 crores. So what is this extraordinary item means? There was a major fire accident at a godown. So because of that fire accident, entire stock was damaged. Because of the fire accident in that godown, entire stock was damaged. So that 50 crores of loss was a extraordinary item. It is a one-time item, right? So there was a loss of 50 crores and the management has correctly presented that information also in the financial statements. And the management has already presented that information also clearly. So notes to accounts, here extraordinary item, they have mentioned some note number 2.28. So if you go to note number 2.28, you will get to know in the financial statements, notes to accounts, in under note number 2.28, they have explained what is this extraordinary item clearly. They have told that in the financial statements, notes to accounts, they are telling you that they are providing you complete information. At so and so place a godown is situated. In that godown, because of short circuit, there is a fire accident. The stock was lying this much, 100 crores. That entire stock was damaged. Out of that, 50 crores insurance claims was raised. Remaining 50 crore was an extraordinary item. It is a loss. Complete information was already presented in the financial statements. There is some loss because of fire accident, and that item was correctly presented in the financial statements also without any mistake. Now, what opinion auditor will give? What opinion auditor will give? Is there any misstatement in the financial statements? If you ask me, there is no misstatement in the financial statements. Sir, there is a loss? No. But loss was actually disclosed in the financial statements? No. For example, if there is a loss of this 50 crores but the management is not showing this loss, then we say there is a misstatement. Then we say financial statements are not giving a true and fair view. But what happened here? There was a loss of 50 crores. The management has correctly presented in the financial statements also. There is a loss of 50 crores and management also correctly presented the information. There is no deviation. They have correctly presented. So I will not say here there is a misstatement. I will not say here there is a misstatement. Why? Because what is the actual position of this loss? That loss has been actually shown. Right? So this is 950 crores. So the profit became 950 crores. So auditor, or in audit report, what is the opinion auditor has given? Auditor given an unmodified opinion because there is no misstatement. Okay. Now assume a shareholder of this company. Right? So we cannot expect each and every person to be a chartered accountant. Any person who invests in the company, we cannot assume every person will have the capability to read and understand the financial statements. For example, one software engineer bought the shares in this company. So he will see the auditor's report. He will see that the auditor has given unmodified opinion, everything is good. He will feel like that. But actually there was a item which was already presented in the financial statements. There was a fire accident which is already presented in the financial statements, but we cannot expect each and every user of the financial statement to go through the entire financial statements. Can we assume each and every user of the financial statements to go through entire financial statements? No. Even we as a chartered accountant, some chartered accountants, even they don't know how to read the entire financial statements. Then how come a person from a non-financial background will be able to understand these matters? So that's why even though you give an unmodified opinion, you thought that there is no modification required, everything is correctly presented, but you want to draw the user's attention. You want to draw the user's attention to certain matters which are already presented in the financial statements. There are some items which are already presented in the financial statements. There was a fire accident, the details of which are already presented in the financial statements. But we cannot expect every user of the financial statements to go to every note and read the details. But we want to communicate them. Sir, the loss of 50 crores is one-time loss. Sir, next year this loss may not be there. This loss is because of fire accident. So last year my profit was 1000 crores. All of a sudden, why this 50 crores is loss? All of a sudden this year the profit is 950 crores only. Why my profit has reduced? So if you don't communicate, if you don't highlight this matter to the shareholder, what he will think? The profitability of the company is decreasing. So next year my profit will be much lower. He may be in the wrong notion. But actually this 50 crores reduction in profit was because of one-time event, because of fire accident. Next year this loss may not be there. Right? So this, if you communicate to the user, that will help him in a better understanding of the financial statements. If you highlight this information to the user, that will be fundamental to the user's understanding of the financial statements. So if you highlight this matter, if you bring this matter, if you want to bring such matters which are already presented in the financial statements to the user's attention, you will use the emphasis of matter paragraph. You will use what? Emphasis of matter paragraph. So in order to bring the matters, to highlight some matters which are fundamental to users understanding, of financial statements. So the meaning of the term emphasis, the meaning of the word emphasis is to highlight. The meaning of the word emphasis is to highlight. So you are highlighting what? You are highlighting here some matter which is fundamental to the user's understanding, which is already presented in the financial statements. So emphasis of matter paragraph will be used to highlight a matter which is already presented in the financial statements. Which is already presented in the financial statements. The information relating to that matter is already there in the financial statements, but you want to highlight the user's attention. You want to bring the user's attention to that matter. So what paragraph you will use? Emphasis of matter paragraph. By using this paragraph, you will highlight the matter to the user. So and so event has happened, you please go and refer to that matter. Okay, so that is the emphasis of matter paragraph. So if you observe Infosys annual report, so there is an emphasis of matter paragraph. He is highlighting something. What he is highlighting? As more fully described in note number 2.22, the standalone financial statements, the company is responding to inquiries from Indian regulatory authorities. The scope, duration or outcome of these matters are uncertain. That means the company has received some complaints. If you are aware, in the recent news, there was some whistleblowing. So someone has told that accounts are manipulated. Some issue in the Infosys is going on. Right? So these regulatory authorities, some actions are going on, some inquiries are going on, and company is responding. This information was actually presented in the financial statements also. If you go to note number 2.22, so one second, let me go to that note. So let us see what is there in note number 2.22. Yeah, see here. So there are contingent liabilities and commitments. What are they? It is having contingent liabilities of 3,410 crores, pending litigations, 1,305 crores, capital contracts. Right? So these legal proceedings are there. So the auditor wants to highlight this matter. See, there are some pending litigations. We don't know what these pending litigations would lead to. The company has disclosed the information. They have presented correctly only. They have given the information. They are telling you that the company is having so much of cases. The amount involved is so much. The information was already presented in the financial statements. In note number 2.22, they are presenting the information. But still, every user may not go through this note. If you don't highlight this matter, we cannot expect each and every user of the financial statement to go to this note number 2.22 and read the information there. So that's why auditor thought that it will be better if the auditor highlights this matter to the user. So that's why what did he do? He used the emphasis of matter paragraph. He used the emphasis of matter paragraph and told that you please go and refer to that matter. There some important information is presented which is relevant to the financial statements. What is that? So there was some pending litigations going on against the company. So auditor wants to highlight that matter. So he has used an emphasis of matter paragraph and brought it to the notice of the shareholders. Right. So that is the purpose of the emphasis of matter paragraph. Okay. He wants to highlight some information which is already presented in the financial statements. Now what do you mean by other matter paragraph? So other matter paragraph, if there is some information which is not highlighted in the financial statements, which is not presented in the financial statements. So the auditor wants to tell something, but it was not presented in the financial statements. So if he wants to highlight any such matters, then he has to use other matter paragraph. Primarily this other matter paragraph will be used for responsibilities of the auditor, for deciding what are the additional responsibilities or reduction in responsibilities. For example, if the accounts of the branch have been audited by some other person, he can highlight this matter in the other matter paragraph. There is joint auditor, he can highlight this matter. So when it comes to the matters relating to responsibilities of the auditors, when it comes to the matters relating to the responsibilities, additional responsibility if he has taken up, or his current responsibility was reduced. So if there are such matters relating to modification of the responsibilities, then he can highlight those matters under other matter paragraph. So emphasis of matter paragraph is used to highlight those matters which are already presented in the financial statements, and other matter paragraph will be used to highlight those matters which are not already presented in the financial statements. So primarily responsibility related matters will be highlighted in the other matter paragraph. Like, so if the branch accounts are audited by some other person, right? So if some responsibilities are different, right? So then he can use the other matter paragraph. Okay. So this is regarding emphasis of matter and other matter. So let us see them. SA706. Emphasis of matter and other matter paragraph in the auditor's report. Definitions. What is emphasis of matter paragraph? emphasis of paragraph that is included in the auditor's report that refers to a matter which is already presented or disclosed in the financial statements. A matter is there which is already presented and disclosed in the financial statements that auditor wants to highlight. What he will do, he will use emphasis of matter paragraph. Next, other matter paragraph. A paragraph included in the auditor's report that refers to a matter other than those presented or disclosed. The information was not presented or disclosed in the financial statements, but auditor wants to report such matter. Right? This paragraph mainly contains detail describing of auditor specific responsibilities, such as responsibility in case of branch audits, joint audits, or if the auditor has used any expert. So that responsibility related matters, he can communicate that in the other matter paragraph. Next, how this usage of when this usage of emphasis of matter paragraph is relevant. So emphasis of matter paragraph is used to draw users' attention to matter which is already presented in the financial statements, which is fundamental to the user's understanding of the financial statements. Right? Emphasis of matter paragraph is used to draw users' attention to a matter which is important for users' understanding of the financial statements in view of the auditor's judgment. The auditor shall include an emphasis of matter paragraph only he has obtained sufficient and appropriate audit evidence that the matter is not materially misstated in the financial statements. Same logic, the logic which you have used in the key audit matter. Let me ask you a simple question. So there is one area, there is a lot of misstatement in that area. Can the auditor give an unmodified opinion and highlight the matter in the emphasis of matter paragraph? No. The auditor can disclose certain matter as a emphasis of matter paragraph only when regarding that matter there are no misstatements. The auditor has obtained sufficient and appropriate audit evidence. There is no misstatement in that respective area in the financial statements. Then only he can highlight that matter as a emphasis of matter paragraph. If any area contains material misstatements, then auditor has to modify it. It will not be sufficient if he gives an emphasis of matter paragraph. That means, for example, here there is an Infosys company. For example, in this note number 2.22, the company has not disclosed, the company has not completely disclosed the pending litigations. Can the auditor highlight this as emphasis of matter paragraph? No. But here the auditor should satisfy himself that whatever information presented regarding litigations, that is correct only. There are no misstatements in that area. Then only he will highlight this as a emphasis of matter. If there is any misstatement in that area, they have not disclosed the information relating to contingent liabilities, then he will modify, then he will not highlight. Able to understand? Right? So what he is telling, the auditor shall include an emphasis of matter paragraph only when he has obtained sufficient appropriate audit evidence that the matter is not materially misstated in the financial statements. When the auditor has obtained evidence that respective area which he wants to highlight, in that respective area there is no misstatement, auditor has got sufficient appropriate audit evidence, then only he can highlight that matter as an emphasis of matter paragraph. So some examples also he is giving. What are the examples? So like pending litigations, right, or significant or major catastrophe like fire accident. That what should be the manner of presentation? It should be presented in a separate paragraph with the heading emphasis of matter. And if wherever the information is presented, you should give the reference number to that note number also. So see here, they have used a title separately, emphasis of matter, and they have also given a reference to the note number where you can find more additional information regarding that matter. Next, also state the auditor's opinion is not modified. You should also tell that we are highlighting the matter, we are not modifying. Yes or no? Otherwise, what user will think? Auditor is highlighting this matter, there is some mistake. So that's why in order to avoid users misunderstanding, what you have to do, you have to tell that, here see, here what they are telling, our opinion is not modified. We are not modifying our opinion because of this matter. We are just highlighting this matter to you, that's all. So like that you have to use a statement. And this emphasis of matter and other matter paragraph, these also before including them in the auditor's report, you please communicate with those charged with governance. So before including this emphasis of matter paragraph or other matter paragraph, just communicate this matter with those charged with governance. Don't take the permission, just communicate with them. Sir, why communication is required? You may get additional information for presentation, that's all. Okay, so you may communicate with those charged with governance before using the emphasis of matter paragraph and other matter paragraph. Okay, so that's all, very simple standard regarding SA 706. So we have seen what do you mean by key audit matter, what do you mean by emphasis of matter, and what do you mean by other matter paragraph. Let me give you one single overview regarding this. Last time I will try to give you an overview about these three matters. So key audit matter versus emphasis of matter paragraph versus other matter, right? So key audit matter, it is a audit related matter. Key audit matter is what? It is a audit related matter. So for example, if the auditor has found any difficulty in obtaining the evidence, or if the auditor has faced a lot of issues, the auditor has put a lot of efforts than other areas. So those audit related process, those audit processes, some matters which the auditor is going to disclose in the key audit matter. Here he will tell audit related process, a process of audit which he has faced a difficulty, that he is going to disclose in the key audit matter paragraph. Whereas when it comes to emphasis of matter paragraph, here the auditor wants to highlight the information which is already present in the financial statements. Highlight information which is already present. It is already presented in the financial statements at some place. You want to draw the user's attention to that respective matter. So in order to draw the user's attention to that matter, what paragraph that you are going to use? You are going to use a emphasis of matter paragraph. Whereas key audit matter is it is an audit related matter. The difficulty which the auditor has faced, he has faced some difficulty. If you observe this Infosys annual report, what is the key audit matter their auditor is showing? So determining the percentage of completion in case of contracts is a difficulty which the auditor has faced. He has explained that. Here auditor is not modifying opinion, his auditor is not giving any negative remark, just he is telling that in so and so area I have faced this difficulty, and that's why I have identified this as a key audit matter, and this is how I have dealt with that respective area. These are the procedures which I have followed in that respective area. So that audit related process the auditor is disclosing in the key audit matter, whereas emphasis of matter paragraph, the matter which is already presented or disclosed somewhere in the financial statements by the management, the auditor wants to draw the user's attention to that matter, because we cannot expect each and every user of the financial statement to go through the entire set of financial statements. We cannot expect. So that's why there could be some matters which is essential for the user's understanding of the financial statements. The auditor will identify a few of that items and he will disclose them and he will highlight them under emphasis of matter paragraph. Next, what do you mean the other matter paragraph? Here the auditor will mention something which is not already present in the financial statements. Which is not already presented in the financial statements. That means specifically, as I have told you, responsibilities. Any specific responsibilities or no responsibilities. Some responsibility he has not done. So that responsibility related matters he can disclose them in the other matter paragraph. For example, one of the accounts of the branch were not audited by the principal auditor, some other branch auditor was appointed. So he will tell, so and so branch was not appointed by me. It was audited by some other person. So there is no responsibility with respect to this branch, because this branch is audited by some other chartered accountant. So there is no responsibility here. So that's why he highlighted that matter in the other matter. Or while conducting the audit, he has skipped some area, right? Or the auditor is conducting the audit of consolidated financial statements. Their holding company he has audited. For example, there is a holding company, there is a subsidiary company, and there is also an associate company. This holding company will prepare a set of standalone financial statements. Every holding company will have a set of standalone financial statements, and it will also have a set of consolidated financial statements which includes the information relating to holding company, subsidiary, associate, joint ventures. All this information of this entire group will also be contained in the consolidated financial statements. Audit will happen for both the standalone financial statements and also consolidated financial statements. The auditor will give a separate audit report for standalone financial statements. For consolidated financial statements, separate audit report will be there. Okay. So if you observe even if you take if you observe here, this is actually the annual report of Infosys company. So here there is a financial statements. So this is actually the index. Here if you observe, there are standalone financial statements. And there will also a consolidated financial statements. This consolidated financial statements will incorporate the information relating to subsidiary and associates also. Whereas these standalone financial statements will contain information only relating to the holding company. Whereas consolidated financial statements will contain information relating to holding company, its subsidiary, its associate, all the group company consolidated information will be presented under consolidated financial statements. So if you observe here, for standalone financial statements, there will be independent auditor's report. A auditor will be appointed for standalone financial statements. The audit also will happen for the consolidated financial statements also. So if you observe the index here, in case of standalone financial statements, there is an independent auditor's report. In case of consolidated financial statements also, auditor will verify consolidated balance sheet, consolidated statement of P&L, consolidated cash flow statement, consolidated statement of changes in equity, and consolidated notes. These and all auditor will verify. In consolidated financial statements also, auditor will give an audit report. Okay, so for example, you are appointed as an auditor of a consolidated financial statements, but you are also the auditor of a holding company, or also the auditor of a subsidiary company, but associate company, some other auditor is there. There is a person, Mr. X, he has been appointed to conduct the audit of both consolidated financial statements and standalone financial statements of the holding company. So this associate company was not audited by Mr. X, some other chartered accountant, Mr. Y, has audited the financial statements of an associate company. But the details of this associate company also will be included in the consolidated financial statements or not. So here the auditor will mention in the other matter paragraph, what he will mention, the financial statements, the consolidated financial statements include financial information of the associate also. That associate was not audited by me, thus that associate was audited by some other person. So here there is a responsibility related matter. So like that, if the auditor wants to disclose any matter relating to responsibility which is not presented in the financial statements, then he can disclose the same in the other matter paragraph. Okay, so this is the major differences between key audit matter, emphasis of matter paragraph, and other matter paragraph. Okay, so with this we have completed all the contents except this essay 570, the paragraph relating to material uncertainty. A paragraph relating to material uncertainty that we did not discuss, that we will come across when we are discussing essay 570. Right. So other than that, all the contents of the auditor report that we have finished. Okay, so only this one is pending. Material uncertainty relating to going concern is pending, that we will come across while discussing the standards on auditing as per essay 570. We will come to know what is this paragraph, what and all information will be presented in this paragraph. Okay, so with this we have completed essay 700, 701, 705, 706. So we have completed 700, which contains the details regarding the report, how the report, what are the contents of the report, that all. And 701, this discusses about key audit matters. 705, modifications to the audit opinion, that also be completed. 706, emphasis of matter paragraph and other matter paragraph. Right, but one more thing guys, there is report on other legal and regulatory requirements. No, so here report on report on other legal and regulatory requirements. Here I have told you that, so there are some reporting requirements under the Companies Act. So what are they? I have told you that there are total 32 points under 143 subsection 1. There are 6 points on which the auditor is required to comment. Under 143 subsection 3, there are 10 points which the auditor is required to comment, and 143 subsection 11 are CARO 2016. So under this, how many points are required to be reported? Under this, once again 16 points are required to be reported. So in total 32 points are required to be reported by the auditor in the auditor's report. These are the requirements of the Companies Act. These are all the requirements of the reporting requirements of the auditor under the Companies Act. 143 subsection 1, 6 items, 143 subsection 3, 10 items, 143 subsection 11, 16 items. Total on 32 points auditor is required to comment. Where and all he is going to include all these comments. All this will be mentioned under the heading report on other legal and regulatory requirements. All these 32 points the auditor will report under the heading report on other legal and regulatory requirements. With this heading, the auditor will include a paragraph in the auditor's report, and under that heading he is going to comment on these 32 items. First of all, let us see what and all these 32 items say. What are those 32 items? First of all, let us see that. Okay, so we will start with 143 subsection 1. Let us see what are the 6 items which are mentioned under 143 subsection 1. So explain various reporting requirements of the auditor under 143. So first we will discuss under 143 subsection 1, 6 matters. So this is also called as inquiry. What are the matters that the auditor has to inquire? If they ask you the same question, then also you have to write the 6 points. Or sometimes they can directly ask you the question, what are the reporting requirements of auditor under section 143 subsection 1? Or sometimes they can ask, they can also ask you the question like, what are the matters that the auditor is required to inquire as per 143 subsection 1? So whatever may be the question, answer is the same. Okay. So what are the 6 matters? Let us see. It is the duty of auditor to inquire into the following matters. What is that? First point. Let us go point by point. Whether loans and advances made by the company. Here what they are telling you? Loans and advances made by the company. That means they are telling you about loans and advances which are given by the company to the outsiders. They are telling you about loans and advances which are given by the company to the outsiders. That means assets of the company. Company ఏదైతే లోన్ థర్డ్ పార్టీస్ కి ఇచ్చిందో ఆ లోన్స్ గురించి మనకి కొన్ని రిపోర్టింగ్ రిక్వైర్మెంట్స్ ఉన్నాయి. Whatever the loans and advances that are given by the company, not taken by the company. Here they are talking about the assets. So first point is relating to loans and advances given by the company. What and all auditor has to check? Whether loans and advances which are made by the company on the basis of the company, on the basis of the security have been properly secured or not, and whether the terms on which they have been made are prejudicial to the interests of the company or its members. What does that mean? So if the company has given any loans and advances and to other persons, and they are showing it as a secured loans and advances, that means they are telling you that those loans and advances are given on the basis of security. As an auditor, you have to verify whether they are properly secured or not. Whether they are properly secured or not. What do you mean by this? Let me give you a small example. For example, the company is telling that they have given 10 lakhs of loan to some person on the basis of the security. They are showing it as secured loans and advances. Now you ask, sir, what is the security that you have accepted? On what security you have given a 10 lakhs of loan? So the company management is telling that we have taken a two-wheeler as a security. He is having some two-wheeler, they have taken a two-wheeler as a security and given 10 lakhs of loan. Can we say this loan has properly secured? Okay, you are telling security is there, but is it properly secured? For giving a 10 lakhs of loan, this you are accepting some 50,000 or 60,000 worth of one motorcycle. How can we call it as a properly secured? So as an auditor, what you have to verify, whether whatever loans and advances that are given by the company to the outsiders, right? So loans and advances given by the company, made assets of the company, whether or they are showing them as a secured loans and advances, whether they are properly secured or not. Okay, security is there, okay, but that security is proper or not. So this is one example. For giving 10 lakhs of loan, if they accept the security of a motorcycle, we will not call it as a properly secured. How can you call it as a properly secured, right? So that is the first point. And also whether the terms on which they have been made are prejudicial to the interests of the company or its members. So whatever the terms on which these loans and have been made, whether they are adversely affecting the members, whether they are adversely affecting the interest of the members of the company. For example, when we say the terms will be prejudicial, so in articles of association they have written that whenever the company gives a loan, it has to charge an interest rate of 10% per annum. But in one case, the company has a given loan to one of the directors free of interest, without any interest they have given. So now the terms on which these loans are given, are they against the interest of the company or not? Yes. Why? Because in AOA the 10% interest you have to charge, but you are giving free of interest. Or in AOA they have told you that the maximum amount which a company can give a loan is 10 lakhs. But to some company the management has given a loan of 30 lakhs. Here also you have permitted up to 10 lakhs, you have exceeded that limit. That means the terms on which the loan was given is prejudicial. It is negatively affecting the interest of the company. So as an auditor, whenever the loans and advances are given by the company to other parties, you have to verify whether the secured loans and advances are properly secured or not, and the terms on which such loans and advances are made, whether they are against the interests of the company or its members, whether they are adversely affecting the interests of the members of the company. That as an auditor you are required to comment. That is the first reporting requirement under 143 subsection 1. What is the second one? Whether the transaction of the company which are represented by mere book entries, The transactions of the company which are represented by mere book entries are prejudicial to the interest of the company. What do you mean by transactions which are represented by mere book entries? That means transactions will have only book entry, there will not be any supporting for that. What are some examples? Provision for depreciation. Right? Provision for depreciation is actually only a book entry. You will not have any evidence for that. Similarly, provision for bad and doubtful debts. Provision for bad and doubtful debts. This is also just a book entry. You will not have any proof for that. Right? So like that, if there are any transactions which are just having book entries, whether those transactions are against the interest of the company, the auditor has to verify. That means there is actually one of the debtor, he has to pay us some 2 crore rupees. He is going to be bankrupt almost. So what we have to do, and management is of the assumption that nothing is recoverable. Out of these 2 crores, nothing is recoverable. We are going to get 0. So now what management has to do? They have to do a provision for depreciation, for provision for bad and doubtful debts for entire 2 crores. But management, in order to show higher profits, what they have done is, instead of 2 crores, they have shown only 1 crore as provision for bad and doubtful debts. Now here the transaction is represented only by book entry, and here the terms are prejudicial or not. Actually, the debtor is going to be bankrupt and the management estimates that we can recover nothing from him. Then they have to create a provision for 2 crores. But in order to hide this, in order to show higher profits, what management is showing? Provision for doubtful debts, they are showing it as 1 crore only. So here the transaction is represented by mere book entry and it is prejudicial to the interest of the company. It is against the interest of the company. So like this, if there are any circumstances, auditor has to report on them. Second point. Next, third point, whether any shares or securities held by the company are sold at a price less than the purchase price. So if the company is having any shares or securities, whether they have sold them at a price less than its purchase price. Here market price is irrelevant. If you are selling the shares and securities at a loss, okay, so if you have bought some shares, you have bought some 1000 shares at 100 rupees and you are selling the shares at 98 rupees, you have to report such kind of transactions, right? So as an auditor, if you have to report if the company is having shares and securities of other companies, whether they are sold at a price less than its purchase price. Here market price is irrelevant. If the price at which you are selling your securities is less than the purchase price, you are required to report it. Whenever you are selling it at a loss, you have to report it. However, this reporting is not applicable when you are conducting audit of investing and banking companies. Whenever you are conducting audit of investing and banking companies, you are not required to report on this point. Why? Because banking and investing companies, their regular activity is buying and selling of the securities. No. So there can be so many instances where they will buy at a higher price and sell at a lower price. It is their ordinary course of business. So that's why this reporting requirement will not be applicable to banking and investing companies. That is third point. Next, whether loans and advances made by the company have been shown as a deposits. As an auditor, you are also required to comment if the company has given any loans and advances. Here also they are talking about assets only. Fourth point is also relating to loans and advances given by the company to the others. So if the company has given any loan and advances to the other party, have they shown it as deposits? If you find anything, you have to report. Why, sir? Why they can't be shown as a deposits? Why? Because generally in the normal course of business, the companies are required to deposit so many items. For example, if you want any property on rent, you have to give rental deposit. If you want electricity connection, you have to give electricity deposit. Sometimes supplier may also ask for security deposit. So deposits happen in the ordinary course of business. Whereas loans and advances, if you give loans and advances to other persons without any proper reason, shareholders will question. See, our business is doing something. We are not the bankers for giving loans and advances. Why as a management you have given the loan to other person? The shareholder will question. But deposits, generally shareholders will not question. Why? Because a lot of deposits will be given in the ordinary course of business. Both are assets only. But loans and advances raises the questions of the shareholders, but the deposits does not raise the questions of the shareholder. So that's why if any loans and sometimes management, what they can do, they will give loans and advances, but in order to distract the shareholders, they will show it as a deposit to avoid the questions of the shareholders. So that's why as an auditor, if you find any loan and advances which is given by the company, but it has been classified or shown as a deposit in the balance sheet, you have to report those matters also. That is the fourth point. Next, fifth point, whether any personal expenses have been charged to revenue account. So there are some personal expenses of the directors. Directors is paying a rent of a flat. Can it be shown as a company expenditure? Unless there is a policy, you cannot show, right? So one of the director has bought an iPhone for his wife. Can it be shown as a company expenditure? No. So whatever the personal expenditure is there, that should not be charged to revenue. That means that cannot be shown as a business expenditure. As an auditor, during the course of the audit, if you are able to find any such personal expenditure which has been charged to revenue account, as an auditor, while conducting the audit, if you are able to find any expense which is personal in nature but it has been charged to revenue, you have to report those kind of matters also. Next, finally, last point, where it is stated in the books and documents of the company that any shares have been allotted for cash. So for the year you are conducting the audit, and during the year, if any share has been allocated for cash, as an auditor, what he has to verify? Whether cash has been actually received in respect of such allotment. If you are allocating shares for cash here doesn't mean physical cash. In bank also, when the amount comes, then when the amount comes, then also we say it as a shares allocated for cash only. So if the company has allocated shares for cash during the year for which you are conducting the audit, you are required to comment whether the cash has been actually received or not. And if not received, whatever the position is shown in the financial statements and balance sheet, whether that is correct or not. That means if the call amount has not been received, how it has to be shown in the balance sheet? It has to be shown as calls in arrears. If any amount has been received in advance, then it has to be shown as calls in advance. Right? So as an auditor, you have to see if any shares have been allocated for cash, whether the cash has been actually received or not. If not received, whether the position which is stated in the financial statements is correct and not misleading. So these are the 6 points which the auditor is required to report under 143 subsection 1. What are that? Once again, first point is relating to loans and advances, whether on the basis of security have been properly secured or not, and the terms and conditions on which they are made, whether they are prejudicial, and the transactions which are represented by mere book entries, whether they are prejudicial, and also if the company is having any shares and securities, whether they are sold at a price less than its purchase price. This is not applicable to banking and investment companies. And fourth point, whether loans and advances are shown as deposits. Fifth point, whether personal expenses have been charged to revenue account. And sixth point, if any shares have been allocated for cash, whether the cash has been actually received or not. If not received, whether the position stated in the financial statements is correct and not misleading. One more thing, sir, auditor has verified all the 6 points, sir. He did not get negative answer. Everything he got a positive answer only. For example, take only this point, sir, there are no shares and securities. Even though there are shares, they are sold at higher than the purchase price only, sir. Then is the auditor required to state in the positive sense also. There are shares and securities which are sold, but they are not sold at less than purchase price. They are sold at higher than purchase price only. He is required to mention that also, even though he get a positive answer. He is required to state the company has sold the shares and securities at a price higher than the purchase price. Like that, even though he got a negative answer, still he is required to report. The act says no. All these 6 points are required to be reported only when there are negative answers, negative remarks. That means there are some shares and securities which are sold less than purchase price, then only reporting will be applicable. If no share has been sold for less than purchase price, reporting is not required. If you get a positive comment, no separate reporting is required. If to any of the above 6 points, if you get a negative answer, then only you are required to report. For example, loans are not properly secured, you have to report. Terms are not prejudicial, you have to report. No sir, all the loans are properly secured only. Terms are also not prejudicial. Are you required to report? Not required. So like that, to the 6 points, if you get a negative answer, then only you are required to report. If you are getting a positive remarks, you are not required to report. The same thing they will tell you here. If the auditor got a positive response, he can ignore above matters. However, if there is any negative or adverse comment, observed, then he shall state them in his report along with the reasons. Next, where and all these matters should be reported under the heading report on other legal and regulatory requirements. Under that heading in the auditor's report, the auditor has to comment on these 6 items. So these are the 6 matters which the auditor has to inquire under 143 subsection 1. Let us see next point. There are 10 more points under 143 subsection 3 now. So let us see that. So duty to report on certain matters under 143 subsection 3. So what are the reporting requirements under 143 subsection 3? Let us observe that. The audit report shall also state, first point, whether he has sought and obtained all the information and explanation which to the best of his knowledge and belief were necessary for the purpose of his audit. So first point, what he has to state under 140 subsection 3, whether the auditor has obtained all the information and explanation or not, that auditor is required to comment. Next, B, whether in his opinion proper books of accounts as required by law have been kept by the company so far as appears from his examination of those books and proper returns advocate for the purpose of his audit have been received by the branches not visited by him. In the second point, what he has to comment, whether in his opinion all the proper books of accounts as required by law have been maintained or not, and in respect of any branches which he has not visited. If he has not visited any branches, in respect of that branches, whether summarized returns are received by him or not. So that is the second point which auditor has to comment. Next, third point, whether the report on the accounts of any branch office of the company audited by a person other than a company auditor has been sent to him and how he has dealt with it in preparing his report. That means what? If the accounts of the branch are not audited by the company auditor himself, accounts of the branch are audited by some other person, that branch auditor, whether he has sent his report to the main company auditor or not, that also auditor has to comment. Sir, what do you mean by this, sir? Who can conduct the branch audit? So let me cover the branch audit also here only, right? So what do you mean by branch audit? For example, there is a company X Limited, right? So it is having a head office at Hyderabad. It is having so many branches. It is having branches at Vijayawada. It is having branch at Guntur. It is having branch at Chennai. It is having branch at Vizag, Bangalore. So like that, it is having so many branches. So this X Limited has appointed Mr. A, a practicing chartered accountant, as an auditor of X Limited. So this auditor is telling that I will not be able to visit this Bangalore branch. Please appoint some other auditor specifically for this branch only. Okay, so what management did was, it appointed Mr. B, another chartered accountant in Bangalore, to conduct audit only for the branch. Only for the Bangalore branch. So we will call him as a branch auditor or component auditor. Branch auditor or a component auditor. See, branches are nothing but components of an entity. Branches are nothing but components of an entity. Since this person, Mr. B, is conducting audit of one of the component of the entity or branch of the entity, we call this person as a branch auditor or a component auditor, and this person who has been appointed for company as a whole as an auditor, he will be called as a principal auditor. He will be called as what? Principal auditor. So the person who is conducting the accounts, who is conducting audit of the branch, is known as a branch auditor or component auditor, and the person who has been appointed as an auditor for the company as a whole, we call him as what? Principal auditor. We call him as what? Principal auditor, right? So the branch auditor, Mr. B, has been appointed as a branch auditor of this Bangalore branch. He has to submit his audit report to the principal auditor, Mr. A. The branch auditor has to submit his report to principal auditor. So as an auditor, in under 143 subsection 3, under third point, what you are required to comment? If the accounts of the branch are audited by some other person, whether that branch auditor has sent his audit report to the principal auditor or not. Whether the branch auditor has sent his report to the principal auditor or not, and how he has dealt with it, the auditor is required to comment. The auditor is required to comment in the third point. So first 3 points, whether he has obtained all the information and explanation. Second point, whether proper books of accounts are maintained, and in respect of branches which was not visited by him, summary returns are received or not, and if the accounts of the branch are audited by some other person, whether that branch auditor has sent his report to him or not, and how he has dealt with the report, that also auditor is required to comment under 143 subsection 3. Now fourth point, whether the company's balance sheet and profit and loss account dealt within the report are in agreement with the books of accounts and returns. What is the fourth point that the auditor is required to comment? Whether your financial statements, that is balance sheet and profit and loss, whether they are matching with the books of accounts or not, the auditor is required to comment. Next, E point, whether in his opinion the financial statements comply with the accounting standards. Also, whether the financial statements are complying with the accounting standards or not, auditor is required to comment. Next, the observations or comments of the auditors on financial matters or transactions which have any adverse effect on the functioning of the company. So if the auditor has found any transaction, any financial matter, it could have an adverse effect on the functioning of the company. It could affect the functioning of the company. For example, the company has taken a loan. The client for which you are conducting the audit, they have taken a loan, and the rate of interest is 35%. Rate of interest is how much? 35%. As an auditor, you thought that this loan at such a higher rate of interest will adversely affect the functioning of the entity. You can comment it here. Okay. So the observations or comments on auditors on the financial transactions or matters which have any adverse effect on the functioning of the company. Those matters or observations also auditor is required to report under F point of 143 subsection 3. Next, G point. Whether any director is disqualified from being appointed as a director under subsection 2 of section 164. So like if you remember, in company audit we will have a disqualifications for the auditor. If certain conditions are fulfilled, the auditor cannot, the chartered accountant cannot act as an auditor of a company. Similarly, under 164 subsection 2, there are some disqualifications to the directors. So one of such disqualifications is if the company in which you are a director has not filed the annual return with ROC for 3 continuous years. For 3 continuous years, you are not filing the annual return. All the directors of that company will be disqualified. Not only from that company, they cannot act as a director in any other company for a period of 5 years. Okay, so like such, there are some disqualifications under 164 subsection 2 to the directors. If the client for which you are conducting, in that client, if any of the director is disqualified, you have to report. If under 164 subsection 2, if any of the director of the client for which you are conducting the audit is disqualified, you have to report under clause G of 143 subsection 3. Next, what is clause H? Any qualification, reservation or adverse remark relating to the maintenance of accounts and other matters. So what do you mean by this? So the management has maintained all the books of accounts, but they have not properly maintained it. They have not followed proper policies. For example, they have maintained all the books of accounts, but they are not maintaining it under accrual system. They are maintaining under cash basis. So here there is a negative remark or not. Auditor is required to comment or not. He has to comment under clause H. See, if you observe, clause B and clause H looks similar. Clause B is also relating to books of accounts. Clause H is also relating to maintenance of accounts. So what is the point of difference, sir? So in clause B, you have to report whether all the books of accounts are maintained or not. Whether all the books of accounts are maintained or not, that you have to comment. If in clause H, what you have to report, the books of accounts are maintained, but there is some mistake in the maintenance. For example, if the company is covered under section 148, cost records is mandatory for them, no? So the company did not maintain cost records. They will mention under clause B. The company has maintained cost records, but they have made some mistake in the maintenance. You have to report under clause H. Okay. Next, clause I. Whether the company has adequate internal financial controls with respect to the financial statements in place and their operating effectiveness of such controls. Also, the auditor is required to comment whether the company is having proper internal financial controls or not. Internal financial controls are also nothing but a part of internal controls which deal exclusively with the financial statements. So generally, internal controls are nothing but policies and procedures to prevent the misstatement in the financial statements. Yes or no? So if these internal controls are specially designed to prevent the mistakes in the financial statements, then we call them as internal financial controls. So as an auditor, you have to verify whether your client is having adequate internal financial controls or not, and if they are having, whether they are operating effectively or not. The auditor has to see both the existence of internal controls and also the operating effectiveness of such internal controls. However, some companies are not required to maintain internal controls. The exception has been provided to some class of companies to not maintain internal financial controls. What are those companies? So here they have given. The provisions of internal financial controls shall not apply to for the following private limited companies. To private limited companies, if they satisfy certain conditions, internal financial controls need not be implemented by the management. If the internal controls need not be implemented by the management, then reporting on internal controls also not mandatory for auditor. See, So what do you mean by this? What do I mean by this? So for example, we have told that under clause I, auditor is required to report on whether the company is having adequate internal financial controls and whether they are operating effectively or not. See, some companies are not required to maintain internal controls only. Companies Act itself has given exemption to certain companies not to maintain internal financial controls. If the Companies Act itself is giving an exemption, then you are having nothing to report, right? Then what you will mention in clause I in such companies? See, for this company, adequate internal financial controls is not mandatory. Just you will give a simple statement. So first of all, let us see for what companies internal financial controls are not applicable. For the following private limited companies, what are they? One person company need not design internal financial controls. Small companies are also not required to maintain internal financial controls. And also if a private company satisfying the following two conditions, both the conditions, what are they? Turnover as per the last financial statement shall not exceed 50 crores and also loans and borrowings from banks and financial institutions shall not exceed 25 crores. So if the turnover does not exceed 50 crores and loans and borrowings does not exceed 25 crores, if both the conditions are satisfied by a private company, then that private company need not have internal financial controls. If the company itself need not have internal financial controls, then the auditor also, there is no requirement on the auditor also to report on these matters. So that is clause I. Next, what is clause J? Such other matters as may be prescribed. Rule 11 of the Companies Rules 2014 describes the other matters. Under Rule 11, there are some other matters which are required to be reported. So what are they? There are 3 points under Rule 11. What are they? Let us see. Whether the company has disclosed the impact of pending litigations on its financial position in its financial statements. That means the auditor has to comment whatever the pending litigations are pending against the company, whatever the litigations that are pending against the company, whether the impact of all that litigations has been included in has been properly presented in the financial statements or not. Okay, so whether the company has disclosed the impact of pending litigations on its financial position in its financial statements, whatever pending litigations are there, whether they have been properly presented in the financial statements or not, auditor is required to comment. Next, whether the company has made provision as required under any law or accounting standards for material foreseeable losses, if any, on long-term contracts including derivative contracts. So in respect of long-term contracts, if there are material foreseeable losses, whether you have created a provision or not. If you remember accounting standard 7, there a point will come. If there is if before the completion of the project only, if you are able to know that there will be losses, what you have to do? You have to recognize the loss immediately, no? So same point. So if there are material foreseeable losses in case of long-term contracts, you have to create an advocate provision. So whether such provision has been maintained or not, auditor is required to comment. Next, whether there has been any delay in transferring amounts required to be transferred to the Investor Education Protection Fund. So, is the company required to transfer any Investor Education Protection Fund amount? If yes, if there has been any delay, whether they have transferred the amount to the Investor Education Protection Fund to the company, to the Investor Education Protection Fund within due date or not, also auditor is required to comment. Okay, so these are all the reporting requirements under section 143 subsection 3. So totally I have told you 10, but indirectly 10th point has 3 more sub points. That means total 12 points are required to be reported by 143 subsection 3 by the auditor. And let us see what will be the reporting requirements here. Under 143 subsection 1, what we have told, if the auditor is having negative remark, then only he is required to report. If the auditor is having positive remark, then he need not report. Let us see what they are telling in 143 subsection 3. Audit reporting requirements. The auditor shall report on the above matters irrespective of positive or negative remarks observed by him. So whether he is having a positive remark or whether he is having a negative remark, everything he has to report. For example, for all the above questions, he's got a positive answers only. Still, he have to state them in a positive manner. So, no director is disqualified. You have to say, no director is disqualified. He has obtained all the information. You have to say, I have obtained all the information. All the books of accounts are maintained. You have to tell positive manner. Right? So, even you get a negative answer, even you get a positive answer. In every audit report, these 10 points should be there. And also, where and all these should be presented? They should also be presented under reporting on legal and other regulatory requirements. Okay, so let us see once Infosys annual report. Let us go to the heading report on other legal and regulatory requirements. So if you observe here, report on other legal and regulatory requirements. So the auditor has reported under 143 subsection 3. there is no single point which is reported by auditor under 143 subsection 1. What does that mean? The auditor is commenting only on the points under 143 subsection 3. He is not giving any comment relating to the points under 143 subsection 1. What does that mean? That means that whatever that 6 points are there under 143 subsection 1, all that points the auditor had got positive answers only. Since there are no negative answers, that is not required to be reported. But under 143 subsection 3, even if you get a positive answer, even if you get a negative answer, you have to report. So if you observe, he has reported. So we have sought all the information, proper books of accounts are maintained, right? So no director is disqualified. So financial reporting, internal controls, and also see other matters. The company has disclosed the impact of pending litigations. The company has made provision for material foreseeable losses. There has been no delay in transferring the amounts to the Investor Education Protection Fund. So 143 subsection 3 reporting was there, whereas 143 subsection 1 no single point is there. What does that mean? The auditor is not having any negative comment. So that is relating to the reporting requirements under 143 subsection 1 and 143 subsection 3. Now we are left with 143 subsection 11, that is CARO 2016 reporting requirements. Let us complete that also. Let us see the reporting requirements under 143 subsection 11 CARO. So explain the provisions relating to responsibilities of an auditor to report under CARO. First of all, let us see to whom 143 subsection 11 will be applicable. That is to whom the CARO 2016 will be applicable. So let us see the first of all applicability. So this order applies to every company including a foreign company. That means a foreign company which is having an office in India, which is having a place of business in India. To that company also CARO will be applicable. If there is a foreign company and there is no place of business in India, then on whom you are going to apply CARO? So if there is a foreign company, for example, there is a US company and that US company is having a place of business in India also, then CARO will be applicable. If there is a US company, there is no place of business in India, then CARO is not applicable. Okay, right. However, it shall not apply to the following class of companies. However, this CARO 2016 is not applicable to specific kind of companies. What are they? It is not applicable to a banking company. It is not applicable to an insurance company. It is also not applicable to Section 8 company, non-profitable organization. It is not applicable to one-person company. It is also not applicable to a small company. And it will not be applicable to private limited companies in some scenarios. So if some conditions are satisfied, then it will not be applicable to an auditor of a private limited company. What are the conditions? Let us see. It should not be a subsidiary or holding company of a public company. It should be a private company. It should not have a holding company which is a public company. It should not have a subsidiary company which is a public company. It should be purely a private company. Neither it's a subsidiary nor its holding should be a public company. A private company which should not have holding company as a public company, or it should not have a subsidiary as a public company. Next, the total paid up share capital and reserves and surpluses shall not exceed 1 crore as on the balance sheet date. Important point. So first point is it should not have a subsidiary, it should not have a holding which is a public company. Next point, total paid up capital and reserves and surpluses. Paid up capital along with the reserves and surpluses shall not exceed how much? 1 crore. And important point here is all the conditions must be satisfied. Not any one condition. If all the 4 conditions are satisfied, then only it will not be applicable to private company. If any one condition is violated, CARO will be applicable. Okay, first point is what? Not being a subsidiary or a holding of a public company, and also the total paid up share capital and reserves and surpluses shall not exceed 1 crore. The total borrowings from banks and financial institutions shall not exceed 1 crore. Here the important line is at any point of time during the financial year. At any point of time during the financial year, your borrowings should not exceed 1 crore. I will explain that later. Let us see the next point also. And the total turnover calculated as per Schedule 3, including revenue from discontinuing operations, shall not exceed how much? 10 crores. So this total turnover also as per Schedule 3 should not exceed 10 crores. So if all the 4 conditions are satisfied, then only CARO will be applicable. Then only CARO will not be applicable. If any one of the condition is violated, then CARO will be applicable. Let us see some special points with regard to calculation. First point, what they are telling. So it should be a private limited company. It should not have a holding company which is a public company. It should not have a subsidiary company which is a public company. For example, there is a private limited, right? It is actually a subsidiary of B limited which is a public company. Is CARO applicable to A private limited? Yes, CARO will be applicable. right? Or it is not having holding, but A Private Limited is having a subsidiary which is B Limited, which is a public company. Is Caro applicable to A Private Limited? Yes, Caro will be applicable. So that is first point, as simple as that. Next, paid up capital and reserves and surpluses. Paid up capital and reserves and surpluses shall not exceed 1 crore. It should be less than 1 crore. If it is 1 crore or more, Caro will be applicable. If it is less than 1 crore, Caro will not be applicable. That means the amount is 99.9999 lakhs. Is Caro applicable? Not applicable. Just 1 rupee, 1 crore, Caro will be applicable. If the paid up share capital and reserves and surpluses, if they does not exceed 1 crore, then Caro will not be applicable. Now, some special points with regard to calculation. Here, paid up share capital, it includes both equity share capital and also preference share capital. See, from these calculations, practical questions may be asked, so that's why please be careful. So, from paid up share capital includes both equity share capital and preference share capital. Now, reserves and surpluses, they include free reserves, revenue reserves, capital reserves, even revaluation reserve also will be included. Even revaluation reserve also will be included. All the reserves and surpluses will be included, whether that could be free reserves, balance, that could be profit and loss balance, credit balance, all has to be included. What if there is a debit balance in profit and loss? What if there is a debit balance in the profit and loss? Okay, let me tell you some illustrations. So the company is having a equity share capital, right? So it is having a equity share capital of 80 lakhs. Reserves and surpluses, it is having some general reserve 30 lakhs, right? And it is having profit and loss debit balance. Debit balance in the profit and loss is 20 lakhs. Now, is Caro applicable? So the act says that you can adjust the debit balance in the profit and loss account against the credit balances. So here you can adjust it. So 20 lakhs debit balance is there. This you can adjust against this credit balance. So now it will be 10 lakhs. 10 lakhs, capital plus reserves and surpluses, 80 plus 10, 90 lakhs. Caro applicable? Caro is not applicable. Okay, let me ask you one more question. So here what I am telling you is the debit balance in the profit and loss account can be set off against the credit balances for the purpose of calculation. Now one more thing, let me ask you one more thing. Equity share capital 1.2 crores, general reserve some 30 lakhs, general reserve 30 lakhs, debit balance in P&L. Debit balance in P&L is 60 lakhs. Debit balance in P&L is 60 lakhs. Is the Caro applicable? So now the main agenda of asking this question is, sir, here reserves having a credit balance of 30 lakhs only, whereas we are having a debit balance of 60 lakhs. Okay, sir, out of this debit balance of 30 lakhs, out of this debit balance of 60 lakhs, I will adjust 30 lakhs against general reserves, against the reserves of credit balances. For example, I am having credit balance in the reserves like revenue reserve, capital reserve, some balance I am having 30 lakhs. So, but the debit balance in the profit and loss account is 60 lakhs. Okay, out of this 60 lakhs, 30 lakhs I will adjust against the credit balances. I will set off against the credit balances. But still, there is other 30 lakhs, no sir. There is still some more debit balance in the profit and loss account. Can I set off it against the equity share capital? Can I set off it against the paid up capital for the purpose of calculation? The answer is yes. The answer is yes. So if you are having debit balance in the profit and loss account, you should first set off it against the credit balances of the reserves. If anything is left out, if still there is more debit balance, you can set off against the paid up capital also for the purpose of the calculation. Okay, so here first 30 out of this 60 lakhs debit balance, 30 lakhs I will adjust against this credit balance of reserves. Again 30 lakhs will be there. This I will adjust against the paid up capital, which is 1.2 crores. So if I adjust this 30, if I set off this 30 lakhs debit balance against this 1.2 crores, my balance would be 90 lakhs only. Now paid up capital plus reserves and surpluses is 90 lakhs only. Is Caro applicable? No. So the main purpose of telling you, highlighting this point is, if you are having debit balance in the profit and loss account, you can set off it against the credit balance of the reserves, and still if the debit balance in the profit and loss account is left out, you can adjust it against the, you can set it off against the paid up capital also for the purpose of calculation of this limit. For the purpose of calculation of this limit. So these are the special points relating to paid up capital and reserves and surpluses, which should be less than 1 crore. Now, third point, borrowings from banks and financial institutions. borrowings from banks and financial institutions should be less than 1 crore at any time during the financial year. Important term, at any time during financial year. What do you mean by this? First of all, let us see some special points regarding to this borrowings. Okay, now coming to borrowings, what are the special points? One second, just give me a moment. Okay, so coming to the borrowings, what are the special points? Let us see. Now, so every borrowing from the bank should be considered, whether it is a short-term borrowing or long-term borrowing. Whether it is a short-term borrowing or long-term borrowing, it is irrelevant. Any kind of borrowing. For example, you have taken overdraft facility, you have taken crash credit facility. Still, these also should be included for the purpose of calculation, right? And one more thing. For example, you are taken overdraft facility by giving security of deposits. You are having an FD with the bank. You have given that as security, and you have availed a overdraft facility. So you are having a fixed deposit FD of some 50 lakhs. Taking this as a security, the banker has given you a overdraft facility of 60 lakhs. So for the purpose of calculation, will you consider this gross amount, or will you consider it after setting of the security? After setting of the security amount. The Act says don't set off directly. Without setting of the security, you have to consider the total balance. Able to understand here what I am telling you is, so the banker has given you a overdraft facility. Why? Because you are having a FD with him. He has considered that as a security and has given you an overdraft facility. So that FD amount is 50 lakhs. On that security, he has given 60 lakhs as OD facility. For the purpose of calculation of this borrowing should be less than 1 crore, you will consider this 60 lakhs or 60 lakhs after adjusting with 50 lakhs. The answer is you have to consider 60 lakhs only. You should not adjust. This is one more special point. Now come to the important term, at any time during the financial year. At any time during the financial year. What do you mean by this? For example, for the year 18-19, on opening day 1/4/2018, the company is having a borrowings from banks and financial institutions of 90 lakhs. On 30th of June, it has taken a additional loan of 30 lakhs. It has taken an additional loan of 30 lakhs. Now, on 31st of January 2019, it has repaid 40 lakhs of loan. It has repaid 40 lakhs of loan. So, as on 31st of March 2019, the closing balance of borrowings from banks and financial institutions is 80 lakhs. Now, is CARO applicable? Is CARO applicable? The answer is yes. Why? Because here, while calculating the applicability, the Act does not say you have to consider the balance as at the balance sheet date. The Act is saying that borrowings should not exceed 1 crore at any time during the financial year. So if you observe here, during the financial year, from 30th of June till 31st of March, the balance of the borrowings is more than 1 crore till 31st of January. See, here 90 lakhs opening balance. You have taken 30 lakhs additional loan. So 1.2 crores as on 30th June. And you have repaid on 31st of January before the closure. As on the balance sheet date, the borrowings are only 80 lakhs. Still the CARO is applicable. Why? Because the Act says you have to calculate the limit not at the balance sheet date, at any time during the financial year. If the borrowings from banks and financial institutions exceeds 1 crore, CARO is applicable. Equal to 1 crore or exceeds 1 crore, CARO will be applicable. So here from 30th of June, even though he has repaid it before the closure of the financial year, for some period of time, the borrowings is more than 1 crore. Even if he repaid on the immediate day, on 1st of July, he repaid this 30 lakhs additional loan, still CARO will be applicable. Why? Because as on 30th of June, your balance is more than 1 crore or not. So even for a single day, if the balance of the borrowings from banks and financial institutions is 1 crore or more, CARO will be applicable. Whereas same logic not applicable to share capital. Share capital you have to calculate. Paid up capital and reserves and surpluses should be less than 1 crore at the balance sheet date. Paid up capital and reserves and surpluses, you have to calculate the limit at the balance sheet date, whereas when it comes to borrowings, the limit should be at any time during the financial year. And finally, fourth point, revenue should be less than 10 crores. So there is no point, there is no logic in discussing at any point or at balance sheet for revenue. Why? Because revenue is a consolidated figure. Whatever the total transactions that have happened during the year, that only we call it as a turnover. Okay. And one more point, what you have to do is sales return has to be deducted. Sales returns has to be deducted from the revenue, and also trade discount also should be taken out. while calculating this turnover, you can exclude sales returns and trade discounts, right? And if the revenue figure is inclusive, if this revenue figure is inclusive of GST or inclusive of service tax or inclusive of excise duty, then that duty also should be excluded. Only when the figure is inclusive. For example, sometimes they may ask you a question like this. So the turnover of the company 10.1 crore, GST accounted separately 20 lakhs. Now, will you deduct this 20 lakhs from the turnover? The answer is no. Why? Because what they are telling you, GST accounted separately. That means what? This is not included in the turnover. It is accounted separately. Then you should not once again deduct it, because they are telling you GST is accounted separately. It is not included in the turnover. It is accounted separately. You need not deduct the GST amount once again from the turnover. When they say the turnover is inclusive of the GST, inclusive of the service tax, inclusive of the excise duty, then only you have to deduct. If they are telling you in the question they are accounted separately, you need not deduct that once again from the turnover. Only you have to deduct when the revenue is inclusive figure, inclusive of the taxes, then you have to deduct, or else you should not deduct. Okay, so for any private company, if all these 4 conditions are satisfied, then CARO is not applicable. All the 4 conditions should be satisfied for the private limited company. For public company, CARO is mandatory. For private company, whether CARO reporting is applicable or not, you have to calculate the limits. And what are these limits? 4 limits, and we have also considered what are the special points in this calculation. Okay, so very much important. Lot of times practical questions are asked from this area regarding the applicability. Okay, so these are all the special points to be kept in mind. What are they? Paid up share capital, what should be included, what should be excluded. Revenue, all revenue should be included. All reserves should be included. Next, revaluation reserve also should be included. Debit balance can be reduced. It can be reduced from the paid up capital also for the purpose of calculation. Next, borrowings includes all borrowings, short term, long term, right? If there is any security, you have to consider excluding that security. Next, gross figure you have to consider, you should not set off. And credit card borrowings also should be included. If the borrowings include credit card borrowings, that is also borrowing only. No, you have used the credit card given by a bank, that is also a borrowing from the bank. You have to consider borrowings from the credit cards also. Next, turnover includes total turnover including discontinuing operations. GST shall be deducted only when it is included. Only when the turnover figure is inclusive of the GST, then only you have to deduct that once again. If it is accounted separately, no need to deduct that once again. And what and all should be deducted? Sales returns, trade discounts also should be deducted. So these are the special limits for the purpose of calculations. Okay, we have seen the calculation, the applicability of the CARO, and what are the points that are to be kept in mind while doing the calculation for the private limited companies. There are some additional points with regard to this applicability. Let us see that. For example, there is a company X Limited. It is having a subsidiary company. It is having a subsidiary which is Y Limited, and it is also having a associate which is Z Limited. X Limited, Y Limited and Z Limited. X Limited is a holding company, Y Limited is a subsidiary company, and Z Limited is an associate company. Now, for determining whether CARO will be applicable or not, are we required to calculate the limits as per consolidated financial statements or standalone financial statements? My question is, so here there is a company X Limited which is a holding company. It is having a subsidiary and it is also having an associate. So this X Limited, while preparing financial statements, it will prepare both standalone financial statements and it will also prepare consolidated financial statements, which includes the information of the subsidiary and associate. Now, for the purpose of calculation, whether we will consider the limit, whether we will calculate the limits as per consolidated financial statements or standalone financial statements, the answer is we have to calculate the limits as per standalone financial statements only. We have to calculate limits as per standalone financial statements only, not consolidated financial statements. So in order to determine whether CARO is applicable for this X private limited company or not, you have to calculate the limits as per standalone financial statements of X Limited. And also Y private limited, whether for this CARO is applicable or not, you will calculate the limits as per Y Limited balance sheet. limited balance sheet and profit and loss, and also whether CARO will be applicable for this associate company or not. You will calculate the limits as per the standalone financial statements of the Z Limited. Okay, and one more thing, we have told that the audit will happen for both standalone financial statements and also consolidated financial statements. We have seen that auditor will give a separate audit report for standalone financial statements, and for consolidated financial statements also auditor will give a separate audit report. Now the Act says, in CARO it says the audit reporting, that means the CARO reporting is not applicable for consolidated financial statements. The audit reporting is not applicable for consolidated financial statements. It is enough if the auditor prepares the CARO reporting for standalone financial statements only. CARO reporting will not be applicable to the standalone financial statements. For standalone financial statements, CARO reporting is not applicable. Okay, it is applicable for standalone financial statements only, and for the purpose of calculation we will consider the limits as per the standalone financial statements, not consolidated financial statements. Now one more additional point. For example, there is a company X Private Limited. It is having so many branches. It is having a head office which is situated at Hyderabad. It is having so many branch offices. So it is having one branch office in Chennai branch. Right? It is having branch in Bangalore. It is having branch in Mumbai. Okay, and some other places. So there is, for Bangalore branch, separately a branch auditor has been appointed. This head office and all other branches are looked after by Mr. A. He is a principal auditor. Okay. For specifically conducting the audit of the accounts of the branch of Bangalore, only for conducting the audit of the Bangalore branch, Mr. B was appointed. Okay, here Mr. B, we call him as a branch auditor. Yes or no? We call him as a branch auditor because he is conducting audit, because he is verifying the books of accounts of only the branch. Whereas Mr. A will be called as a principal auditor. Why? Because he has been appointed as an auditor for the company as a whole. Now the auditor of this principal auditor, Mr. A, he has calculated the limits for X Private Limited and they are complied. X Private Limited is not satisfying the limits, not satisfying those limits. That means CARO is applicable. CARO is applicable to this X Private Limited. So this Mr. A, principal auditor, while preparing the entire audit report on the X Private Limited, he has to include CARO in his audit report. Now there is a branch auditor. Whether CARO reporting will be applicable to this branch auditor also. Mr. A is a principal auditor, so while giving his audit report, he calculated the limits for the entire company. For the entire company, the limits are not met. That means CARO is applicable for the entire company. Like the paid up capital was more than 1 crore, or the borrowings are more than 1 crore, or turnover is more than 1 crore. So some limit was not satisfied. So CARO is applicable for this X Private Limited. So Mr. A, while preparing the audit report of the company as a whole, he included CARO in his auditor's report. Now, whether this branch auditor, is he also required to prepare the CARO in his audit report in respect of that report which he has prepared on the branches? This Mr. B, branch auditor, will prepare audit report exclusively for the branch only. No. So while preparing that audit report, is he required to include CARO 2016? The Companies Act says yes. Is he required to see the limits for the branch also? No. No separate calculation of limits for branch. Once if for the company as a whole CARO reporting is applicable, then each and every branch auditor of that company is also required to include CARO under his branch auditor's report. What is the point here? If for company as a whole CARO is applicable, then every branch auditor, irrespective of calculations at the branch level, every branch auditor has to include CARO in his audit report. Once it is applicable for the company as a whole, each and every branch auditor should include CARO reporting in his auditor's report. Able to understand? So these are two special points which are regarding the applicability of the branch audit, applicability of the CARO. So in case of holding and subsidiary company, it is applicable for standalone financial statements only. It is not applicable for standalone financial statements. It is not applicable for consolidated financial statements. In case of company having branches, if the CARO is applicable from entire company's view, right, including the amounts from all branches but not with respect to each branch, we will calculate for company as a whole, not for branch separately. Once it is applicable to the company once it is applicable to the company as a whole, then each and every branch of the company will be covered under CARO. Therefore, all the branch auditors of the company are also required to report on these 16 matters in their branch audit report of the concerned branches. Okay. Next, what are the matters that are to be communicated under CARO? So as I have told you that under CARO there are total 16 reporting requirements. Under CARO there are totally 16 reporting requirements. Let us see what are those 16 reporting requirements. Right. Next, so 16 matters, let us see one by one. First point is regarding fixed assets. The auditor has to some aspects relating to fixed assets. So what is the matters? Those is required to report as per fixed assets. So in respect of fixed assets, auditor is required to comment upon two things: whether proper records have been maintained, nothing but fixed asset register, whether proper records which shows both quantitative details, that is number of the fixed assets and situation of the fixed assets, whether those records are maintained or not in respect of fixed assets, which are in respect of fixed assets of the company, whether the records of those assets which contains both the quantitative details, quantitative means how many number of fixed assets are there, and also situation, that means location of the fixed assets. So whether those records are maintained or not, that is the first point which auditor has to comment. Whether the company is maintaining proper records showing full particulars including quantitative details and situation of the fixed asset. Next point, whether these fixed assets have been physically verified by the management at reasonable intervals, and also auditor is required to comment whether these fixed assets are regularly verified or physically verified by the management. Auditor should not verify here what auditor has to comment, whether they are physically verified by the management or not at reasonable intervals. What do you mean by reasonable intervals? Reasonable intervals means it depends upon the size of the entity. Okay, but on an average, generally. So in respect of fixed assets, the first reporting requirement is the auditor has to comment whether proper records which contains both quantitative details and also situation of fixed assets is maintained or not. And also the auditor is required to comment whether management has verified these assets regularly, physical verification of assets, whether they are verified or not, the auditor is required to comment. So I am telling you that here reasonable intervals need not be every year, it depends upon the size of entity. For example, for Reliance company reasonable interval may be 5 years, for Infosys company reasonable intervals may be 3 years, for a smaller company reasonable interval may be 1 year. Okay, so as an auditor, the auditor should decide whether it reasonable intervals the assets are physically verified by the management or not. And on such verification, if there are any discrepancies, if there are any differences between the records and the physical assets, how those differences are met in the books of accounts, how those differences are dealt with in the books of accounts. So what do you mean by this? So first reporting requirement is regarding the records. Second reporting requirement is regarding the physical verification at reasonable intervals. Physical verification at reasonable intervals. We have seen that reasonable intervals depend upon the size of the entity. For one entity, reasonable interval may be different from the other entity's reasonable interval. Right? So it depends upon the size of the entity. So depending upon that, so for example, for a company like Wipro or for a company like Infosys, reasonable interval for verification of fixed assets is 3 years. Once in 3 years, the management has to verify all the fixed assets. So whether verified or not, auditor is required to comment. And also on such verification, if there are any discrepancies, differences, that means for example, in the records, in the register of fixed assets, there are 500 fixed assets, but when you physically verify, but when the management has physically verified, there are only 498. So there is a difference of 2 years, difference of 2 assets. Now when analyzed, the management came to know that 2 of its assets are recorded twice. The asset was bought only once, but by mistake 2 assets are recorded twice. So there is a discrepancy between the physical verification and the physical assets and the records. So now how these differences are met? So now what management should do? Now it should write off. Yes or no? What the management should do? Now it should write off. Right? So the auditor is required to comment whether the fixed assets are physically verified at reasonable intervals or not, and on such verification whether there are any material discrepancies found. If found, how they are dealt with in the books of accounts. Next. Third point, what auditor has to comment regarding fixed assets is whether the title deeds of the immobile properties like land, building, etc., whether the title of these land and buildings of these immobile properties, whether they are in the name of the company or not, that the auditor is required to comment. So third point regarding fixed assets, what auditor has to comment? Whether the title of the immovable properties are held in the name of the company, if not, provide the details of the same. So in respect of the immovable properties, there will be title deeds. Whether in that title deeds the name of the company is shown as the owner or not. Right? So title deed should be in the name of the company. If not, what are the immovable properties in respect of which title deeds are not in the name of the company? They have to be identified by the auditor. So regarding fixed assets, three matters. What are they? Regarding proper records maintenance, and second one regarding physical verification, third one is regarding title of the immovable properties. Next, inventories. Regarding inventories, there are some reporting requirements. What are they? So first point, whether physical verification of inventory has been conducted at reasonable intervals or not. Here reasonable intervals means at least once in a year. In respect of fixed assets, reasonable interval depends upon entity to entity, but in respect of inventory, reasonable interval means once in every year. So the auditor is required to comment in his audit report whether the inventory has been physically verified by the management at reasonable intervals, at least once in every year. And on such verification, if there are any discrepancies, if there are any differences between the physical verification and records, inventory records, how those differences are dealt with in the books of accounts, that the auditor is required to comment. Okay, so regarding fixed assets, 3 items auditor is required to comment. Regarding inventories, 2 items. What are they? Whether physical verification of inventory has been done at reasonable intervals or not, and on that physical verification, if there are any material discrepancies, how they are dealt with in the books of accounts. 2 points inventories, 2 points regarding inventories, auditor is required to comment. Next point, loans to directors and interested parties. If the company has given any loan to directors or interested parties, then there are certain reporting requirements of the auditor. So here also loans means loans given by the company. Loans given by the company, not accepted by the company. So here what do you mean by loans? Right. So loans to directors and interested parties. If the company has given any loan to the director or interested parties, there are certain reporting requirements. What are they? First point, whether the company granted any loans secured or unsecured to companies, firms, limited liability partnerships or other parties covered in the registers maintained under section 189 of the Companies Act. So under section 189 of the Companies Act, the company is required to maintain a register which contains the details of the related parties. So as an auditor, you are required to verify whether any loan or advance has been given to the parties covered under section 189. If yes, verify the number of parties. The auditor has to identify to how many parties the loans are given, and also what is the amount involved. Next, whether the terms and conditions are prejudicial to the interests of the company. The terms and conditions on which such loans are given to the related parties, whether they are prejudicial to the interests of the company, that auditor is required to comment. Next, second point, whether repayment of principal and interest and payment of interest has been regularly received on or before the due date. And also as an auditor, you are required to verify, okay, you have given loan to the parties covered under section 189, whether they are repaying the principal on time or not, whether they are paying the interest on time or not, the auditor is required to verify. That is second point. Next, third point, if the amount is overdue, and if such amount overdue for more than 90 days, whether reasonable steps have been taken by the company for recovery of the principal and interest. So, for example, the company has given loan to one of the party covered under section 189, but that party is not repaying the interest and principal. Now, if the amount remains overdue for a period of more than 90 days as on the balance sheet date, the amount remains overdue for more than 90 days, then the auditor is required to comment whether reasonable steps have been taken by the management or not. Okay, so regarding loans and advances, there are 3 points. What are they? Loans to directors and interested parties. So in clause C, there are 3 parties. So if the company has given loans, number of parties and amount involved, the auditor is required to comment number of parties and amount involved. Next, after this, whether the terms are prejudicial, auditor is required to comment on this also. Now, next, whether repayment of principal and interest is made on or before due date, repayment of interest and principal received on or before due date or not, that auditor has to comment. Last point, if it remains overdue for more than 90 days as at balance sheet date, if it remains overdue for a period of more than 90 days as at the balance sheet date, then auditor is required to comment what are the reasonable steps taken by the management. If no reasonable steps have been taken, the auditor will comment the same. The auditor will say the amount remained overdue for more than 90 days, but management has not taken any reasonable steps. If the reasonable steps have been taken, the auditor has to comment what are those reasonable steps. Okay, so this is the third clause. Loans to directors and interested parties. Now coming to the fourth point. So here if you observe, here they are telling you, it should be noted that CARO 2016 consider loans granted but not loans taken. So this third point is regarding loans and advances given by the company, assets of the company, not the liabilities. Next, fourth point. Loans, investments, guarantees made by the company. Fourth point is also relating to loans, investments or guarantees made by the company. So regarding in this point, what are the reporting requirements? In respect of loans, investments and guarantees and securities provided by the company, whether the provisions of section 185 and 186 have been complied with. If not, provide the details thereof. So if the company is giving any loan or making any investment or giving any guarantee, there are certain conditions, there are certain terms and conditions which are required to be followed, which are mentioned under section 185 and 186. As an auditor, you have to verify if the company has made any loan, given investment or made any guarantees, whether the provisions of section 185 and 186 are complied with or not. The auditor is required to comment. Next point is relating to deposits. What are the reporting requirements here? In case the company has accepted the deposits from the public. So in case for the client for which you are conducting the audit that has accepted the deposits from the public, then the auditor has to verify compliance with provisions of the Companies Act, section 73 to 76. Whatever the provisions are there relating to deposits, whether they have been met or not, auditor is required to comment. Next. And if there are any directives, if there are any instructions issued by the RBI regarding the acceptance of deposits, whether they are met or not, that auditor has to verify. And finally, if there is any order passed by the company law board or any court or other any tribunal, whether all these conditions are met or not, the auditor has to verify. If the company has accepted deposits from the public, the auditor has to comment whether the provisions of section 73 to 76 of the Companies Act are complied with or not, whether the directives issued by the RBI are complied with or not, and also if there is any order relating to that deposit which is passed by company law board or any court or tribunal, whether all these requirements are met or not, auditor is required to comment. If there is any non-compliance, the nature of contravention should be stated. If any non-compliance of the above items, the auditor should mention what is the nature of contravention. That is relating to deposits. Next, sixth point, regarding cost records. So in this, the auditor has to verify whether the provisions which are mentioned under section 148. So we have discussed that every company is not required to maintain cost records. The company which satisfies the criteria mentioned under section 148, only those companies are required to maintain cost records. So as an auditor, you have to verify whether the provisions of section 148 are applicable. If applicable, whether the cost records have been made or not. The auditor has to comment whether provisions of section 148 are applicable. If applicable, whether the cost records are maintained or not, auditor is required to comment. Next important point is regarding statutory dues. First of all, what do you mean by statutory dues? The amount which statutory dues means the amount which we are required to pay because there is a regulatory or statutory or a requirement by law. We are paying some amount. Why? Because there is a requirement under law to pay such amount. We call such an amount as statutory dues. Okay, so statutory dues means amount which is required to be paid as per the requirements of the law, like income tax, GST, PF, gratuity, ESI. All of them are what we are paying. Why? Because there is a separate law which requires us to pay this amount. We are paying this amount because Income Tax Act is required, because under Income Tax Act, if we are making an income, we are required to pay the tax. We are paying GST because the GST law requires us to pay the GST. PF Act requires us to pay the PF. Gratuity Act requires us to pay the gratuity. So all these expenses are examples of statutory dues. These amounts we are paying because it is a requirement of a law. Right. So regarding statutory dues, the auditor is required to have, the auditor is having some reporting requirements, and these reporting requirements are separate for undisputed dues and disputed dues, disputed statutory dues. Sir, what do you mean by disputed or undisputed? Undisputed means what? The department, some regulatory authority wants us to pay some amount, and we are not disputing, we are agreeing with that. Then what do you mean by dispute, sir? That means we are challenging the regulatory requirement. We are challenging the regulatory authority. For example, so GST department has sent a notice to pay some 80 lakhs of GST. But we are telling that we are not required to pay 80 lakhs. Our liability is 40 lakhs only. So the case is going on before the assessing officer or some court of law or some tribunal. So then we say there is a dispute. We say there is a dispute when we are not agreeing with the regulatory authority, when we are having some dispute with the regulatory authority regarding the amount of the statutory dues. Right? So statutory department is telling some other amount, but whereas I am telling no, I don't want to pay that, I am not required to pay that much of amount, my liability is actually lesser. So this case is going on between GST department or some court of law or some tribunal, the case is going on. So such kind of statutory dues are called as disputed statutory dues. If on the other hand, okay, income tax department has sent me a notice to pay 10 lakh rupees of income tax. Okay, I also agree. So this is what I am not fighting. Just income tax has sent me a notice that doesn't involve dispute. I am agreeing to that notice. I am not challenging that notice. Then I say it as undisputed due. So whereas the income tax department has sent me a notice to pay 10 lakhs of income tax liability, but I am sending an objection that I am not required to pay 10 lakhs. My actual tax liability is 5 lakh rupees only. Then I say there is a dispute. Okay, so regarding undisputed items, there is some reporting requirements. Regarding disputed statutory dues, there is some reporting requirements. So regarding undisputed statutory dues, what are the reporting requirements? The auditor has to comment whether the company is regular in depositing the statutory dues. That means whether these undisputed statutory dues are paid on time or not. Whether these undisputed statutory dues, whether they are paid with the regulatory authorities on time or not, the auditor is required to comment. So if you observe here, in respect of undisputed dues, is the company regular in depositing undisputed statutory dues? Example, provident fund, ESI, income tax, service tax, or any other statutory dues with the appropriate authorities. Is the company is regular in depositing? That is, whether it is depositing within due date or not. If not, if they are not regular in depositing, if they are not depositing the statutory dues on time, the extent of the arrears of outstanding statutory dues as at the last day of the financial year concerned for a period of more than 6 months from the date. More than 6 months from the date they become payable shall be indicated by the auditor. So what is that they are telling you here? If they are not paying the amount, if they are not depositing the statutory dues on due dates, and if any amount is overdue for a period of more than 6 months, it has remained overdue for, it has remained unpaid for 6 months as on the balance sheet date. So what do you mean by this? Let me tell you with the help of example. So there is a income tax liability. Actually the due date for this is 31st March. Sorry, the due date for it is 31st of January 2019. Okay, so we are conducting audit for the financial year 18-19. So there is some income tax liability, assume TDS liability only. So for example, consider the due date as 31st of January 2019. Right, the company is not challenging. The company has accepted that notice amount also, but it did not pay. As on 31st March 2019 also, it remained unpaid. Is it required to be reported? The answer is no. Why? Because here what they are telling, if not, the extent of the arrears of outstanding dues as at the last day of the financial statements, that means as on the balance sheet date, concerned for a period of more than 6 months, if they remain unpaid for a period of more than 6 months as on the balance sheet date, from the date they became due till the balance sheet date, if the period is more than 6 months, 6 months or more, then only it requires reporting, or else no reporting is required. So if you observe here, the due date is 31st of January 2019 and the balance sheet date is 31st of March 2019. Till now they have not yet paid. Is it required reporting? No. Next. Take other example. For example, the due date is 30th of August 2018. It remains unpaid till 31st of March 2019. Now is it required to be reported? Yes. Why? Because as on the balance sheet date, it remained, this undisputed statutory due remained more than a period of 6 months unpaid. So this required to be reported. So regarding undisputed statutory dues, two matters the auditor is required to comment. One, is the company regular in depositing the undisputed statutory dues? Okay. If not, if any amount remains unpaid for a period of more than 6 months as on the balance sheet date, from the date it becomes due, those matters are required to be those matters are required to be reported. So this is the reporting requirements of statutory dues. In respect of disputed statutory dues, that means some case is going on regarding the dispute. So with regard to that, what are the reporting requirements? The auditor has to comment what is the forum where it is pending and what is the amount involved. What is the forum where the case is pending and what is the amount involved? For example, income tax 80 lakhs you did not pay. Why? Because a case is going on. Where is the case pending? Is it pending before the assessing officer? You have to say it is an income tax liability. It is pending before assessing officer and amount involved is 80 lakhs. Some GST you have not paid. Why? Because it is pending with the High Court. Some case is going on regarding that. So what is the amount involved? Some 30 lakhs. Next, PF, you have not paid. Why you have not paid? There is some dispute going on. What is the forum where it is pending? It is pending before Supreme Court. What is the amount involved? 20 lakhs. Like this, you have to give the reporting requirements. In case of disputed statutory dues, the auditor has to comment on two things: forum where it is pending and what is the amount involved. What is the court, a tribunal or whatever, what is the forum where the case is pending and what is the amount involved in that dispute. That's all. That is regarding the statutory dues. So undisputed we have seen. Disputed dues. In case dues have not been deposited on account of any dispute, some dispute is going on, that is the reason why you have not deposited the amount. Then what and all auditor shall indicate? The amount involved in the dispute. What is the amount that is involved in the dispute? Next, the forum where dispute is pending. What is the forum where the dispute is pending? Like High Court, Supreme Court, Tribunal, whatever. Next, a mere representation to the concerned department shall not constitute a dispute. For example, you are doing something regarding GST calculation, you got some doubt. So there is some oil, coconut oil. I am just telling you an example. So there is some coconut oil. So the coconut oil will be used for edible purposes and it is also for used for cosmetic purposes. Right? So you got a doubt whether you have to charge GST under coconut oil or under edible oil or cosmetic product అయితే ఒక GST rate ఉంది, edible product అయితే ఇంకో GST rate ఉందండి. Cosmetic product is having one GST rate, edible oil is having one GST rate. You got a doubt, you don't know how you have to classify it. You have to classify it as a edible oil or to classify it as a cosmetic product. You are not able to identify, you are not able to judge. So what you have done was, you made a representation to the department, some assessing officer you have consulted. Sir, I am dealing in the coconut oil, so this oil will get covered under both edible oil and also it will be covered under the cosmetic product also, sir. Sir, what am I supposed to do, in which I have to classify? So like that, you have some doubt, you consulted some officer for representation. A mere representation was made. Can we consider this as a dispute? Can we call this as a dispute? This is not a dispute. A mere representation to the concerned department shall not constitute a dispute. You have got some doubt, you went to the assessing officer or some regulatory authority for clarification. You have made a representation, that cannot be considered as a dispute. Okay? Right. So this is the reporting requirements for statutory dues. Next, default in repayment of dues. Next point is relating to default in repayment of the dues. So if the company has taken any borrowings from financial institution, bank or debenture holders. So what is that here reporting requirement? If the company has taken any borrowing from financial institution, bank or debenture holders and it has a defaulted in repayment. Default means what? It has not paid the amount within the due date. Here they are telling you about loans, liabilities of the company, not loans given by the company. Borrowings accepted by the company. If the company has accepted any borrowing from a financial institution, bank or a debenture holder and it has made any default in the repayment, right? So the auditor has to comment on that. If yes, the default is made, the period and amount of default to be reported each lender is important. If the company has made any default in making payment to the financial institution, bank, then it has to prepare a report. What is the amount and what is the period of default? The auditor shall prepare a report each lender wise. For example, the company has taken loans from so many banks. It has defaulted for all the banks. The auditor has to give the details. What is the, for each bank, what is the period of default, what is the amount of default and bank name. So lender wise they have to prepare the report. Those are the reporting requirements in case of repayment of dues. Next, application of funds. One more important point. So if during the year for which you are conducting the audit, the company has made an IPO or FPO, it has made an initial public offer or further public offer by which it has raised the money. So whenever you raise the money, you will tell the purpose. You will generally issue the prospectus and in that prospectus you will mention what is the purpose for which you are raising this money. So as an auditor, if you have to verify if the company has made any IPO or FPO, whether it has been utilized for the purposes for which they have been raised or not. Whatever they have told the purpose. For example, the company has made an IPO. In prospectus, it has told that they want to raise the capital for the purpose of expansion. But after raising the money, they are using it for repayment of the borrowings. Is the auditor required to comment or not? Yes, the auditor is required to comment. Okay, so whether the money raised by way of initial or further public offer, including debt instruments, And term loans, even loans, you have taken a banker stating some other purpose, but you are actually utilizing for some other purpose. We are utilizing for the purposes for which those are raised or not, for whatever purpose that you have told for the purpose of raising the loan, whether the amount has been utilized for that purpose only or not. If not utilized for the purpose for which you have raised, the auditor has to give the details of default. For what is the default that you have made, and what is there any delay. You have told that we are going to utilize this amount for so and so purpose within this time, but you have delayed it. That delay details also you are required to comment, and also subsequent ratifications if any to be reported. If there are any subsequent ratifications, that means what? Subsequent rectifications. So that means what? So let me tell you one example. So for example, the company has raised 10 crore rupees for IPO for the purpose of expansion. So all of a sudden it has got working capital requirement. Immediately there is a working capital requirement of 2 crores. So what they have done was, whatever money they have raised for the purpose of expansion, out of that 2 crores they have used for working capital. So there is a default. But subsequently within 2 or 3 days it has arranged an alternative source and brought it back. So for urgent purpose, what they have done is they have utilized it for some other purpose, but subsequently they rectified it. Subsequently they got some alternative arrangement and they brought back this 2 crores for the purpose of expansion. So here what happened? A rectification has happened. First it has been utilized for other purpose, then it has been subsequently rectified. The details of such rectifications also should be reported. Okay, so regarding application of funds, 2 points: whether it has been utilized for the purpose for which it has been raised or not. If not, the details along with the defaults, delays and subsequent rectifications if any to be reported. Next, reporting of the frauds. Auditor is required to report on frauds also under CARO. What are they? Whether any fraud by or on the company. If any fraud is committed in the company or fraud has been committed in the name of the company on outsiders, both are included. Whether any fraud by or on the company, someone has committed a fraud, or in the name of the company some outsider has been defrauded, both will be included. Whether any fraud by or on the company by its officers or employees has been noticed or reported during the year. If any fraud has been noticed or actually reported, right? So here reason to believe is not sufficient. Here the fraud should have been noticed or reported, some proven fraud, right? So if any fraud has been noticed or reported which has been committed by the company or on the company by its officers or employees, the auditor is required to comment on that. If yes, the nature and amount involved. What is the nature of the fraud and what is the amount involved? The auditor is required to comment. Okay, simple. Next, managerial remuneration. Regarding managerial remuneration, the company cannot pay whatever amount it requires as a managerial remuneration. Certain provisions, certain rules and regulations are there in section 197 and schedule 5. So as an auditor, you are required to see whether in paying the managerial remuneration, whether the provisions of section 197 and schedule 5 are complied with or not. If any amount has been paid in excess, so they will say some 11%, so and so, no. So if any amount has been paid in excess of that amount, in excess of limit permitted under section 197, the auditor has to comment what are the steps involved, what is the amount that is paid in excess, and what are the steps taken by the company for refund of that amount, for getting the refund of that amount. Auditor is required to comment. Next, Nidhi company. Nidhi company means what? A kind of chit fund business. So if you are conducting an audit of a Nidhi company, you are required to comment on 2 points. What are they? Whether the Nidhi company is required to have a net owned funds to deposits ratio of 1:20. Nidhi company is required to have a net owned funds to deposits ratio of 1:20. That means if it is having a own funds of 1 rupee, it can accept a maximum deposit of 20 rupees only. So whether this ratio requirements are met or not, as an auditor, you are required to comment. And the Nidhi company should maintain out of its deposits 10% in an unencumbered term deposits, and without any charge it has to keep under some term deposits. Okay, unencumbered means without any charge. So if you are conducting an audit of a Nidhi company, you have to see whether the net owned funds to deposits ratio is 1:20 or not, and out of its total deposits, minimum 10% has been kept in unencumbered term deposits or not. Auditor is required to comment. For example, for the company for which you are conducting audit is not a Nidhi company, then what you will say? The company is not a Nidhi company. That's all. Over. If it is not a Nidhi company, you will say the client which you are conducting audit is not a Nidhi company. That's all. Next. Related party transactions. So if there are related party transactions, the auditor has to comment on 2 things: whether all the provisions of section 197 and 188 are complied with or not. If you are entering into a related party transaction, you are required to comply with the provisions of Companies Act which are contained in section 177 and 188. So as an auditor, you have to check whether these requirements are met or not, and also there are some accounting standards which require you to disclose some information whether the information has been disclosed in the financial statements as per the applicable accounting standards or not, auditor is required to comment. Next point is regarding preferential allotment or private placement. That means what? The shares will be allocated to a specific number of persons. Only to specified persons the shares will be allocated, not to the common public. We call it as preferential allotment. So if during the year you are conducting audit, any preferential allotment has happened, then what has to be done? So the auditor has to comment on two things: whether the company has made any preferential allotment or private placement of shares or fully or partly convertible debentures during the year under review. For which year you are conducting the audit, or during that year if the company has made any preferential allotment of shares or debentures. If so, if yes, they have made a private placement, then the auditor has to verify compliance with section 42. Companies Act section 42 contains regulations relating to preferential allotment. Whether those rules and regulations are met or not, auditor is required to comment. And auditor is also required to comment what is the amount raised and what is the purpose. What is the purpose for which they have been raised, and whether they are utilized for that purpose or not, auditor is required to comment. Okay, so whenever there is a preferential allotment or private placement of shares, the auditor has to verify compliance with provisions of section 42, and also the amount, whether it has been utilized for the purpose or not, the auditor is required to comment. And also, if not, provide the details in respect of amount involved and nature of non-compliance. No, the amount is not utilized for the purpose, or there is no compliance with section 42, the auditor has to comment what is the amount involved and what is the nature of non-compliance. Next, 15th point, non-cash transactions. So if there are any non-cash transactions between the directors and the company, the auditor has to comment what are the non-cash transactions and whether the provisions of section 192 are complied with or not. So when you are entering into non-cash transaction with the director, there are certain rules and regulations which you have to follow as per section 198. So whether those provisions are met or not under section 192, the auditor is required to comment whenever there is a non-cash transaction between the director and the company. Next, finally, non-banking financial institution. If you are conducting audit of any NBFC, you have to see whether it is required to be registered under section 45 IA of the Reserve Bank of India Act. Okay, so if there is certain criteria, if that criteria is met, certain NBFCs are required to register with the Reserve Bank of India. If you are conducting an audit of an NBFC, you are required to see whether your company is required to register under section 45 IA. If yes, you are required to be registered, whether it is registered or not, auditor is required to comment. Okay, if the client for which you are conducting it is not an NBFC, what you will say? You will say that the client is not a non-banking financial institution. It does not require any registration. That's all. Okay, so these are all the 16 points which an auditor is required to comment under CARO. What is the first one? First one is fixed assets. Second one inventory. Third one loans to directors and interested parties. Fourth point loans, investments and guarantees. Fifth point is relating to deposits. Sixth point is relating to cost records. Seventh point is relating to statutory dues. Eighth point is relating to default in repayment of dues. Ninth point application of funds. 10th reporting of frauds, managerial remuneration, Nidhi company, related party transactions, preferential allotment, non-cash transactions and NBFCs. So all points are not that important. The main important points are right. Fixed assets is important. First 3 points are important. After that, deposits is also important. Statutory dues, very important. Right. Allotment of shares, application of funds, that is also important, and preferential allotment. That's all. All these clauses are very much important. Other than that, not much asked in the examinations. Now, the question may come, sir, under 143 subsection 1, 143 subsection 3, we have told that under 143 subsection 1, reporting requirements will be applicable only when there is a negative comment. Under 143 subsection 3, reporting requirements are applicable even though it is a negative answer or positive answer. Right? Similarly, under CARO 2016 also, all the above points are required to be reported whether it is a positive comment or negative comment. Okay, reporting under these matters is mandatory, whether it could be positive answer or negative answer. If you are giving a negative answer, you should also tell what are the reasons why you are giving a non-satisfactory answer, right? So this is regarding the CARO. So most of the time the questions are asked from applicability. If they want to ask you about the clauses, they will ask you from the important clauses which I have told. Okay, so this is regarding CARO. With this we have completed audit reporting chapter completely. So we have discussed 4 standards: SS 700, 701, 705, 706. Then we have discussed report on other legal and regulatory requirements, reporting requirements of auditor under Companies Act 143 subsection 1, 143 subsection 3 and 143 subsection 11 CARO. Okay, so these are the reporting requirements of the auditor under the Companies Act. Now, so since we have completed audit reporting, now let us discuss about SA 299. Joint audit of the financial statements. Let us discuss about standards on auditing SA 299. Joint audit of the financial statements. First of all, let us try to understand what do you mean by joint audit. Okay, So the meaning of the term joint audit means if for the same client, if for the same entity, for the same financial year, for the same scope of work, if more than one person is appointed as an auditor, if more than one firm of auditor is appointed as an auditors, then we say as joint auditors. If for the same financial year, for the same entity and having the same scope of work, for a single year, for the same entity, for the same scope of work, if more than one auditor is appointed as if more than one auditor is appointed to conduct the audit of a company, then we audit of the entity, then we call that concept as a joint audit, right? So more than one auditor. Sir, what do you mean by this more than one auditor? Right, for example, let me give you some examples. So there is a company X Limited. For this company X Limited, XYZ and Co, a firm of chartered accountants has been appointed. In this firm, there are three partners, Mr. X, Mr. Y, Mr. Z. There are three partners. This firm of chartered accountants has been appointed as auditor of the company. Can we call this as a joint audit? Can we call this as a joint audit? We cannot call this as a joint audit. Why? Because here what we are telling, the appointment is done for more than one auditor. Here you have appointed one auditor only, one firm of chartered accountants was only appointed. That firm of chartered accountants may contain many number of partners, but you have not appointed partners separately. You have appointed a single auditor, single firm as an auditor. So if you appoint a firm of chartered accountants which contains any number of partners, it cannot be called as a joint audit. There can be any number of partners, but you have appointed only one firm. It is not a case of joint audit. Now, so then what do you mean by joint audit, sir? For example, there is a company X Limited, ABC and Co. ABC and Co. It has been appointed as joint auditor. It has been appointed as a statutory audit. It has been appointed as a statutory auditor. There is other firm PQR and Co, sir. It has been appointed for tax auditor. It has been appointed. This firm of chartered accountants has been appointed for tax auditor. So ABC and Co has been appointed as a company auditor. PQR and Co has been appointed as a tax auditor for the same company. Can we call them as a joint audits? Can we call them as a joint auditor? No. Why? Okay, two persons are appointed, same entity, okay, but scope is different. But what? Scope is different. The scope of statutory auditor will be different. The scope of tax auditor will be different. We cannot call them as a joint auditors. Why? Because there is a different scope of work. Now let me tell you one more example. There is a company X Limited, right? There is a firm ABC and Co. It has been appointed as a principal auditor. It has been appointed as a principal auditor. There is a person, Mr. X, a practicing chartered accountant. He has been appointed to conduct the accounts, to conduct the audit of one of the branch. So he is called as a branch auditor. So same entity, two auditors. Can we call them as a joint auditors? Can we call them as a joint auditors? The answer is no. The answer is no. Why? Because here also scope is different. The principal auditor scope of work is entire company, whereas the branch auditor scope of work is only with respect to a specific branch only. So here also scope is different. So we cannot call them as a branch auditor. We cannot call them as a joint auditors. Now next, take other example. There is a company X Limited. ABC and Co, a firm of chartered accountants has been appointed as company auditor. There is a other firm PQR and Co. It has also been appointed to conduct the company audit only. Both firm of chartered accountants have been appointed as a company auditor for the same client. The scope of work is also same. Both are appointed for conducting the statutory audit of the company only. Can we call them as a joint auditors? Yes. Yes. Now let me tell you other example. X Limited, ABC and Co, a firm of chartered accountants has been appointed as company auditor, and Mr. X, a practicing chartered accountant, has also been appointed as a company auditor for the same financial year. Here financial year is also same for the 18-19 financial year, for the 18-19 financial year, for the same financial year, for the same scope of work. Both are doing the company audit only. A firm of chartered accountants and an individual, separately individual has been appointed. Can we call them as a joint auditors? Yes, we can call them as a joint auditors. Here also two auditors, one firm, In the previous example, two firm of auditors, two partnership firms have been appointed. In this example, one firm of chartered accountant and one individual practicing chartered accountant has been appointed to conduct the same scope of work. We also call them as a joint auditors. Take other example, X Limited. For the financial year 18-19, Mr. X, an individual practicing chartered accountant, has been appointed as a company statutory auditor. Mr. Y, another practicing chartered accountant individual, has been appointed to conduct the company audit. Same scope, same financial year. Can we call them as a joint auditor? Yes. We can also call them as a joint auditors. So we call a concept of joint audit. The meaning of the term joint audit is for the same entity, for the same financial year, and for conducting the same scope of work. If more than one person has been appointed as an auditor, we call them as joint auditors. We call them as joint auditors. These more than one firm can be more than one firm can be more than one form of auditors, or more than one practicing chartered accountant, or combination of practicing chartered accountants and a firm of chartered accountants. It could be anything. This we have seen. Okay. So Reliance company is having a joint auditors. Why? Because two persons are going to sign the auditors report. Two persons are going to sign the auditors report of Reliance company. SBI is having 14 joint auditors. SBI is having how many joint auditors? 14 joint auditors it having. So the audit report of the SBI company will be signed by 14 joint auditors. See, if you appoint the branch auditor is not going to sign the company's auditor's report. Only principal auditor will sign. For example, you have appointed one auditor for entire company. For one specific branch, one branch auditor was appointed. Now for company as a whole, an audit report will be generated by the principal auditor. In this auditor's report, only principal auditor signature will be there. There will not be branch auditor. Whereas in the case of joint audit, all the joint auditors are going to sign the auditor's report. In the case of joint audit, all the joint auditors who have been appointed for conducting the same scope of work, all of them are going to sign the auditor's report. Andaru kuda sign chestaru. All the joint auditors will sign. Whereas a branch auditor is not going to sign on the company's auditor report. Only principal auditor will sign. Whereas in the case of joint audit, all the joint auditors will sign the audit report. So as I have told, so in case of Reliance company, there are two joint auditors. In case of SBI, there are 14 joint auditors. 14 people have been conducted to report on the financial statements of SBI. Right? So like this, when more than one person has been appointed for conducting the same scope of work for the same financial year, we call them as a joint auditors. Right? So when joint auditors have been appointed, when more than one auditor has been appointed to conduct the audit of any entity, what should be his responsibilities? What are the responsibilities of the joint auditors? What are the responsibilities between the joint auditors? What they are supposed to do? What are their responsibilities? Those all will be dealt in SA 299. We are going to discuss about the contents of the SA 299. So we have seen the examples of the joint audit. So what do you mean by joint audit? When more than one person, when more than one auditor has been appointed to conduct the audit of the same entity for the same financial year and also having the same scope of work, we call them as joint auditors. So we have seen examples also when we call as a joint audit, what and all, right? Next. So what is the why clients will go for joint audit? What is the advantages? Right, what are the advantages? Nothing but the work will be shared. So if you assume a Reliance company, it is having so much extent of operations, and this Reliance company, if a single auditor has been appointed, there may be some scenario where he will not be able to complete the entire audit. So that's why in order to cover the workload, in order to share the workload, joint auditors will be appointed. So see here some of the advantages of the joint audit: sharing of expertise, mutual consultation. If one of the joint auditors got any doubt, he can consult with the other joint auditor. So mutual consultation will be there. Lower workload will get reduced. Better quality of performance. If more than one person is conducting the work, their quality will be improved, and also improved service to the client. Ultimately, the client is going to get benefited because his service will be increased. Service will be improved. Next, a sense of healthy competition towards a better performance, and it will increase the competition among the joint auditors. Next, general disadvantages. So always the advantages comes with the disadvantages also, no? So what are these general disadvantages? Fees being shared. So earlier, if a single auditor has been appointed, we used to pay a fees of 1 lakh. Now if we want to appoint 2 auditors, what we will do? So we will reduce the fees. Why? Because work is reduced. No. Now the other auditor is also sharing your work. So not exactly we will make half. We will give 70,000 to one joint auditor and 70,000 to other joint auditor. right? So this is a disadvantage from the auditor's perspective, the fees being shared. Psychological problems where firms of different standing are associated in the joint audit. So for example, there are two kinds of firms. One firm is very much risk averse, it does not want to take any risk at all, it always ensures to be in the safe position, whereas there is other kind of firm, its nature is such that it is always risk taking, it is always taking risk, right? They are willing to take more risk. So when these two psychological background firms have been appointed for conducting the same audit, there will be lot of problems, there will be lot of conflicts between them. One joint auditor may not agree with the other joint auditor. So like that, these problems may arise, psychological problems may arise, and also general superiority complexes of some auditors. So some auditors may have some ego feelings. They will feel that why should I listen to the other joint auditor? I am also a chartered accountant, he is also a chartered accountant. Why should I believe him? Or why should I rely on him? So there could be some superiority complexes or problems of coordination. Work may not be coordinated. Areas of work of common concern being neglected. So if there is any common area, they will ignore. So they will think that one of the joint auditor will think this will be covered by the other joint auditor. Other joint auditor thinks that that area will be covered by this joint auditor. So both of them thinking in that way, they will ignore certain areas. And also uncertainty about the liability for work done. There will also be sometimes, if the other joint auditor fail to do the work, sometimes you may also be held responsible, right? So there will be responsibilities, uncertainty about the liability for the work done, right? Next, what will be the responsibilities of the joint auditors? Let us see, right? So joint auditors responsibility will be broadly two types. Responsibility of joint auditors. There will be specific responsibility, there will be joint responsibility. See, as we have seen, the main purpose of having a joint auditors is sharing of work among the joint auditors. The main purpose of having the joint audit is sharing the work among the joint auditors. Joint auditors are not appointed with a view that first one auditor will complete the work, once again the other auditor will do it once again. Not that. So for example, two joint auditors appointed, so it doesn't mean that first A will complete the work, B will also do the work completely. No, then there is no purpose of having the joint audit only. So joint audit, the main purpose is the joint auditors who are appointed, they will share the work among themselves. They will share the work among themselves. Sir, how the work is going to be shared, sir? There are so many ways in which the work can be shared. What are the examples? For example, they can be shared on the basis of items of financial statements. They can be shared on the basis of items of financial statements. So two joint auditors are appointed. So Mr. A is telling I will look after the assets. Mr. B is telling I will look after the liabilities. Mr. A is telling I will look after incomes. Mr. B is telling I will look after expenses. So on the basis of items of financial statements, the work among the joint auditors can be separated, can be divided. Or on the basis of geographical locations. On the basis of what? On the basis of geographical locations also the work can be shared. For example, it is having places of business in so many states. X Limited, it is having place of business in so many states. Andhra, Maharashtra, Telangana, Tamil Nadu. Right? So two joint auditors are appointed for this firm. So joint auditor A is telling I will look after Andhra and Maharashtra geographical locations. Mr. B joint auditor is telling I will look after Telangana and Tamil Nadu states. Okay, so like this, on the basis of geographical location also the work can be divided. It can be divided on the basis of period of financial statements also. It can be divided on the basis of period of financial statements. First 6 months I will look after, second 6 months I will look after that. So like that, on the basis of period of financial statements also the work can be divided among the joint auditors. And finally, it can also be divided on the basis of units or productions. So for example, a company is X Limited is producing so many products, A, B, C, all these are different varieties of the products. So Mr. A, B, C, D, 4 kinds of products it is producing. Joint auditor is telling I will look after these 2 products. Joint auditor B is telling I will look after these 2 products. So the work can also be divided on the basis of units. So X Limited is producing 4 kinds of products. So joint auditor A is telling he is look after A and B products, and joint auditor B is telling he is look after the products C and D. So like that, on the basis of units or productions also the work can be shared. So what if this work is shared? So for example, ignore all this. Okay, these are all different examples. Sir, for example, auditors have shared the work, sir. Auditors have shared the work among themselves. So there is a entity X Limited. So they have shared work on the basis of locations. Okay, so there are two joint auditors, Mr. A, Mr. B. Mr. A told that he is going to do some 2 locations, Mr. B is going to do some 2 locations, right? So as I have told that when joint auditors are appointed in the joint audit, in the audit report, all the joint auditors will sign. So for example, both of them have done the audit and have given a report. Both of them agreed that unmodified opinion is appropriate. They have given an unmodified opinion. Okay, so Mr. A is looking into Andhra and Telangana locations, B is looking into Tamil Nadu and Kerala locations. So subsequently, after giving the opinion, a mistake has been found out. The mistake was found out in this Andhra location, in the geographical location which is looked after by the joint auditor A in Andhra location. In that location, a certain fraud was identified. Certain fraud was identified. So now, who will be held responsible? Will both the joint auditors will be held responsible, or the person who has looked after this A branch will be held responsible? So the standard says that SA 209, there will be specific responsibility of the auditor if any work has been allocated between them and properly documented. Right? So the joint auditors have shared the work among themselves on some reasonable basis, on some appropriate basis. The joint auditors have shared the work among themselves on some reasonable basis. Like in our example, they have shared the work on the basis of geographical location, and they should document it. Document means what? Both the joint auditors will sit together, they will list out the work, they will write the name, this is responsible for so and so person, and at the bottom they will sign, and each one will keep a copy. So that is meant by documentation. If the work has been properly segregated and it is properly documented, then each joint auditor will have a specific responsibility only with respect to the area which he has verified, which was allocated to him. What is that here they are telling? If the work is divided and it is properly documented, each joint auditor will be held responsible only for the area of the work which he was allocated. So here we are telling that A and B have been divided their work on the basis of geographical location, and they have given an unmodified opinion. Subsequently, a fraud was found out. That fraud actually happened in the location of Andhra Pradesh, which has been looked after by the joint auditor Mr. A. In this case, Mr. A only will be held responsible, Mr. B will not be held responsible. If the work is divided on some reasonable basis, there will be specific responsibility. Now, there will be joint responsibility in some cases. What do you mean by joint responsibility? Joint responsibility, in some areas, joint responsibility will be there. That means all the joint auditors will be held responsible. In some areas, all the joint auditors will be held responsible. What are those areas? If any work has not been allocated among themselves, which they have not divided. For example, they have divided incomes, expenses, assets, liabilities they did not divide among themselves. That means what? The work which was not allocated to the joint auditors, in respect of that work, all the joint auditors will have a responsibility. So while dividing the work, they did not divide the work relating to the liabilities. That means what? In the liabilities area, all the joint auditors will be held responsible if in future something goes wrong. Right? And if any matter has been brought to the notice of all the joint auditors, so there is some mistake in some other area, right? So one second, I will tell you. Right, for example, there is a mistake in A branch, Andhra Pradesh branch, which is looked after by Mr. A. There is some misstatement in this area, and this has been brought to the notice of B also, all the joint auditors. For example, I have told that in case of SBI, there are 14 joint auditors. So one of the joint auditor has found some misstatement and he has brought it to the notice of all the joint auditors. Andaru joint auditors ki kuda chepparandi aa mistake gurinchi. So if regarding to some misstatement which has been brought to the notice of all the joint auditors, then also all the joint auditors will be held responsible. If any matter which comes to the notice of all the joint auditors, and in that matter if any subsequently some misstatement has been found out, the auditors have given an inappropriate opinion, even though they know about the misstatement, it came to the notice of all the joint auditors, then also in that area all the joint auditors will be held responsible. And any decision taken by all, if all the joint auditors are sitting together and taking a decision regarding some item, so in future with regard to that item, if any misstatement happens, then also all the joint auditors will be held responsible. Any decision which is taken by all the joint auditors, if any decision has been taken by all the joint auditors, then every joint auditor will be held responsible. Next. Right. And also, whether the financial statements are having advocate disclosures as per applicable financial reporting framework or not. Whether the financial statements are having advocate disclosures as per applicable financial reporting framework or not, that also is required to be reported. That is also the responsibility of all the joint auditors, whether the financial statements are complying with the disclosure requirements as per the applicable financial reporting framework or not. That has to be ensured by each and every joint auditor. Next, and also whether the audit report that has been prepared by all of them is complying with the standards on auditing or not, that is also a responsibility of all the joint auditors. Right, so there will be specific responsibility if work has been properly allocated between them and documented, but there will be joint responsibility in some areas. What are those areas? If the work is not allocated among themselves, any matter which is brought to the notice of all the joint auditors, any decision taken together by all the joint auditors, whether the financial statements are complying with all the requirements, all the disclosure requirements in this applicable financial reporting framework or not, and also whether the audit report is prepared as per the standards on auditing or not, all of them are to be ensured by all the joint auditors. It is a joint responsibility of all the auditors to have them, to verify them. Okay, so this is what we are telling you here. Specific responsibility: when the work is divided among the joint auditors on a suitable basis, then each joint auditor is responsible only for the work performed by them. Generally, the work will be divided based on the following basis. What are they? Items of assets or liabilities, incomes or expenditures, geographical areas, identified units, and period of financial statements. On all these bases, on all different items, on various bases, the work can be divided. Next, joint or combined responsibility. So in the following areas, all the joint auditors will have indivisible or combined responsibility. In the following said areas, there will be common responsibility of all the partners. What are those areas? If work is not divided among themselves, if work was not divided, in respect of decision taken by all joint auditors, in respect of any matters brought to the notice of all joint auditors, for verifying the disclosure requirements, and also for ensuring that the audit report complies with the relevant statute. That means standards on auditing. Next, audit reporting. Now, how audit report has to be prepared? Sir, all the joint auditors, sir, SBI 14 joint auditors are there. So all these 14 joint auditors, how they are going to give the report, sir? So how they will give the report? Generally, before the finalization of the report, all of the joint auditors will sit together, have a meeting, and they decide what kind of opinion is appropriate. So everyone will agree upon some opinion. So all of them are thinking that unmodified opinion is appropriate. There is no material misstatement. So like that, before forming an opinion, all of the joint auditors will sit together, have a discussion, and decide the opinion that they want to give. Sir, out of these 14 joint auditors, 13 joint auditors are telling unmodified opinion, sir, but there is one auditor, he is telling that modified opinion is appropriate. Sir, while discussion among these 14 joint auditors of the SBI, 13 joint auditors are telling, sir, 13 joint auditors are agreeing that they want to give an unmodified opinion. But one of the joint auditors is telling, no, here modified opinion is appropriate. Sir, now what should be done? The person who is disagreeing here, the joint auditor who is disagreeing here, is he bound to follow the majority decision? The standard says no. No partner need to be bound by the majority. No partner need to be bound by the no joint auditor need to be bound by the majority. Then what he can do, sir? He can give a separate opinion incorporating his opinion. The person is having some different opinion with the other joint auditors, he need not go with the majority. What he can do? He can give a separate audit report. So these 13 auditors, they will decide and give one audit report. This one auditor will give a separate audit report. Sir, now what will be circulated to the members of the company, sir? All the reports will be circulated. This report also will be circulated. This report also will be circulated. Now, sir, shareholder will rely on what report, sir? It is up to them. Shareholders can rely any of the report. So management will circulate all the audit reports. It will contain this unmodified opinion. It will contain this modified opinion report also. So this modified opinion, he will give reasons also. What is the basis for giving a modified opinion? So the shareholders will be having an opinion, and also the reasons for such opinion. They will decide which one to choose. It is up to them. Okay, right. So this is what reporting requirements. Generally, all the joint auditors arrives common conclusion and express common opinion through a single audit report. However, any joint auditor is not bound by majority's opinion. Right? If there is any difference of opinion among the joint auditors, then such disagreeing auditor can express his own opinion by a separate report. So if any of the joint auditor is not agreeing with the majority, then what he can do? He can give a separate opinion. Separate report. Now, sir, is a joint auditor, sir, more than 14 joint auditors are appointed for SBI. Sir, each joint auditor, can he rely on the work of the other joint auditor, or he needs to review it once again? My question is, or take a simple example, A and B, two joint auditors are there, right? So A has done the work. Can B rely on this work, or B has to review the work of A once again? The standard says each joint auditor is entitled to rely on the work of the other joint auditor. Every joint auditor can rely on the work of the other joint auditor. He need not review them once again. This Mr. A is telling, in the work which was allocated to him, there was a material misstatement. Is B required to verify that once again, whether A has done correctly or not? Not required. Joint auditor can rely upon the work of other joint auditor without any review. Why? Because other person is also a equally qualified person like you. Okay, so the standard is permitting each joint auditor is entitled to rely on the work performed by another joint auditor and need not review the work performed by the others. Every joint auditor is entitled to rely on the work performed by another joint auditor and need not review the work performed by others. Next, special considerations as per 299. So regarding the planning and performance of the audit, SA 299 tells some special conditions. See, if there is a single auditor, no issue. Now if there are more than one auditors, if there are joint auditors, there are some special issues which are required to be considered. What are they? Let us see. First point, so this point, special considerations as per SA 299. The engagement partner and key engagement team from each of the joint auditors shall be involved in planning the audit. So for example, two joint audit firms are appointed, ABC and Co, PQR and Co. Two firm of auditors are appointed as a joint auditors of some company X Limited. So while planning the audit, both the engagement partners from both the firm and engagement teams from both the firm should participate in the planning. So they are telling you here that audit should not be planned by single joint auditor. Both the engagement teams of all the joint auditors should be involved in the planning the audit. So if there are 14 joint auditors of SBI, while planning the audit for the SBI, all these 14 joint audit teams should participate in the discussion relating to the planning of the audit. That is the first point. Next, all joint auditors should establish jointly the overall audit strategy as required under SA 300. How we are going to carry out our audit, they will set a strategy, right? So regarding this strategy, planning will come in SA 300, a separate chapter is there. Okay, so all the joint auditors should establish an overall audit strategy. Everyone should decide overall single audit strategy. Next, each of the joint auditors shall assess the risk of material misstatement and communicate to the other joint auditors. Every joint auditor should do the risk assessment procedures. That means he should be able to identify what is the risk involved. He should first study the organization and identify the risk and communicate that risk of material misstatement with the other joint auditors. Okay, each of the joint auditors shall assess the risk of material misstatement and communicate to the other joint auditors. Next, the joint auditor should discuss and document the nature, timing and extent of the audit procedures for common areas and specific areas of audit to be covered. And also the joint auditor should document what are the areas, how they are going to divide the work, what every joint auditor is required to be performed, what are his specific areas of audit, what should be the audit procedures. All this should be documented in a single audit plan. Next, joint auditor shall obtain common engagement letter and common management representation letter regarding fulfillment of responsibilities by the auditor. So we have seen that auditors have to get a letter of engagement. Auditor should give a letter of engagement to the management. Yes or no? So here in the case of joint auditors, not each joint auditor will send a separate engagement letter. All of the joint auditors will prepare one common engagement letter and should send it to the management. And also management will give a representation letter. Management will give a written representation that they have fulfilled their responsibilities at the start of the audit. So in the case of joint audit, management need not send representation letter to each and every joint auditor separately. For all the joint auditors, one common management representation letter will be sufficient. Representation letter means nothing but written representation from the management which states that they have fulfilled with the responsibilities. Right, so no separately for each joint auditor it is not required to be sent. If for the entire joint auditors, if a single engagement letter and a common management letter is sent, it is more than enough. Next, The work allocation between joint auditors shall be documented and signed by all the joint auditors, which shall also be communicated to those charged with governance. And also we have told that the work will be divided, how they are dividing the work, what each joint auditor is responsible, they have to properly document it, and it should be signed by all the joint auditors, and a copy of it should be given to those charged with governance also, because they also have to know who is conducting what part of the work. So that's why. So these are the special considerations as per SA 299. What are they? First, the engagement partners and engagement teams of all the joint auditors should be involved in planning. All the joint auditors should set up a overall audit strategy. Each auditor shall assess the risk of material misstatement and communicate with the other joint auditors. They shall document what should be the nature, timing and extent of the audit procedures. They should issue a common engagement letter, and they should obtain a common management representation letter. And also the work allocation between the joint auditors shall be documented and signed by all the auditors, which shall also be communicated to those charged with governance. Okay, so these are the special considerations as per 299. So totally this is the complete content of SA 299. We have understood the meaning of joint audit, we have seen the advantages, disadvantages, responsibility part, reporting part, and also special considerations. Now let us start discussing about SA 610. SA 610 is relating to, the title of this SA 610 is using the work of internal auditor. Using the work of internal auditor. Okay. So first of all, what do you mean by internal audit? Or let me put it this way, whether the scope of internal auditor will be much higher or scope of statutory auditor will be much higher. So if you ask me, the scope of internal auditor is much higher than the scope of the statutory auditor. What is the main objective of the statutory auditor? The company auditor will verify the financial information and express an opinion on the financial statements. Whereas when it comes to the internal auditor will verify financial information. Internal auditor will verify internal controls. Internal auditor will suggest improvements to the organization. Improvements to the accounting systems and internal controls also he will suggest. It is like a consulting activity. It is like a what? Consulting activity. So statutory auditor, he verifies majorly financial information and internal financial controls, and he will just express an opinion. The internal auditor will be associated with the entity throughout the year. So the statutory auditor generally comes for a month. In any case, for any company, the statutory auditor will visit the client for a maximum period of 30 days, or in some companies 2 months, that's all. So most of the statutory auditors, what they will do, once the financial year is closed, after the financial statements are prepared, they will plan their visit to the client and they will stay there for some 20-30 days. They will verify the transactions on a sampling basis. They will look over the transactions on a sampling basis only, and they will give an opinion, and they will come after next closure of the financial year. Whereas internal auditor is not like that. Internal auditor is continuously associated with the entity. Sometimes some internal auditors will do even 100% verification also. They will do a much in-depth analysis than the statutory auditor. So the internal auditor comes once in a year, some 10 days, 20 days, 30 days, depending upon the size of the entity. He will plan the audit, he will have a sampling, he will select a few samples and he will verify them, and he will select only few internal controls and verify them, and he will give an opinion and go. Whereas internal auditor is not like that. He is continuously associated with the entity throughout the year. He will do financial information verification. He will study the internal controls, whether financial or whether operational, and he will also suggest the improvements, and also he is going to do some consulting activity also. And also, if you observe in the Companies Act, the internal auditor can be an employee also. You need not always go for an external consultant. Sometimes you can employ some person. You can employ a person with your company. He will be an employee and he will be doing the work of internal auditor. Okay. So Companies Act permits that internal auditor need not always be an outside consultant or outside consultant like a firm of chartered accountants. Even an employee, even an internal person can also be an internal auditor. And as I've said, sometimes internal auditors will do even 100% of the verification also. right? So that's why I told you that the scope of internal auditor is much higher than the scope of the statutory auditor. The scope of internal auditors also includes a part of statutory audit. Whatever the statutory auditor is coming and doing, internal auditor also will do the same. Even not only he will do the same, he will do a more in-depth analysis than what the statutory auditor is doing. Take a simple example. So the statutory auditor wants to verify the rental expenses, whereas the company is having a internal auditor. What he has done was he has prepared a schedule, he has prepared a table. What is the properties they have taken on the rent, what is the location of the property, what is the rent as per agreement, what is the rent actually paid, what is the due date, what is the actual date of payment. Like that, internal auditor has already verified all the rental expenses and he has prepared a schedule also. Now tell me, as a statutory auditor, if you want to verify, you will select a few rental expenses and will verify them. But here internal auditor has already done an in-depth analysis. He has already prepared a schedule of the entire properties and he has identified the location, what is the amount as per agreement, what is the amount actually paid, what is the due date, whether it has been paid within the due date or after the due date. All has been already done in an in-depth manner by the internal auditor. Now tell me, so whatever work that the statutory auditor wants to do, that internal auditor is also doing with a more in-depth analysis. Now the question may arise, can the statutory auditor use the work of this internal auditor? See, the auditor wants to verify rental expenses, but the internal auditor has already prepared a schedule for the rental expenses. Can the auditor use the work of this internal auditor? Can the external auditor, that means can the outside auditor, that the statutory auditor can use the work of internal auditor or not? That is the question. And SA 610 permits the external auditor to use the work of the internal auditor. SA 610, it is permitting the statutory auditor to use the work of the internal auditor. He can go ahead and use the work of the internal auditor. Okay, so it is providing some guidance with regard to whenever a statutory auditor wants to use the work of the internal auditor, what are the precautions that he has to take, what are the guidelines that he has to follow. That is mentioned under SA 610. That is mentioned under SA 610. So as per SA 610, the internal auditor's work can be used in two ways. Using the type 1 and type 2. So the internal auditor's work can be used in two ways. Right, first one is using the work of internal audit function. Using the work of internal audit function, and second one is direct assistance. Okay. What do you mean by using the work of internal audit function? That means if you take the above example, so here internal auditor have already prepared the rental schedule, whether I can use this schedule or not. Internal auditor has already prepared his report. So if you observe the internal audit reports of the company, they will not be like audit reports like 2 or 3 pages, it will not be there. Internal audit reports sometimes will be like books. Each internal audit report may contain some 200-300 pages also. Such an in-depth analysis they will do and prepare in the report. So type 1 usage of work means the internal auditor has prepared some reports, whether I can use that reports which are prepared by the internal auditor or not. The internal auditor has already done some work. Internal auditor has already done. He has already done some work and has given some reports or schedules or prepared some documents. Whether I can use the work which has already done by the internal auditor or not, that is called as a type 1 work. Second type of work is, we want to carry out some audit procedures. We will take the help of the internal auditors to perform the procedures. That means what? For example, I have planned to verify statutory compliances. I have planned to verify statutory compliances, whether the entity wants to comply with, whether the entity is complying with all the rules and regulations or not. I want to verify as a statutory auditor. Now I am thinking I will call some internal audit team. The company is having internal audit team. I have called some their internal audit team and I want to give them work. The audit procedure which I have planned, I want to verify the statutory compliances. Now I am thinking whether I can allocate this work to the internal auditors or not. I want to allocate a part of my audit procedures to the internal auditors. I want to perform the audit procedures which I have planned through the internal auditors. That kind of work is called as direct assistance. Here you are involving now you are making the internal auditors work for you. Okay, in the case of type 1 work, what is happening? The internal auditor has already done his work. Whatever work he has already done, you want to use that work once again. Now in type 2 work, what is going to happen? In type 2 work, the auditor has to, in type 2 work, the auditor wants to involve the internal auditors to do the work now. Whatever the statutory auditor is planning to do, he will allocate a part of work to the internal auditors. That kind of usage will be called as direct assistance. So as per SS 610, that there are two types of using the internal auditors work: using the work of the internal audit function and direct assistance. Okay, so when using the internal auditor work, what is the auditor that he has to see? When using direct assistance, what is that auditor has to see? So when using the internal audit work of internal audit function, what and all you will verify? Whether the internal auditor has acted independently or not. If he acted independently, then I will use the work. Whether he is having skill and competence or not. Whether he is having advocate skill and competence. Whether the internal auditor is a qualified person or some BCom graduate is appointed as an auditor with no industry experience. Will I be able to use the work? No, right? So skill and competence I will go, whether the internal auditor is having skill and competence, that I will verify, and also whether he has carried out his work in a disciplined manner or not. Will I see or not? So if the internal auditor is carrying out his work in a disciplined manner, then I will use his work. If the internal auditor is not carrying out his work in a disciplined manner, then I will not be able to use the work. As simple as that. Right? So if the internal auditor has acted independently, if he is having advocate skill and competence, if he has carried out his work in a disciplined manner, then I will use the work of internal audit function. Same factors I will consider here also. Whether the internal auditor is acting independently, whether he is having skill and competence. Right? So if he is satisfying with these conditions, I will use him for the direct assistance. He is not acting independently, he is not having advocate skill set, he is not having required knowledge, then I will not use internal auditor for direct assistance. Yes or no? So that is the standard about this. Okay, some factors which you have to consider when you want to use type 1 work, some factors which you have to consider when you want to use type 2 kind of work, when you should not use it works, when you should not use this kind of work, what are the areas where you should not allocate the work. So all these areas we are going to see. So let us quickly revise. Concept is that's all, two types of work are there. So what and all we have to see while using the work of internal auditor will be provided in this chapter, in this standard. So first, objectives. What are the objectives of the external auditor? So here the standard is about the statutory auditor using the work of internal auditor, not the reverse. This standard is not telling the internal auditor to use the work of external auditor. This standard is permitting the external auditor to use the work of the internal auditor. Okay, let us see the objectives. So the objectives of the external auditor are to determine whether he can use the work of internal audit function or direct assistance. First thing what he has to consider is whether he wants to use this work or that work. What is the kind of work, or he wants to use or he doesn't want to use. First he has to take a decision that to determine whether the work of the internal audit function or direct assistance from the internal auditors can be used or not. Next, if using the work of internal audit function, to determine whether the work is advocate for purpose of the audit. So that means type 1 work. If he wants to use the work of internal audit function, okay, whether that work is advocate or not, adequate for the purpose of the audit or not, the auditor has to evaluate. If using the internal auditors to provide direct assistance, to appropriately direct, to supervise and review their work. If you want to involve the internal auditors to carry out the audit procedures, what and all you have to do? You have to direct them, you have to give them instructions, you have to supervise them and also review their work. So objectives are three. What are they? The external auditor has to determine whether internal audit function or direct assistance, whether type 1 or type 2 work can be used or not. If type 1 work is used, they have to determine whether the work is adequate. And if he wants to use type 2 kind of work, he has to properly direct them, supervise them and also review their work properly. Next, some definitions. So they are defining a term, internal audit function. What is that? It is a function of an entity that performs assurance and consulting activities designed to evaluate and improve the effectiveness of the entity's governance, risk management and internal control process. So if you observe, the definition of external audit is to give an opinion, but the definition of internal audit is not to give an opinion. What is here expected? So it performs assurance and consulting activities for what purpose? To improve the effectiveness of entity's governance, entity's management, to increase the effectiveness of the entity's management, to increase the risk management, to increase the effectiveness of the risk management, and also internal control processes. So that's why I am telling external auditor will give only opinion, but whereas internal audit function, it is not concentrated on giving the opinion, it is concentrated on improving the effectiveness of the entity. Its internal control processes, its risk management processes, everything it wants to improve. Everything it wants to improve, right? That is direct internal audit function. Next, direct assistance. Direct assistance means use of internal auditors to perform the audit procedures under the direction, supervision and review of the external auditor. So direct assistance means what? Here the internal auditors will be used to perform the audit procedures under the direction, supervision and review of the external auditor. So external auditor will provide direction, supervisions and review, and under that direction, supervision and review, internal auditor will perform a part of the procedures which are planned by the external auditor. External auditor wants to carry out some audit procedures and he will allocate his work to the internal auditors to carry out the procedures. Okay. Now, first, let us come to the first part. What are the things that the auditor has to consider when he wants to use type 1 work? That is, internal auditor has already prepared a report. Whether the auditor wants to use that internal auditor's report, what are the things that he has to consider? Evaluation process. First one. The external auditor shall determine whether the work of the internal audit function can be used for the purpose of the audit by evaluating the following. So whether the internal auditor's work can be used or not, that he can determine by evaluating some items. What are they? Whether the internal audit function, organizational status and relevant policies and procedures support the objectivity of the internal auditors. That means what? Whether the internal auditor is given an appropriate status or not, whether he has given independence or not, whether he is permitted to act objectively, that is without any partiality, whether he is permitted to function or not, whether such kind of policies are there in existence in the entity or not. That means, so whether in the organization there are policies which are advocate to support the internal auditor to carry out his work objectively or not. Next, the level of competence of the internal audit function. That means the level of knowledge, the level of skills, the level of competence which is possessed by the internal auditor, whether he is having advocate skills or not, whether he is having advocate knowledge or not. Next, whether the internal audit function applies a systematic and disciplined approach including the quality control. That means whether internal auditor is carried out his work in a disciplined manner or not. He is carrying out the work in a systematic approach, or he is carrying his work without any manner, without any proper manner. Randomly he is doing something. Will we use audit work in such cases, internal auditor's work? No. So if he is acting objectively, if the organization status supports the auditor to supports the internal auditor to carry out his work objectively, and if the auditor is having advocate support, advocate knowledge, advocate skills, and also if the internal auditor is carrying out his work in a systematic and disciplined approach, so then only we will use the internal auditor's work. No, if to this question any of the answer is no, then we will not use the type 1 work. The same thing they are telling you here. The external auditor shall not use the work of internal audit function if the external auditor determines that the function's organizational status and relevant policies and procedures do not adequately support the objectivity of internal auditors. The function's organizational status and relevant policies and procedures do not adequately support auditor objectively, or he lacks sufficient competence. He does not carry out his work in a systematic and disciplined approach. So that means what? If for these 3 questions, if we will evaluate these three items. If for these 3 items we got negative answers, then we will not use the work of internal audit function. Then we will not use type 1 work. Next, let us come to type 2 work. So if the auditor wants to use the internal auditors for direct assistance, whatever procedures that he wants to carry out, he will allocate the work to the internal auditors. So in order to use a direct assistance, what should be the evaluation process? Let us see. The external auditor shall determine whether the work of the internal audit function can be used for the purposes of the audit by evaluating the following. Okay, so what are that? Whether the internal auditors possess objectivity and independence, whether internal auditors are having independence and objectivity or not, and also whether the internal auditors are having necessary skills and competence. This will compulsorily no. So if they are having skill and competence, if they can act independently, objectively, then we will allocate the work to the internal auditors. If they are not having independence, if they are not acting independently, if they are not acting objectively, that is they are having partial attitude towards the management, or they are not having advocate skills, then we will not allocate the work. Same thing. Prohibition on type 2. So there are significant threats to objectivity. the auditor is not able to act, the internal auditors are not acting objectively, or they lack sufficient skill and competence, then we will not use them for direct assistance. For type 2 work, we will not use them. Okay, next. Areas where internal audit function cannot be used for direct assistance. That means in some areas you cannot use internal auditors work. You cannot use type 2 work. That is, you cannot allocate the work to the internal auditors with respect to some areas. So what are that? Let us see. The external auditor shall not use the internal auditors to provide direct assistance to perform procedures. So in respect of certain areas, the external auditor shall not use the internal auditor for direct assistance. What are those areas? Areas involving significant judgments. So in whatever areas management assumptions are involved, like depreciation. Depreciation is based upon estimate. Provision for doubtful debts, it involves so many judgments and assumptions. So whenever there are more judgments, there is obviously a higher chances of misstatement. So no, if in any area so many assumptions are used, so obviously in that area there is a chance of misstatement. So that's why wherever judgments are used, in that areas don't allocate that work to the internal auditors. See, whenever you are using the internal auditors, you are taking some risk. Whenever you are using the work of internal auditor, you are taking some risk. So if you allocate high risky areas to them, you are increasing that risk. Okay, so areas involving making of significant judgments or areas with higher assessed risk of material misstatement. So in respect of certain areas, there are so many judgments. Don't allocate that work to internal auditors. In respect of some areas, there is a higher risk. There is a possibility of misstatement is much higher. Don't allocate that area to the internal auditor. Okay, and areas relate to work with which the internal auditors have been already involved. Also, don't allocate those areas in respect of which internal auditors are already involved. ఇంతకు ముందు వాళ్ళు ఒక ఏరియాలో పని చేస్తున్నారండి, ఆ పనినే రివ్యూ చేయమని మళ్ళీ మీరు ఇంటర్నల్ ఆడిటర్స్ కి అలొకేట్ చేయకండి. వాళ్ళ వర్క్నే వాళ్ళే ఎలా రివ్యూ చేసుకుంటారండి? సెల్ఫ్ రివ్యూ థ్రెట్టా కదా? They will not act independently, no. See, you cannot review your own work. So that's why internal auditors కి ఏదైనా వర్క్ అలొకేట్ చేసేటప్పుడు ఆ వర్క్ లో వాళ్ళు ఇంతకు ముందు ఇన్వాల్వ్ అయ్యి ఉన్నారు చేసేటప్పుడు, అదే వర్క్ ని చెక్ చేయడానికి మళ్ళీ వాళ్ళకే అలొకేట్ చేయకండి. Okay, so areas where IAF cannot be used for direct assistance, that means type 2 work కొన్ని areas లో యూజ్ చేయకూడదంట. Type 2 work means direct assistance should not be used in certain areas. What are they? Areas where significant judgments are involved, areas with higher assessed risk of material misstatement, areas relate to work with which the internal auditors have been already involved. Internal auditors have already done some work in certain area. Don't allocate that area once again to the internal auditors. So why these exceptions, why these areas this cannot be used? That means whenever you are using the internal auditors, whenever you are allocating the work to the internal auditors, there is always some risk. And if you allocate these risky areas to them, then this risk will be much higher. So that's why don't allocate these areas for direct assistance. Next. And also the standard says that before you use the work of internal auditors for direct assistance, that means before you are using the type 2 work, you have to obtain representations. You have to obtain some confirmations. From whom? From internal auditors, first thing. So what communication, what representation you have to get from them? You have to get a representation from them that if they will keep the information confidential, and if they found any threat to their independence, they will communicate to the statutory auditor first. Yes or no? You have to obtain a written confirmation from the internal auditor. What? But regarding what? So they have to give a written representation that, sir, we will keep the information confidential which we obtained through the audit, and if we find any threat to our independence, that means if we are not permitted to act independently by the management, we will come and communicate to you. So like that, obtain a written representation from the internal auditors. So if you observe here, so obtain written agreement from internal audit function while using as direct assistance. Whenever you are using the work of internal auditors, whenever you are using type 2 work, that is direct assistance, you have to obtain some written representations. You have to obtain written representation from internal auditors stating what? So that they will keep the information confidential. They will keep the information confidential and inform the external auditor of any threat to their objectivity. If the management is not permitting internal auditors to carry out the work, then internal auditor shall come and communicate to the external auditor. So like that, they have to take a representation. Next. And they should also take a the external auditor shall also take a representation from management, a written agreement from management regarding what? So he has to take a written agreement that the management will permit the internal auditors to carry out the work which was allocated to them. They will not interfere with them. Yes or no? Or else what will happen? As a statutory auditor, we will allocate the work to internal auditor. Now management will come and interfere. They will give some other work to internal auditors. So that's why we have to obtain a written agreement from the management that, so sir, we are using your internal auditors for our work, so don't interfere with them. Please permit us to work for, please permit them to work for us. Don't interfere in between. So like that, obtain written agreement from the management also. Right. So the statutory auditor, before he wants to use the internal auditors for direct assistance, he has to obtain written representations from management also. He has to obtain written representations from written agreements from internal auditors also. And the external auditor shall direct, supervise and review the work performed by internal auditors on the engagement in accordance with SA 220. That means if you have allocated some work to the internal auditors, you cannot blindly believe. What you have to do? You have to review them or not. And also how the work has to be carried out. You have to give directions or not. You have to supervise them or not. You have to continuously check whether they are doing properly or not. So you cannot blindly sit there. Once you have allocated the work to the internal auditors, you should not accept whatever they tell. You have to direct them, you have to provide instructions to them, you have to supervise them, you have to review the work. Right? How you have to direct, how you have to supervise, how you have to review, that has been mentioned under SA 220. Next, verify the audit evidence for the work performed by the internal auditors and ensure that evidence is sufficient and appropriate. So if you have allocated some work to the internal auditors, they will also obtain evidence or not. You evaluate whether the evidence obtained by the internal auditors is sufficient and appropriate or not. So that's what I am telling. You cannot believe the work whatever the internal auditors does. You have to direct them, you have to supervise them, you have to review them, and you should also verify the audit evidence obtained by the internal auditors whether it is sufficient or not. That also you are required to verify. You are required to verify whether the audit evidence obtained by the internal auditors is sufficient and appropriate or not. Next, documentation. So what and all you have to document when you want to use the direct assistance? What and all you have to document? Right, let us see. The basis for the decision regarding nature and extent of the work performed by the internal auditors. So what is the nature of procedures that was performed by the internal auditors? What is the extent of work that is performed by the internal auditors? Right. So what work you have allocated, document that. Next, the written agreement obtained from an authorized representative of the entity and the internal auditors. So previously we have told that before using internal auditors for direct assistance, external auditor is required to obtain written agreements or not. All these written agreements should be obtained and they should not be thrown away. What they have to be done? They have to be properly documented. They have to be maintained as a part of your audit file. And also the working papers prepared by the internal auditors who provide direct assistance on the audit engagement. So whatever working papers has prepared, whatever the working papers that have been prepared by the internal auditors, they also belong to the firm and they should also form part of your audit documentation. Okay, these are all the documentation requirements as per SA 610.
Hello students, so far you have watched sample RRB videos. If you want to watch further parts of the RRB videos, you have to install Masterminds online classes app. Now let me show you the procedure of installing Masterminds online classes app. The procedure is very simple. You just click on the Play Store. Once you click on the Play Store, now you type here Masterminds online classes. If you are an iOS user, you have to download Class Plus app and you have to install our organization code MJetGun. Now you click on install here. Now the app gets installed into your device. Now once the app gets installed into your device, you just click on open. Yes, I am just now clicking on open. Once you click on open, the Masterminds online classes app opens here. Now you enter your mobile number here. So once you enter your mobile number, you will be sent an OTP. Enter your OTP. And click on verify OTP. Now the process is over. Now the Masterminds online classes app gets opened. Now you click on the three lines in the above top corner and you select the study material section. In the study material section, you can find videos. You click on the videos and now here you find all the free resources that are there. Now here in this part you can see the remaining parts of the RRB videos. All the best. Thank you.